All right, very cool. Good morning, everybody. It's good to see you. Thanks for being here. Day 4 is going to kick off right now. It's good to see you. I'm glad you made it. I'm going to start with our legal disclaimer, and then I'm going to say a few things, and then we're just going to kick it off with our first presenter. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation should be construed as investment advice or the solicitation to buy a security. So with that out of the way, I hope you enjoyed it. I always enjoy going through that every time. It's good to have you here. We have a great lineup. We're going to start with Price Headley, and we just have another great lineup of speakers. So thank you for coming here. If you're watching us on YouTube and it's your first day, hi, or even if it's your second day or whatever, make sure to say hi. It's good to see you. At the top, what you're going to notice is it says to be eligible for prizes, ... Click on that and register for today's event. As soon as price is finished today, we're going to start giving away prizes. We've got books, we've got services, we've got all kinds of stuff. We've got tons of high value prizes. And to be eligible to register, if you just found us on YouTube, register for the event, and then that way you'll be on my list. And do it right away. I'm actually going to pull the list as soon as we get price started. Other things to say is if you like the content today, like it and subscribe. That helps a great deal. Helps us grow the channel, helps us get better speakers, helps us keep doing these great events. So if you'll do that, I'd appreciate it. It does help a lot. Want to say thank you to our sponsors today. The first one we're going to talk about is AAII. You can find out more about AAII at AAII.com. They've been a nonprofit that has been doing their nonprofit work since the 1970s. If you've heard about the AAII Sentiment Survey, that's them. They also do a ton of research. They also have an active investor division. Just do a lot of good stuff there. If you want to find out about them, go to AAII.com. And we appreciate it. Good morning, Maverick. It's good to see you. Good morning, Neil. Good morning, Kelly. Good morning, Vincenzo. Want to say thank you to Stocks and Commodities Magazine for sponsoring our event as well. Great sponsors of us. They've been sponsoring it. We were just kind of thinking about how far we've come over the years. I remember when we started doing this, Greg and I were both in the same room, and right before the event started, we're still moving around cables to make sure things work. It's a lot of fun, but we've kind of got it all kind of ironed out there. Stocks and Commodities has been sponsoring us every step of the way, and we really appreciate all of the support over the years. You can find more about Stocks and Commodities at www.traders.com. If you haven't yet, you should join the Traders Forum. The Traders Forum is a free community where you can chat with other traders, learn about the markets. We do all kinds of different lessons in there. There's all kinds of different trainings. It's a great community. We're growing it. TheTradersForum.com. You can join for free. All right, we're of course Metastock. We've talked about Metastock a lot. Metastock's been rated #1 32 years in a row. I talk about how I love to scan and find those opportunities and identify them in the markets. It can help you do that. It can help you do system testing, forecasting, give you real-time commentary, alert signals. Pricing for our delayed version of Metastock is $75. Our real-time is $210. If you pay for a month, we'll give you the second and third month for free. There's no commitment to keep it. I hope it's as helpful for you as it is for me. I wouldn't trade without it. You can sign up for that at metastock.com/conf promo, metastock.com/sales chat, or give us a call, 800-882-3040. Okay. And I do want to just say real quickly, thank you for everybody that signed up. I was looking at all the signups that we've had as a result of the conference. I want to welcome you to the Metastock family. Thanks for joining. If you haven't yet, get set up. The worst thing that's going to happen is it's not going to be helpful for you. But I will tell you this, there's a reason it's been rated #1 in its price category, 32 years straight. I love it. So anyway, let's move on. Big friend of mine, actually Price Headley is the very, very first person when I kind of went from inside sales to business development. So this goes back probably 2 decades. The very first person we started working with, I personally coded a lot of his methodologies into Metastock by personally. I guess I already said that. Price is an absolutely fantastic technician. What I like about Price is he's very easy to understand. His mentality is really what I like a lot most. What he likes to do is focus on some of the bigger opportunities that exist in the market, ignore the ones that are kind of lesser opportunities or not opportunities at all. That fits in really well with what we're trying to do to help you just kind of be able to focus on the opportunities. I love that as a mentality and as a methodology. And a couple of other things. He wrote Big Trends in Stocks and Options, I believe is the name of the book. Price, you can correct me if I'm wrong. And then he's also been rated the top market timer for a number of years from Timer Digest magazine. And he's also a Traders Hall of Fame member. So without further ado, Price, let's go ahead and get you started. Welcome to the conference today.
Well, thank you, Jeff. Good morning. Good morning, everybody. Thrilled to be here to kick off day 4. It's amazing what you guys do to set up such great full week-long plus events. So appreciate all the setup that you've done, Jeff, and your team. Let me share my screen, make sure it's coming in crystal clear. All right, ready to roll?
First try. Your turn.
Beautiful. Beautiful. Thank you, Jeff, and all the Metastock team. Good morning, everybody. Price Headley here. And like Jeff said, my focus is on the bigger opportunities, looking past the noise, the chop. As I say, why pick up nickels in front of a bulldozer? You want to be on the bulldozer. You want to be riding the bigger moves. And so my goal today, we talk about 2 favorite low price option strategies. Whether you're a bigger account or a smaller account, the beauty of trading is it's scalable, especially with what I'm going to show you here, because these are relatively cheap options. These are options where you can get a lot of bang for your buck. They're not without risk, right? Every strategy you do has risk. So as we get it started, let me just remind you, got to have the appropriate disclaimers out there that everything we're sharing with you today is based on our proprietary research. It's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. Of course, the stock and options trading, while they have large potential rewards, they also have large potential risk. We're going to talk about how we manage both the risk and the reward in these strategies today. But ultimately, remember, the past performance of any trading system or method is not necessarily indicative of its future results. Future results are going to vary. Do know that our terms of use on our bigtrends.com homepage are there for you to get more information. Now, if you don't know me, I've been trading stocks and options for over 35 years. I caught the trading bug while I was a student down at Duke University, and frankly, I got into a trading contest that kind of permanently altered my career trajectory, because I saw the potential of the markets after kind of buying and holding in a collegiate investment challenge where I bought and held really quality stocks, and I was in the bottom 25% of the participants with a month to go in this 4-month contest. And so I said, this strategy is not working. Time for me to do something different. Started active trading. This is back in the late 80s, and went from the bottom quartile to the top 1%, and just saw the potential for a more active, proactive approach. So I started bigtrends.com in 1999, over 25 years ago. Like Jeff said, he helped me to really codify a lot of my methodologies back some 20 odd years ago to help people to basically say, okay, go run scans, go find these opportunities, and use the power of computers, the power of technology. So while everybody's all hyped on AI, artificial intelligence, we've been talking about the power of a systematic approach, and obviously Metastock is a great tool to help you be more systematic. Take the emotions out of your trading and let the data drive your decisions, right? That's a big conversion, because what that means is that you have to let go of not just your emotions, but your ego. Your ego is your desire to be proven right. And we've got to clean that up to say, look, I'd rather acknowledge that we're going to be wrong sometimes. Let's be wrong smaller. When we're right, let's be right bigger. That's really why I've been able to be in the trading game for 35 years and counting, because the big ones will carry you, and then just clean up the little ones here. So from that perspective, we look at this and say, okay, how are we going to find this? We're going to talk about not just 1, but 2 small account strategies with not just 1, but 2 indicators that you can use on your Metastock platform. You can see them real clearly. And these are designed to find not just doubles, but even triples and sometimes quadruples, or 300% winners are possible and will be achieved from time to time. Not going to happen all the time. Don't have to. That's the advantage of this, is that we're talking about focusing on really big moves. And so we call it double confirmation here. So we're not talking about one indicator, but both of them. It's kind of like two rivers flowing into one more powerful river. When you get that, you're going to see that you get a lot more. It's kind of like a rocket ship getting extra turbo boosters to make sure you get more successful launches. We'll give you a bunch of charts how you can target up to 4x returns on monthly options. So we're not talking about the 0 days expiration options. That's become a real popular thing with a lot of traders trying to trade them real close to the expiration. I'm not recommending that. Because I'm saying, look, you want to have enough runway. You want to make sure you can launch and then have some time. So even if you're waiting a little bit, you're not sweating so much, right? That's a big part of it. And then we can actually double up the number of trades because of 2 systems here rather than 1. So the strategy, we call it Grand Slam options, and a sister strategy, Grand Slam Extra, where we're looking for not just any old home run. You know, a Grand Slam in baseball is when the bases are loaded, one swing of the bat can score 4 runs, and just a simple bases loaded home run turns into a Grand Slam, right? Those are really powerful in baseball. They're really powerful in your portfolio too. So let's look at a recent winning trade example, kind of start to help you visualize what we're talking about here. So what we've done, here's a trade we did not long ago on Dick's Sporting Goods. DKS is the stock symbol. And you can see that what we're looking for here, we've got 2 indicators, and let me just kind of mention what they are here. The red line in the middle panel is Larry Williams %R, percent range indicator. Now, %R is what you'll see at Williams %R. You may see it called on the Metastock platform, but the idea is that whatever you're looking at here, you look at %R, this action point here, when we break out, and the bottom indicator, CCI, Commodity Channel Index, also breaks out together. That's the double confirmation. That tells me that we believe, based on our data, and based on the history, based on our quantitative edge, that that's the start of not the top of a range signal, but actually the start of a bigger trend developing to the upside. So %R essentially is designed to calculate where you are within the recent look back range, right? So by definition, when you're breaking out, you're near the high end of the range. What you'll notice on these chart indicators is that, and these are custom, by the way, they're not the default settings for %R or the CCI Commodity Channel Index. They're actually something that I've coded, and it's available in our Big Trends toolkit in Metastock. Jeff will tell you about that more later. But the idea is that, look, notice when something breaks out and breaks out to the top percentiles of its range and keeps going to the upside, you know it's no longer a range, right? When you continue to get higher and higher highs, higher and higher lows. What's that called? That's called an uptrend, right? You can see that up channel quite clearly. Well, obviously, we don't have the benefit of being able to predict with any kind of 100% precision, right? There's uncertainty on what the future holds. There's never any perfection on that. But what you do have the benefit of following is when %R changes from a range into what I kind of tongue-in-cheek call %T, percent trend. This top 20% of your signals here is no longer a range, right? It's more of a %T, a percent trend. The 80-20 rule, you've probably heard of that as well. It applies very heavily in trading, which says that the top 20% of my trades are probably, especially in options trading, are probably going to drive 80% or more of my total profits. And you say, how is that possible? Because when you get on these really big ones, they can be really quick and really dramatic to the upside, right? You can see here that we were buying at the time that when we got our breakout signal with both indicators confirmed, right? CCI, by the way, shows that same pattern, right? We're staying in that, basically that rectangle in that overbought area, staying overbought, right? So if there's ever a word that I believe is going to cost you more opportunity missed than any word in your trading language, it's the idea that overbought is not buyable, right? By definition, when you hear the word overbought, you think, well, that means I can't buy it because it's overbought, right? Break that whole thing in your mind, break that apart and say, don't get stuck missing out on overbought situations, staying overbought, because guess what? Those are your power trends. Those are your trends where you're actually going to make more money if you know how to trade them and stay with them while they're staying in those overbought ranges. So biggest breakthrough, biggest thing I want you to take away from my presentation of all the fellow traders and interesting and great techniques that are out there is to say, for me, take away that overbought can be powerfully good, not powerfully bad, okay? So the idea is that what are we doing? We're saying, look, we're getting the breakout, we're getting the takeoff of the rocket ship, right? You want to be riding that as it takes off when you get that double confirmation. You do not want to be riding it when it breaks out over here on the left and then we don't get the confirmation from the CCI. 1 out of 2 doesn't cut it, right? We need both of them breaking out together. You see, that saves you from kind of a fake out rather than a true breakout there. And you get faked out once, you say, don't fool me once, but don't fool me twice. I won't trade it the next time, and try to miss that next one. And then of course you miss out on the big win, right? So we want to be able to miss a lot of those fake out noisy signals by not having just one indicator, but 2 strategies and 2 techniques guiding us together, right? That's the power of, like, 2 heads are better than 1. In this case, 2 indicators are better than 1 for me, right? So the idea is that, okay, we get into the 260 strike calls at our breakout point here when Dick's Sporting Goods is trading about 232.5. You say, hold on, why would I buy a 260 strike call when the stock's way down at 232.5? Doesn't that mean I've got to get it over 260 to start making money? No, that's another fallacy of options buying. And people think, well, I don't want to buy that out of the money option because it takes too big of a move. But the reality is you just need speed of movement. If you're getting good speed of movement, you can get your risk capital back and then keep riding from there and see how you can turn it into something even bigger potentially, while we guide you every step of the way with our alerts on how to manage your way out of trades that aren't firing too, right? But the idea is that, look, here's a great example of this. So you see, we paid 85 cents. That means we paid $85 on each option contract to control 100 shares of stock, right? You would have paid over 23 grand if you're buying 100 shares of Dick's Sporting Goods when we got our breakout signal. Obviously, we're paying a tiny fraction of that, right? Controlling $23,000 worth of stock for just 85 bucks, less than 100 bucks. And we will never pay more than 100 bucks a contract with this Grand Slam strategy. So you're really getting a lot of bang for your buck. And we tend to show our examples based on a typical starter account might put in $1,000 a trade, but you can put it in as little as 4 contracts here, because we are going to scale out of our winners. We're not going to sell it all at once. What our goals are we have 3 different goals here. First goal is, how do we get your risk capital back? So our first target is a double on your money. When we get doubles, then we sell half of our position, right? So if in this case, if you were putting $1,000 in, you get like 11 contracts in for 935 bucks. You can't buy the 12th contract. That would push you over your maximum amount invested per trade. So get 11 contracts, can't sell a partial contracts. You can't sell 5.5. You sell 6, just over your halfway point there. So 6 or 11 on an odd number of starting contracts, and now you've gotten more than your risk capital back when it doubles. Notice it doesn't double right away, right? The stock has to rally in a meaningful way to start to get us there. But you see, it's not a huge move. Our first target's getting hit as the stock pops up from 232.5 to about 240 just a couple of trading days later. You can see, why are we riding this thing? Why are we staying with it? Because we're staying in that overbought area and the stock is continuing to advance. When we get into our stop rules, it's when the stock is not advancing in future days after we get in that's the tell that we need to go ahead and move on out, even if it's not that much against us. If it's not for us, that window is closing. You need price validation that indeed the stock is going the direction you thought it was going to go, right? So we've got some specific rules we'll get into on that too to help clean up trades that aren't firing. But the idea here is that, okay, the stock's advancing, and you say, well, it's still in a great looking percent T, top 20% of our signal, staying very overbought, staying in that power trend up. Why would we sell any of it? Because when you sell half of your trade at a double, it gets you to a freed up position, not just financially getting to a risk-free position, but also to a psychologically free position to say, now you can take a deep breath. Now you can let the rest of the trade run. Now you can feel even better that, okay, I've got no risk in this trade. Even if the rest of the trade went to zilch, went to nothing, you wouldn't lose. Worst you do when you sell half your trade at a double is, if the rest of it craps out, you break even on your whole position, okay? That's the worst case. Obviously, we don't want that to happen. As you see, it pops up that second day in the trade up from 240 to 245. Now we're getting our next target, which is a triple. So think about this. The stock has moved under 5%, and we're making 200% on our second target. So we sell half our remaining position at 200%. Our final target is 300%. You can see just over 250 now, so we're getting our final target hit. This is happening in less than a week, right? So the idea is that it's gone from 232.5 to 250. It's up 17.5 points. That's a nice move, right? But in percentage terms, that's nothing off the charts. It's nothing unheard of, right? To get in the neighborhood of about an 8% move, you make 300% on your final target. Why don't we hold for even bigger targets? Why don't we do different things on our trailing stops? Our experience is that once we get to 300% in this short of a period, it's usually a pretty good time to take the money and run on the remainder of your position. Some of them will keep going, some of them will fall back. But the idea is that you're scaling out of your profits, out of your winners gradually, right? You've heard the old phrase, let your winners run, cut your losers short, cut your losers quickly, right? Well, this is a way that we let our winners run gradually and kind of gradually take money off the table as the market makes it available to us. As you can see in this example, if you put in 935 bucks on the 11 contracts, $1,000 maximum commitment, you'd make 1,530 bucks in gross profit before commissions. Now remember, commissions are way down in options from what they were when I got started trading 35 years ago in options, when we had ticket charges where even a one lot cost you 30 bucks plus. It was like, no, we're not doing that anymore. Thank goodness. Now you pay no more than $1 a contract on each side. If you got 11 contracts in, 11 contracts out, no ticket charge, your maximum total commission would be like 22 bucks. Okay, so you still be up over 1,500 bucks even after commission. So it's a beautiful time to be an options trader. We're going to walk you through more examples on this, but how do I find these trades? My team and I run scans where we're looking across. In this case, those were hourly charts, right? We're looking at really the first hour's close. It's really our big action point. In fact, my team's scanning right now for opportunities that might hit right after this 10:30 close, first hour in the books. You know, the market's been volatile this morning, right? We had the NVIDIA earnings last night. They looked good. Stock was up initially, popped up to 135, was up about 4 points. Now it's down 4 points, back towards 127 and change. Volatility's out there, right? The key though is like who's winning the war at the end of the hour, right? So we don't want to overreact off the open. People who did that with NVIDIA are not too happy right now that it's flipped on them. We want to see that we're getting that follow through by the first hour's close. So we wait for those indicators to set up at 10:30 Eastern, first hours in the books, and are we getting not just that both of those are breaking out to the upside or in some cases to the downside for bearish put options purchases, but the idea is that getting both of those together and the history saying that when you do this on this particular stock, indeed the odds are in your favor, right? So that's important too. We want to know the odds are in our favor and in your favor when you get signed up as a Grand Slam option subscriber. Got more on that at the end of my presentation. But the idea here is that, look, we want to see both of them launch and get the kind of twin turbo boost there. I can't give away the settings here, but I can tell you when you become a subscriber, you get full access to the specific parameters we use for %R, CCI, and all the other rules. So you know exactly how you can kind of follow along at home. But we send out the trades to you via real-time email. You can also get them via a mobile phone update on the WhatsApp technology as well. So let's look at another Grand Slam trade example where both of these are firing together. And here's Roblox, RBLX. So here we are back in January. Now, remember, we're going out to the monthly option. So like right now, I'm not messing with anything February. We're basically been focusing on the March options. By the end of next week, we'll then be starting to focus on the April options. We're going to give ourselves about a month to go before the options would expire. So back in January, we bought the February monthly 80 strike calls on Roblox when we got both of our indicators breaking out together. You can see the breakouts happening here. Now, this is important. Breakout's happening around 64 bucks. We're buying an 80 strike call, right? That seems really expensive. Some 25% out of the money, right? We always want to get it under a buck or less. So 79 cents means we paid $79 to control each 100 shares of stock. It would have cost us about 6,400 bucks. But when you get these breakouts, sometimes you'll get a pause. Sometimes, in this case, you did. You see it broke out, we bought there, and then a couple hours later, we're down. Now, this is important. We don't put an initial price stop on these out of the money trades. We use what we call a time stop. And our time stop rule says, look, give it some wiggle room, give it a chance to kind of do that little back and forth dance that a trade may do when you get a trade started, right? This is also why it's important to never get too heavy on any one trade, right? If it doesn't fire, you're going to have times where you have to take a loss. It could be a 20% loss, 30% loss. If it gets really bad, it could be a 50% loss. You know, theoretically, you could lose what you put into any options purchase, right? But we're going to clean it up by the end of the next day if it's not firing above, in this case, $64 where we got in. but we don't want to overreact. So our first action point is going to be here on Thursday afternoon in terms of our stop. We haven't gotten our target yet. We're saying, look, our first time stop action point would be here Thursday afternoon. Well, look, we're now up to 65. We're above where we got in. So we give it a chance, we hold. And you can see that first few days, it's hanging all around 65. It has these little fake outs. If you're overreactive intraday, you can get yourself whipsawed by those little quick morning flips down and then it flips back up. We're not overreactive to that. We're waiting to the end of each day to not be too overreactive. So you can see that we avoid that noise, we avoid that shakeout and that fake out getting flipped out of your trade with too tight of a price stop. And you can see then as it pops up about 7 or 8 trading days later, we're getting out the middle of the next week. You can see, or maybe 2 weeks later even, from that prior Wednesday. This one took a little longer than I'm used to. This one, 2 weeks later, we're getting our first target at a double, right? So we bought it at 79 bucks a contract. Thus, we've got an order out there to sell half our contracts when it gets to $1.58, right? So notice it's up to $1.58 as the stock has rallied about 4.5 points, somewhat 7% in our favor. So we're not getting massive leverage here, maybe 16-to-1 leverage on that first target. And now we're giving it a chance to keep on running. You can see that, again, because it's so much further out of the money, we need a little bit bigger move. But we don't need it to go to 80 bucks, right? 80 is a strike price. You can see our second target at 200% is achieved when we get to about 72 bucks. So now the stock has rallied from 64 to 72. We're up $8 or in the neighborhood of about, what, 13% move. And we're saying, okay, now we're getting that 200% gain. Now we're up to like $2.40 is our exit on the second target. Our final target up there around 320 is hit when we pop up here at about 75 bucks. We're still 5 points out of the money. We've had a great move, right? It's gone from 64 to 75. That's 11 points. That's just under 20%. And you're getting 301% on your final target, right? All targets achieved, you can see generated on a maximum of $1,000, which wasn't quite what we got in. We got about 12 contracts in for about 948 bucks. But you can see here that 1,671 bucks in total profit before commission on those 12 contracts in and back out. So the beauty of this is that it allows you a way with the time stop rather than being overreacted to a price stop on the starter point of your position to not get shaken out. Now, I will say that once we get our first target of a double, we do like to raise our, actually put a price stop in back at break even so that we don't like to give up all the profit on the whole trade, right? We don't want to turn a double into a break even on the whole position. So even if we get a break even on the second half on our follow through position after we get a double in the first half, that would mean that we would still at least average a 50% gain. That's our kind of minimum objective once we get that first double profit target. So the beauty of this is you can see there were some shakeouts, there were some little volatility points on the hourly chart, and you want to have a way to manage that and not be too overreactive. That's a big lesson that I've learned in my 3.5 decades of options trading, is that you want to be reactive enough, but not too reactive, right? Not all trades are going to hit all their targets, right? Some of them are not going to go, and so we've got to know that even the ones that get part of their target, and then how do we manage the rest? Here's a great example of that. This is Carvana. Carvana's options are quite expensive, right? Carvana is known as a high short interest stock. It's got a lot of potential to move up, but also potential to move down. So basically, you've got that higher premium you pay. So you can see when we got our breakout signal here, as we're just getting going, that first hour's breakout here and starting off, getting in at the start of that next hour right there. The stock's trading about 146. We're having to buy a 190 strike call. And so we're like 44 points out of the money. That's like 30% out of the money. That first move up, right? And you can see, by the way, as you get that first move up, then you get that little dip down. This little retest point here is happening on both of these. Oftentimes those retests will be really key points on the chart to show us that it should hold there. It does, and it starts to advance. We go up to about 156, so we're up 10 points on Carvana stock, something in the neighborhood of about a 7% move in the stock gets us our double, right? We paid 90 bucks a contract. 90 cents means 90 bucks for each 100 shares we're controlling. And so, of course, on $1,000 invested, you'd buy 11 contracts for 990 bucks. You look at this and say, okay, well, you sell, basically half your position, 60 or 11 at the 100% gain when the stock's up to 156, and we feel really good about it right here, right? Right here's the point where a lot of people would say, hey, why are we not just holding the whole thing? We can see in retrospect why, because by selling half at a double, it basically gets you that risk-free position, and then you get stuck in this sideways chop phase, right? And you can see it's just flagging back and forth, and you see that actually because of the loss of time, as it trails back down here, we actually get our trailing stop hit. Our break-even stop actually ends up being a slight loss by the time we get filled with a little bit of what we call slippage. And you say, oh man, we took 100% and we ended up at minus 11% on the second half of our position. It happens. That's why we're kind of cautious about putting stops in. At the same time, we're saying that's just good trading, that it's not moving fast enough, time to clean it up and move it on. As you can see, you make 100% on the first piece, you lose 11 on the second, we still make 490 bucks on the whole trade. So the power of this is that, hey, the trader who held it at the 100% gain did not take anything off, and then it hits back to break even, you're really feeling a lot of regret at that point, right? I don't feel so much regret when it's like, okay, we gave it a chance, it didn't go, it's time to clean it up, move it on, and we still make nearly a 50% gain on the whole position. So the idea of this is that we want to smooth out the ride. We want to take the emotional volatility as well as the financial volatility down. So these are success stories. Even though it didn't fire ultimately, we still took some money, a healthy amount of money out of the trade. Here's another one that was slow to get started. This is Target Corp, TGT. It got our first target on TGT at a double, and then ended up getting to the second target, but we had a little bit of a bumpy ride while we were waiting. And the key here is the retracement retest I was just telling you about. All right, there's our launch point. Should be launching, and we get stuck in a sideways flag, just slightly lower flag. Then it starts to go. We're feeling pretty good, right? Starting to work the way we thought. And then we get this key retest here. And this retest is another thing I look for. Remember, the retest is this pullback bar right here. Put a big R on it. That retest bar, you can see we're just bumping all around it there into the close. So look, it's right around the retest when both of these came back under their overbought threshold. Give it one more day, it ends up gapping up that next day. We go up 101% right off the open, then 200% as it pops on up from 166 to 170. And then our trailing stop gets hit as it triggers back down here. We've raised the stop again to 100% area, and we get out 105%. In that last piece of our position. So that's where the structure of the chart said, while it was a little sloppy start, it still said that the retest was holding. Let's give it a chance one more day, and the one more day paid off for us, $1,219 bucks. But if it wasn't holding, we'd go ahead and clean it up and move it on. And let's face it, there's going to be losing trades too. Here's one that didn't fire per our time stop. This is Floor Corp, not a household name, but it's actually a construction giant. And you can see here that the idea with Floor is that we're saying, okay, look, we think it's in that classic launch phase here. We're buying the 37.5 strike calls when stock's about 34.5. We paid 66 cents, right? These options were not that expensive. But just because they're cheap options doesn't mean they can't get cheaper, right? You can still lose what you put into an option, and so you still have theoretically 100% risk in any option that you buy, right? So we still have to have good trade management. You see, it looks like it's starting to work at first, and it starts drifting back down. Then it's just too darn slow, keeps on that sideways to lower drift by the end of the next afternoon. So that last hour, the following afternoon, or any subsequent afternoon after we get in. If I got in today, I would not use this afternoon. I would use next afternoon, tomorrow afternoon, and beyond as my first kind of time stop exit point. I want to give it enough time, but not too much time to let that thing play out. Looked like we were kind of staying in that overbought zone on the %R. But the CCI was starting to drift a little more than I liked. It had a slight violation here. It was kind of drifting down. It's like, it's just not the right, 1 out of 2 indicators holding is not the right pattern. Let the time stop kick in here, take you out just under a 17% loss. It turns out that it ends up rallying a couple of days later, but you know what? That's the woulda, coulda, shoulda. We all play that game. We can play that game, and it's a game you don't want to play. Your goal should be follow the structure. The structure of the indicators, to me, is even more important than the price action. As the structure is not setting up properly, it tells me we're losing our impetus for wanting to hold the position any further. It just didn't follow the winning classic profile, even though it ended up coming back and would have been a bit of a winner. It's just not the classic big winner profile. So we clean it up and move it on. Here's one that did hit all 3 of the targets on AMD, Advanced Micro Devices, the big chip stock calls. And so you look at AMD here, and you see that this is why you buy the breakout in the first place, right? Both of them breaking out on AMD right off the first hours, big surge, big gap up. We don't ever claim we're going to catch the exact low. We don't want to, right? When you're buying options, you have a need for speed, right? You don't want to buy something off of a low and then wait for a slow boat. You want to be on the speed boat. You want to be on the lead pony here that's taking you out the gate first and staying first. Right. So the idea here is that, look, we say, okay, we get the breakout, we get in right off the open of that start of that next hour. And it's just a straight vertical, higher and higher lows, pretty much just about every single hourly bar there. Right. And so you notice, what does percent R do? It stays near the top couple percent of readings, right? It doesn't get much stronger than that. The CCI also stays there, although CCI even shows us a little retest on that one red candle out of that whole 48 hours that we held the position here. But the key is that, notice, when we got the breakout, look where AMD was trading. It was trading around 186, 187. We're buying a 260 strike call. Now, when I launched Big Trends over 25 years ago, I can tell you that I was a lot more conservative. I was basically like, I better buy in the money options, get rid of a lot of time premium, but I was losing a lot of leverage. And so what's happened in the past 2.5 decades since launching Big Trends is that I've become more and more confident in saying, look, these patterns, you don't have to buy in the money. You can buy at or out of the money options and bet that we're going to move closer to the strike price, and more importantly, that we can get our risk off in a lot of cases, and thus further better manage the rest of our position for even more leveraged opportunities. So for gap up the next morning, goes from, like we said, got in about 186, it opens about 197 the next morning, get just past our 100% target, up 110% on the first half of our position. See, we only paid 76 bucks a contract, right? Because we were pretty far out of the money. And now we're getting just less far out of the money. So we get that double the next morning. Then the following morning, it gaps up again. We get our triple, and then we even get our 300% by the time it pops up here at about 210. Notice, we're still 50 points out of the money as we're getting a 300% profit, right? So it just shows you that going from out of the money to less out of the money can be very profitable, especially when you get that kind of runaway speed working for you. The takeoff is dramatic, and it just keeps on cruising, generating over 1,700 bucks in total profit on that trade for 48 hours of work, right? So it's a beautiful thing. Again, you see it did pop back down the next day. We don't know that's going to happen. Sometimes it'll keep going, sometimes it won't. But the idea is that you're taking those profits gradually as you go. Now, we've shown you some individual trades, but we want to show you when we stack all the trades that we called out for our Grand Slam option system. This system actually goes all the way back to 2017. So it's been around a while, right? Through a lot of different market conditions, including the COVID pandemic, including the 2022 bear market. Even with all that, you can see a $5,000 account grew to $36,783. That's a gross value, and that's a gross profit, $31,783. Those are gross before commissions, before subscription investment. And the idea is that, remember, this is past performance. We just because we look at past performance, remember, past performance can never guarantee future results. Future results are going to vary. But what I like about this is that we weren't compounding the amount we put in per trade. Even if you started with a $5,000 account and you grew it to the mid 30s, that you can see we're still applying the $1,000 per trade even many years later. So we're not trying to compound this result, and thus that's going to help keep you, I think, a lot more steady in your overall risk profile compared to those that try to compound their amount invested per trade. And if you looked at our Big Trends website, actually, you'd see that the Grand Slam options service is actually sold out and unavailable to the masses. But I've set aside a few spots for you to take advantage of this. So this won't apply. Don't go on my website at Big Trends, but basically I'll give you a special separate page. And what happened when it was sold out, it's sold out for a while now, is that we had a lot of people requesting to be on the wait list and not getting on. And so we actually developed our second strategy, the Grand Slam Extra strategy, which basically kind of just expanded our parameters a little bit and the names that we could trade a little bit more. So it was beyond just the tech space, going into some other spaces as well and getting some other variety of trades. So basically, it's an opportunity for folks. I did say I'm going to open up a handful of spots in Grand Slam options as well as Grand Slam Extra as kind of a package deal to give you two strategies, two services, more diversification as part of this thank you for Metastock, including me in today's event, and for you being with us today. So basically when you get Grand Slam options as part of this super special I set up for you, I'll tack on Grand Slam extra as well, so you get twice the trades. We expect somewhere in the neighborhood about 8 trades a month on each service, so you could expect up to about 16 trades per month with the combination of both of the 2 Grand Slam strategies. Now let's look at some trade examples from Grand Slam Extra. And everybody knows about Palantir last year, right? You can see that you don't have to be early to take advantage of these. This is a Palantir trade we did back in December, late last year. So even if you missed a part of the move, you can see that you could have still taken advantage of this. And so we saw this breakout in Palantir when the stock was around 70 on that first big hour surge, right? So we get that first morning surge, first big hour green candle up there. Both our percent R in red and our CCI in blue are both breaking out. They have to be both breaking out together, right? If one's been above there and then the other comes along later, no good, no dice, right? It's both a fresh launch breakout together, and that both of them have to be happening on that first hour's close, not in the middle of the day, but on that first hour close. So it really sets you up for saying, okay, this thing really looks like something that has potential legs to the upside. Now here's the power again of the time stop, because you can see that that first day we're starting to make a little move in our favor, not a huge one. And then look what happens. That second day, the first half of that second day, we get a little pullback in the first part of day 2 in that trade. You say, oh, wouldn't that stop you out? You're below there. Well, remember what I said? Your action point is coming into the end of the day here, and by the end of the day, we're just at or above where we got in. So we said, look, give it one more day. It's basically not against us, not that much for us, but we're not violated yet. And then you can see, in retrospect, what a perfect couple of retests that was, right? The retest is when we pull back here and you say, hold on, that first low, didn't that get violated? Well, by the close of that later that day, it did not violate. It was below it, and then it didn't. The CCI actually picked it up later in day 2 that it was a beautiful kind of marking the low retest on the CCI blue line there. So those retests are a guide for me of saying, are we generally holding up when we get the fact that, hey, the bulls are going to get tested, the bears are going to get tested. Whenever you're in a trade, you know that there's a battle going on between the bulls and the bears. That's just a reality, right? The bears are going to take their shot to knock something that's good down. And likewise, when you got a downtrend, the bulls will take a shot with a short covering rally to see, can we get this thing going the other way, right? So the key is on those retracements, who wins the war? And you can see in this case, the bulls are still holding the ball, even though they're tested intraday, they're still holding the ball by the end of the day. And you can see then it starts to launch here, and you can see as it starts to really take off here about day 4 in the trade, we're up to the mid 70s. We've gone from about 70 to 75. Stock's up about what, maybe 7%, and our options are doubling on the first target. Later that day, we're up to about 76.5. The stock's up now, pushing towards almost a 10% move, maybe 9% move, and we're hitting a triple. And then the following morning, it gaps up past our 300% target. Stock opens over 80. So stock's gone from 70 to 80 in about a week, and we're getting 366%. So it's better than we expected. And you see why we take that last 300% or more profit, because it gets the hard flip back down, and in 2 hours, it's back at $72, right? So the total profit on that trade was $1,800 before commission, and we paid $75 a contract, right? So you can see in that case, on $1,000 invested, that would get you in for about 13 contracts total, right? From like $975. So the beauty of this is that, okay, you don't get too overcommitted to any one trade. You get to take advantage of trading market leaders. If you look back and say, how did I miss Palantir last year? Well, again, you wouldn't have to catch all of it and still could get a really meaningful, in a week, could get a really meaningful part of a market leader. And by the way, we're not buying Palantir now, right? Obviously, it's gotten whacked here over the past week or so. And so the idea is that timing is everything, right? Here's a more recent positional one we just booked here this past week or so. This is Lam Research, LRCX, another chip name, right? We weren't trying to trade NVIDIA in front of the earnings, right? We're saying, look, the Lam Research we felt like was a much cleaner setup before the earnings. And you can see here that this is going back to the prior Tuesday where it broke out gap up by the close of that first hour. Stock's trading about $85. We're buying the 95 calls. It's actually not too bad to pay about 11% out of the money for a chip name, you can see that we bought the March monthly options. We don't ever expect to hold it into the expiration. That's another caveat for you, is that our rule is that we will never hold it with less than 2 weeks to go before an option's expiration. So even if we're waiting, we would say, okay, the first Friday next week's first Friday close, March 7th, would be the last day I would hold a March 21st March monthly expiration, which is a third Friday in March expiration. So we paid $83 per contract. Our target was a double on the first piece. We got it the following day, right? From Tuesday morning, then Wednesday morning it's popped up from about 85 up to about 89 and change. So it's up 4 points and change. We're up about 5% on the stock, and we're taking 100% gain on our first half of our position. As you can see, after it pauses, the next day it actually pops up to about 91.7, and we're up a little more than 100% at that point, but we're not up to 200%. That's our next target. We didn't get it here, you can see. Then it fades, right? By late last week, it's fading back down into the 86 zone, and our trailing stop is hit. In our second half, we only get 18% gain. But the beauty of this is that take those two halves, add them up, that's 118% divided by 2, your average gain for the whole trade was 59%. So again, for a trade from a Tuesday to a Friday, make 59% through the market volatility we've had, very pleased to be able to take that down. Remember, past performance on all these examples is never a guarantee of future results. The next time we trade any of these names, Lamb Research or anything else, it could be a loser, right? So the time stop would have to take us out on the ones that don't fire. It happens. Here's this is Grand Slam Extra, and you can see why we wanted more than just tech into the mix. This is GE, the original Dow stock. And you can see this is going back here to January 14th when both the percent are in red and the CCI in blue. Remember, custom settings, don't use the default time frames for those. Custom settings, you can see the breakouts happening here, and the stock's about 175. So what are we buying? We're buying a 210 strike call. We're 35 points out of the money, which is right about 20% out of the money on the stock price at the time. That seems like a lot, right? But sometimes stocks are expensive and stock options are expensive for a reason. And that's been my experience, is that when you think something's too expensive, be careful about using that as a rationalization why you shouldn't trade it. The key is, do you have a plan to take the money off the table, hopefully relatively quickly, not try to ride it through the expiration. Notice these options were not that expensive. We paid just $63 to control each 100 shares. 100 shares would have cost you $17,500, right? So you're still getting an incredible leverage against the stock by buying a 63-cent option, $63 to control each 100 shares, right? So if you're looking at that as to how many contracts could you get, in this case, that would get you about 15 contracts, right? You'd be in for like $995. And you say, okay, well, you get the first target. And you can see what you really want to see is kind of the stair step up, right? As they say, stocks take the escalator up and sometimes the elevator down, right? So a stair step, a flattening doesn't really worry me that much. Then the next stair step, next flattening, next stair step, next flattening, right? You're climbing the stairs up. That's a good uptrend pattern. You can see it on our indicator charts where we're getting kind of our first percent R retest right in this area here, into this little support point. You can see CCI never quite gets there. It gets close a couple times to a retest. But you can see that we get our first target here before it reports earnings. Stock has rallied from 175 to about 186. So it's up 11 points, or about, 6%? We're getting 100%. Now, this is the only time with this strategy that I will hold into earnings, is if you can get all of your risk capital back before the earnings event, then you should actually want a free roll and give it a chance to go, because sometimes those will turn to even bigger winners than 200 or 300%. You can see the stock went from, before the earnings, it was under 190, trading about 187. The next morning on earnings, it gaps up over 200, trades about 202, and then intraday trades to 205. We own the 210 calls. So as it gaps up more than expected, we end up taking out 301% on our second target instead of 200%. And instead of 300% on our final target, we make 542%. And we were saying, book them, Dano, right? We don't try to keep holding and hoping. We're taking down those profits promptly right after the earnings gap in our favor. So that trade makes an outsized outlier gain where we would say don't expect this much, right? Don't expect 500% wins, right? Our goals on the upside are usually 100, 200, 300, but sometimes you get a better than expected gap in your favor, especially tied to an earnings event. Now, if I had something coming up with earnings tomorrow, I had a position on and I was slightly profitable, slightly unprofitable, whatever, I would get rid of it before the earnings, okay? So we're only willing to do this when you've sold half your position at a double or better, and now you have that proverbial free trade on the remainder of your position. Very important risk management lessons here for you, things I've learned in 35 years that you can apply for your own trading and benefit from it. Now, how do we get these out? We send real-time trade alerts whenever we have a new signal. So here's how you can start getting these and taking advantage of this too. I'll walk you through this offer and how you can lock it in. Then I want to leave some time for Jeff to talk about our Big Trends Toolkit and Metastock too. But what I've done is I've set up a special offer for you where you can get 3 months to not one, but both. 3 months of Grand Slam options. That's our original Grand Slam technique. And then 3 months of the Grand Slam extra bonus trades strategy that we added on for subscribers a little over a year ago. And you say, okay, so how do you do this? Well, I'll show you the link that you go to in a second, but I give you a lot of extra education along the way. So you can truly learn how to do this yourself over time. It's not a black box. I just ask that per the terms of service that when you sign up, you use it for only your own benefit. You don't share this with anybody else. So you get the settings and rule sheet, you get the weekly video training from me, and you get a dedicated email to me and my analyst team if you've ever got a question about what were we seeing on a trade, what were we thinking, is like we guide you through that every step of the way. So that's a $1,782 value if you bought it off my website, $297, $297 a month for each service times 3 months of each. Total of 6 times 297. You're getting it for less than the normal cost of one today. Okay, 1782. Scratch that out. I'm giving you 3 months of each for just $277. Why would I do that? Because I want you to experience this. I want you to see how it works. I want you to start putting it to work in your portfolio across both of the strategies. So the link that we've set up for you in the bottom of the page here is members. It's not a www link, so make sure, not a www link. It's members.bigtrends.com/grand, right? When you go to that page, by the way, you'll see a really clean, simple order page that looks like this. So basically, you'll see that our order pages don't have a lot of text, a lot of talk on them. It's just basically like it's time to act, right? It's time to take action. It's a secure page. You can put your payment information in there, or on the bottom right of the page, we've got a PayPal link in that orange box there too. You can review the terms and conditions, click on that, go through PayPal and tag it in. 277, we've already taken all the discounts off. Like I said, taking it down by more than 85% to 277. You could also add a multi-hour boot camp training. If I know I've had to go fast here to kind of update you about how you can lock it in, but we teach you the Grand Slam strategies part of this, like Gamma Options Boot Camp multi-hour course. You can get lifetime access to the boot camp for only 77 more bucks if you want to add that to your order. Just click that there, and it'd be $354 with the lifetime boot camp access along with the 3 months of each. Or if you just want the 3 months of each, remove that, and there you go, $277. So it's all right there, and if you got questions, you can call our 800 Big Trends number, or you can email clientcare@bigtrends.com. So quick couple of questions that people tend to ask about the service, and then I'll hand it back to Jeff. It's simple. It's options buying. We're not doing spreads. We're not doing option selling. We're just giving the leverage of the out-of-the-money options, calls, or puts, and then we're always buying for $100 or less a contract. So you can get started with this with as little as $400 minimum, because we'd want you to have at least 4 contracts in each trade to do the scale out. We say 8 to 12 new trades on average. Like I said, I'm expecting over the course of the next 3 months, you'll see at least 8 per service. So that's in the neighborhood of about 50 trades over the next 3 months, getting your cost per trade down under about $6 a trade, super value for something that can make you potentially 1,000 plus on a trade that hits its targets. Now, how long? A few days to a few weeks. Some of them, like we showed you, were 48 hours. Some of them were a couple of weeks. How long they took to get to their targets. We send you the real-time email alerts, when to get in and always when to get out. You know exactly how to manage every trade from beginning to end. You can also get the WhatsApp mobile phone updates too. And we'll always give you profit target levels. And then the stop losses will be either time stops or the trailing stops once we get our first double on those trades. Remember just what one trade was able to accomplish, like the Dick's Sporting Goods example, hit those 3 targets in a matter of less than a week. That's just a classic example of what we're looking for. Remember the history on what we did. Again, remember, past performance never guarantees future results. There's going to be ups, there's going to be downs, but we guide you through every step of the way with a system to help you manage and get that growth into your portfolio. So this Grand Slam package gives you 3 months of not one, but both of the 2 services to double up your trade opportunities. Like I said, over 3 months, we'd expect to get you about 50 trades or more. That's a $1,700 plus value, but it's yours today for only $277. Go to that link, Jeff. Thanks for posting it in there. It's members.bigtrends.com/grand. Check it out, lock it down, and you can call us at our 800 Big Trends number if you have any questions getting your order in on this super special value. I want to thank Jeff and his team for having me. I want to hand it back to Jeff so he can also tell you about the Big Trends Toolkit, which is a set of the tools that I use to find trades like these and many more in the Metastock platform. Thanks again, Jeff, for having me.
Just looking for my mic, actually.
Appreciate you.
Let's see. Price, we have a few questions, if you don't mind.
Sure, go ahead.
Bill would like to know if you use volume in the Grand Slam option system. Do you ever look at volume as a confirmation?
We watch volume is a good question, Bill, because I've tested it. What I found was that volume can give you some confirmations, but what it can also do is it can cost you some situations that the volume will be gradually building in, but maybe not big enough at first in some cases. So my experience is that what it does is it actually ends up reducing our opportunities down, and so we actually don't require the volume filter. What will happen is, remember, the stocks are driving the train here. We're latching on to those big institutional stock moves with the options on that. And so that's basically why we know that when you see those price moves, the institutions are going to be tending to drive the train in the stocks. We latch on with the options to get that extra bang for our buck and for your buck.
You're welcome, Bill. Glad we could get that in there. Michael wanted to know, he says, I don't know anything about options. Do you teach us that?
We do. Good question, Michael. We keep it real simple here. So this is the simplest approach, which is just simple options buying. So easy to get yourself set up with an options account on any major platform. Again, like I said, you could trade it with as little as $400, 4 contracts, or to get started. So I do encourage newer traders to start small. So starting with just even 4 contracts to kind of get your toe in the water will allow you to see how this works and see how you're not taking on too much risk on any one trade. Look at your trading as more of you're building the right habits for success. You're building the right habits for learning how to manage winners and also how to manage non-movers, trades that aren't working, trades where you may take a loss on some trades. It's going to happen, right? There's going to be both sides of the equation. We are teaching reality trading, not fantasy trading here. So we want to guide you through every trade. We will remind you, hey, this trade didn't fire, let's get rid of it, and we'll send you a real-time update on that as well. So you know, Michael, how to manage each and every trade. When we send you those alerts, you just then go ahead and go into your platform, whichever one you're using, and say, okay, it's time to get in, it's time to get out. And if you ever have questions, of course, my team's always standing by to help answer any questions you have as you get started in your options trading journey.
I will say that I knew next to nothing about options when I started working with Price, and I learned a lot from him. So there you go.
I'm glad to hear that. Thanks, Jeff.
Yeah, you bet. Let me go ahead and, Price, I want to say thank you for your time here today. We added the links into the chat. Click on them. Go ahead and get set up for that. Price, thank you for being here.
Always a pleasure. Thank you, Jeff.
Very good. I'm going to go ahead and dismiss you, and I'm going to take over from here. Okay, let me go ahead and do this. Go ahead and do this. All right, very cool. You can see we're on the 3rd version of the Big Trend Toolkit 3. I have mentioned it was the very first product I worked on when I went from inside sales over to business development, and I learned a lot actually working on this thing. It's been such a well-received add-on, and there's so many things. The fact that we're kind of on the 3rd version, there's a lot of actual methodologies in here. This I think that's probably 2022. I'm not going to count them, but all of these are different methodologies that are built around kind of those principles that Price talks about, finding the best strategies, ignoring all of the noise and that kind of stuff. Is it at a trend? Is it accelerating into that trend? All of those things. One of the things that I do kind of want to talk about, so there's this 17 different methodologies in there, 18 indicators, all kinds of templates. They have system testing. That's been a question a lot of people have asked. Can I test this? You can absolutely test these. You can run explorations from them. There's expert advisors. They have commentary. One of the things that I like talking about options is how specifically it will go in there and tell you exactly, okay, well, this is a long opportunity. And if you're looking to be conservative, you could just buy the stock, or you could buy this option. If you want to be more aggressive, you could look at buying this option. And it gets really specific in terms of how long the trade will last, what type of a delta you should be looking at, and all that kind of stuff. So if you're newer to options, like I was, it does a really, really good job. I actually use Price's commentary, what he kind of came up as commentary, as examples when I start talking about what good commentary looks like. Because in there, when you get a signal, he's going to tell you why you get the signal. He's going to tell you what you should do with the signal. He's going to tell you how to exit the signal or enter the trade, how to get out of the trade, and why you would want to get out of the trade. Is very, very descriptive. I love the commentary in Metastock and in the Big Trend Toolkit because it really spells everything out for you. So if you're trying to learn, it does a really good job of helping you with that education process. Of course, you can scan. So if you find any of this 18 methodologies particularly helpful, you can. One of the things I really like about 3 that I'm just going to mention real quickly is the scoring methodology. So a lot of times you'll run a scan and you'll come up with 20 different results, for example, right? How do I identify which of those 20 results might be the best? And what we did with Oliver's system was actually put together a score. So it takes a look at his favorite, I don't offhand, maybe 8 to 10 indicators, and ranks them based on bullishness or bearishness from a score of like -100 to +100, which gives you a good way to kind of say, okay, well, these are the ones that are really, really moving. So some really, really cool stuff in here. Very, very inexpensive. It's normally $700 as a one-time cost. A one-time cost of $399 here at the conference will get you a permanent access to this. It's not a subscription. You own it forever. And of course, we're going to give you a 30-day money-back guarantee. And of course, we're going to give you, if you need one, a trial for 30 days. So you can evaluate it totally risk-free. If it's something that's helpful for you, you can keep it. If it's not helpful, if you don't think it's going to really do the add value to what you're already doing, then you can get a refund on it. We just want you to feel real comfortable about your purchase. We have lots of really, really good products, and so we can back them with this money back guarantee. So if you're interested, you can go to metastock.com/conf-promo, pick it up. If you have questions, 800-882-3040, or you can go to metastock.com/saleschat. $399, one-time cost. Again, some of the work that's done by one of the top market timers multiple times over the years. Great expert. Give it a go. Anyway, all right. I do want to say thank you. We're just gonna spend a little bit of time saying thank you to AAII. I want to say thank you for all the work they've done to help support the events, and they're great partners. You should find out more about them at AAII.com. Mr. Lewis, I hope you're ready because I'm ready to give away some books. The books that we're giving away is...
I'm always ready to give stuff away.
I noticed you haven't changed your name. You're showing up as Metastock Webinars.
Oh. Well, at first I thought, why would I change my name? Greg Lewis is a fine name. Okay, is that better now?
There's a joke, but I can't remember it. Yeah, it's changed. All right, you're now Greg Lewis, Mr. Webinars. All right, so we're going to start. Steve Bigelow was a big friend of Metastock, a great partner, and another, like so many people here, somebody that I learned a lot from. Probably one of the most influential people on my trading. And we've got some of his books we're going to give away. We've got Eliminating Emotions, Candlestick Profits by Steve Bigelow. We've got his High Profit Candlestick Patterns. And we've got a mouse pad. And I'm going to send you one that doesn't have coffee spilled on it. So I'll send you a nice clean one like this. So we're going to give that away as a prize. What you need to do if you want to win the prize is you need to make sure that Greg makes you lucky. To be eligible for the prize, if you're watching us on YouTube, you need to register at the top of the chat over here. There's a little bit of a to be eligible for a prize. If you click on that, you can go to our website, register, and that will put you in the prize pool. Okay. What Greg is going to do is he's going to help me determine the winner. And to do that, what I need from you, Greg, is a number between 1 and 8,495.
1,495. All right. According to the Google random number generator, 2,304, 2304.
All right. We have a winner. The winner is David F. in the US with a Comcast account. So if that sounds like you, if your first name's David and your last name starts with an F and you're registered with a Comcast account, you probably just won.
Congratulations, David F. in the
And
United States.
if that is you and you're in the chat, it is obligatory for you to say, hey, thanks for the prize, or hey, I just won, so that we can celebrate.
Or say hooray.
Exactly. Yeah. We love it when people win when they're watching. You don't have to be here to watch, win. It just makes it funner. So there you go. Greg, thank you for the assist.
You're welcome.
All right. Oh, you know who's next? Never mind. Zaheer's next.
Zaheer is next. Zaheer, I'm going to guess.
Zaheer has been a partner for a couple years with Metastock. I really like his presentation style. Having helped do a lot of the coding under the hood, and I have a really deep understanding of the way he looks at markets, the way he kind of looks at kind of the market in general, kind of the strategies that he uses, and he does a really, really good job both in kind of implementing a good strategy, but also talking about it and teaching it. So without further ado, let's go ahead and get Zaheer in here and we'll get him started. Zaheer, how are you doing today?
Hey Jeff, hi guys, how you doing?
Good. I can hear you. You sound good.
Thank you very much.
I just sent the screen over to you.
Okay, one sec.
I should have mentioned that you're from London. I guess I will. Or from England.
Yes. I'd also like to mention that Zaheer and I have quite a bit in common. Every time he does an introduction about himself, I also lived in Japan as an English teacher, and I also was a photographer. And I'm also very handsome.
We got three things in common. That's fantastic.
Yeah.
Well, I mean, Japan's amazing. You know, I'm sure you had an absolutely fantastic time out there.
So. Oh, I was there probably 30 years before you, but yeah, it was great.
Yeah.
All right, Zaheer, I can confirm we can see your screen. We can hear you. Without further ado, I guess I'll let you go. It's your turn.
Fantastic. Yeah, brilliant. Hi guys. I've been jumping in and out of the webinars this week, and as always, Metastock have done an absolutely fantastic job. So I hope you guys have been really enjoying all the knowledge that's been shared. Hopefully I'll be able to add to that with hopefully a slightly different look at the markets. And we're going to be looking at the Market Edge technology, which is the add-on that we have developed for Metastock, and how I then apply that to my 3-step blueprint for ultimately making consistent returns, not just in 2025 and beyond. So you're about to learn a predictable and systematic way to identify the very best stocks and assets, when to enter the market for optimal returns for both a bull and bear market, blocking out all the social media noise. Now, you know, there's always a lot of talk about market crashes and when it's coming, yet the bull market that we're in just continues going up and up and up. The point is, as investors, traders, however you label yourself, you've got to be prepared for both eventualities. So how do we do that? And that's, you know, it's a key skill to have, you know, within your toolkit. And then how to hold, compound, and exit for maximum gains, outperforming all other strategies and money managers, really keeping all of that money under your control for maximum returns. And then how to adapt this process around your lifestyle, because I'm sure everyone on here is busy, jobs, careers, family, married, hobbies, all of that good stuff. You've got a lifestyle going on and you want to ultimately continue enjoying life, but have these really smart processes working away in the background, growing and compounding your money. That literally takes a few minutes each day to manage. So that's what we're going to cover. We're going to learn how to use the MET, the Market Edge technology, and a trend following investment strategy in 2025 to significantly improve your portfolio performance to 30% plus a year every year. Now, just a little bit of a warning. I call this the upgrade ahead warning. What I'm going to teach you guys ultimately some things that you can't unlearn. When I started developing and learning these skills back in in my early part of my journey, sort of 2007, 2008, that's when I discovered trend following. Before that, it was really a sort of mishmash rather of a bit of day trading, a bit of swing trading, a bit of value investing, and it was just all over the place. And I discovered trend following, and I never looked back. You know, I think all walks of life have best practices, and once you start learning these best practices, you have to adopt them and implement them rather than sort of stick to what you are currently doing, which may be old, outdated, even potentially obsolete. So you will have a personal choice to make at the end of this, whether you're going to stick to what you're currently doing or whether you're going to start looking at adopting some of the techniques that you're going to be learning in this. Now, what I'm going to share with you today are the exact techniques, the exact tools, the exact methodology that I have used to get me my Reversy fund, which was incorporated in Luxembourg in 2023. So I have a hedge fund now. This is the simplest, most effective, and most profitable way to invest and compound, to find, invest, and compound stocks and assets, period. So not just stocks, we're talking about commodities and currencies as well. Gold, for example, is in my portfolio. I've been holding and compounding that since March of last year. So this is a system that you can use across the board. And as I said, it's a very same system that I use to manage the funds in our Reversy fund. And we've got an audited track record, guys, that goes back many years, that averages over 30% a year. So this isn't a back-tested strategy. This is a live system that is generating results and has been generating results for the better part of a decade. Just a bit about myself. I have a degree in software engineering. So first thing to note, guys, I haven't worked for a bank or an institution. I don't have a degree in economics or finance. I have a degree in software engineering, and that's really where my love for the technology that we have available to us came from. And when I discovered software like MetaStock specifically and its ability to develop tools, you know, it was just a complete game changer for me. I worked for Oracle for a year. I'm so sure some of you guys know Larry Ellison, one of the richest men in the world, owner of Oracle. I worked there for a year, and I quickly realized that if you're going to work a 9 to 5, it's going to be something you enjoy. So, you know, I didn't last very long. I quit. I then became a TEFL teacher, which is teaching English as a foreign language. I lived in Asia, Taiwan, Japan, Philippines, teaching English. Had a great time. You know, so it's a great job to have in your early 20s, but you know, there's not a lot of money in it. So after a bit of fun out in Asia, I then came back and I got into the world of advertising photography. Photography was always my passion. I learned to develop pictures in the dark room, for example, very old school, and then moved into the digital medium. And it was here in advertising photography where I actually started making good money. Our images went on the side of buses, and I learned the importance of good technology. For example, the camera that we were using was a $65,000 Hasselblad camera. I don't know if you guys are familiar with Hasselblad, but you know, they're the first lenses, the first cameras that were taken to the moon. These are, you know, these are big, the godfather of the camera world, if you like. So, you know, I learned a lot in my careers, which was, you know, always strive to have the best to be able to deliver for your clients. And if you have that mentality, then the money starts coming. And in advertising photography, you know, we really did start making some very, very good money, which then allowed me to put that into my broker account. I started trend following in 2007. What changed it for me was Way of the Turtle by Curtis Faith. If you guys haven't read this book, it's a phenomenal read. Push it to the top of your reading list. Way of the Turtle by Curtis Faith. That's how I discovered trend following in 2007. As I said before that, it was all sort of short-term trading, day trading, swing trading, a bit of value investing, trying to understand what Warren Buffett was doing, but it was just very inconsistent or very cumbersome, very time intensive. Trend following, when I found it, was simple and was actually far more profitable than anything I had done previous to that. I co-founded Sublime Trading in 2018, so I built up a reputation for myself online through my journey. Around 2012, I took to what was Twitter at the time, and then moved through to LinkedIn and Instagram and all those things. 2018, co-founded Sublime Trading, which is our education platform, and then co-found the Reversy fund in 2023. So if you look at my journey, guys, it's probably something very similar to you, which is just a regular guy with a regular background, nothing to do with the financial world, but just had a real healthy interest in trading and investing and the technology that was available to us, and then combining that all together to create what I'm going to be able to share with you today. I'm now in a position, I'm in a very blessed position to be able to share my message across a number of different platforms. As Jeff said, I've been a partner with Metastock now for a couple of years, but I've also been able to write for Benzinga, present at the Money Show, the IFTA, International Federation of Techno Analysts. So I've been able to get my message across to a much wider audience, which is fantastic. So let's start getting into the nitty gritty, guys, the comparative returns. And I really want to show you the importance of why you want to be investing in stocks, and particularly stocks outperforming the index. And I'll explain what that means as we go along. But let's say you have an initial investment pot of 20,000. Sorry, guys, that should say $20,000. But it's the same thing. Whether you've got £20,000 or $20,000, that is your starting amount. Let's say you put $20,000 in a tracker fund that matches the S&P, and then another 20,000 in the stocks that I'm going to be showing you today. Over a 20-year time period, that's your time horizon, and let's say that every month you're adding an additional $100 into the pot. On average, over a 20-year period, a tracker fund will get you 11%. That is potentially being a little bit generous, but let's say you get 11% a year with a tracker fund. And as already mentioned, our audited track record over the better part of a decade is averaging over 30%. So let's say you're getting 30% from these stocks that you invest in, performing better than the average. With a tracker fund, after 20 years, you're looking at around $250,000, which is great. It's a great start. It's the very least you should be doing. It beats the banking system. But if you're pushing your returns to 30% a year, you will then be looking at over $4.5 million. So you can see that the difference is vast over a 20-year period. And this is why investing in stocks outperforming the index, performing better than the average market performance, will significantly get you far more money. Yes, there's an education phase, and there's a need to invest in the right tools to be able to achieve that. But going back to what I was saying earlier about particularly in my photography days, you've got to have the right tools of the trade to be able to deliver the returns. And if you invest in that, a little bit of time in TLC, you will be rewarded with far superior returns than just putting your money in a tracker fund. And so when you then start dealing with these kind of numbers, people then can really start getting back on track with their investing goals. Now, one of the first real goals really is just a sense of confidence that comes with managing your own money, managing your portfolio with real sort of ease and efficiency and confidence. Everyone's trying to achieve it. You see it online. Everyone's got a system and a method, but very, very few people are actually achieving the returns that they want. And we know that from the broker stats that are being produced, that a lot of people underperform. So that's the first goal. It's just that sense of achievement that comes with it that few ever get. Money's all under your control. It's not locked away in schemes and then drip fed to you later on in life. All this money is 100% under your control. And for those of you here in the UK, we're blessed to have certain accounts that are free of capital gains tax. So there's that other benefit and incentive to really managing your own money. Of course, retirement. Many people have one eye on retirement and the pot that they've so far accumulated for retirement, and they're short. So once you start getting these processes in place, it's not just a case of when you retire, it's also a case of how much you will have at retirement. So the vision changes, and of course you can retire far quicker. You may want to then start your own business. Often a lot of people end up on career paths that that isn't really their choice. It's one that's been designed for them. Going back to my days, if I stayed on the path of software engineering and working for Oracle and continuing it, it wasn't really a passion. It was something that at the time, IT was everything that people were talking about. So that's how I got into it. But photography was my real passion. So that can change. You can then start your own businesses. You can then work the hours that you want, the contracts that you want if you're a contractor. You can, of course, be far more generous, set up your own charities. I believe inherently people are good, despite what we may see and read on the internet about this sort of world that is all doom and gloom. But deep down, most people inherently are good and want to do good with money. So if everyone was richer, you could imagine how many more issues and problems would be being solved. So having more money under your control allows you to be far more generous, not just with your money, but also with your time. Then, of course, guys, we want the finer things in life. And why not? If you're working and you're striving and you've got these processes in place, why can't you have the finer things in life? Me personally, I love my bespoke suits, and bespoke suits aren't cheap, but they sure as hell beat an off-the-shelf suit when you start getting them cut to your requirements. So it's a lovely experience. You may of course want to upgrade your premises where you live. And then finally, and this is the most important part, when you learn something like this, you're developing a set of skills, a timeless set of skills that you can then pass on to your kids and loved ones to carry on the good work that you're doing. The schooling system is not going to do it for you. The schooling system is designed to build careers. But when we all build careers, at the end of it, regardless of what career we're in, we all end up with the same problem, which is, what do we do with our money? Financial literacy is poor. So this requires you to take the bull by the horns or the bear by the paws, understand what this is, get it working for you, grow your money, and then teach your kids and your loved ones to do the same, and then carry on your hard work. That's what true generational wealth looks like. So just to give you an idea of how this MET has performed over the last couple of years, we have a service in Sublime Trading called the Asset Position Log, or the APL, which is effectively a copy service. We share our portfolio and people can then copy the portfolio. That is worked out on a $20,000 account, because that's the very minimum that we expect our members to start with. People, of course, have a lot more than that. Some have 100,000, some have 1 million, but the risk element is calculated on $20,000. We started putting our portfolio together in February 2023 when the bull run started kicking back in. That $20,000 is now has a running P&L of almost $26,000. So we have a running P&L of 130%. Divide that over 2 years, and you can see how we're hitting that 30% plus mark that I have talked about. It's about taking a few good stocks, cutting out of the losers, holding and compounding the winners. This is just an example of the sort of sector exposure. Note how diversified it is. It's, our portfolio is 95% US stocks. The remaining 5% is a handful of UK stocks and gold and coffee in terms of commodities. But when it comes to US stocks, that's where the bulk of the opportunities are, because of the age and maturity of the market. But the point to note here, guys, is look how I have diversified my portfolio. If you go online, all you ever hear about is big tech. Nvidia right now with its earnings has been just sort of swamping our media channels. There's a whole world of stocks out there beyond big tech, and a lot of those stocks have actually been performing better than big tech over the last 12 months, 18 months. So you've got to be able to find those stocks and add them into your portfolio, and then diversify as necessary. And we've all done that. Everything that I'm going to show you today, the whole process has been done using the MET and the 3-step blueprint. So just to give you some examples of some of the stocks that I have found and I have invested in over the last couple of years. Costco, guys, it's up 162%. Fiserv, 171%. GoDaddy, 236%. Hilton, up 148%. Nvidia Corporation was up 1,200% between 2022 and 2024. It's now just going through a bit of a sideways market, but it's up 1,200% in the last 2 years. Visa Corporation up over 100%. Walmart up 166%. And we use the MET to ultimately invest in trending stocks that are outperforming the S&P 500. So that's that term again, outperforming the S&P 500. So what does that mean? Well, the S&P 500 is an average. It's an average of 500 stocks. So that means some of those 500 stocks will match the average. Some will underperform against the average, but there'll be a whole bunch of stocks that outperform the average. That means they are moving up quicker and faster than the average. Now, I remember going back, I think it was 2023, there was an infographic that was doing the rounds on LinkedIn. Guys, if you're on LinkedIn, please search for me and add me. I'm very active on LinkedIn. But there was an infographic that was going around that was something like 86% of the S&P 500 is underperforming. So 86% of the S&P 500 is underperforming. Okay, fair enough. But that relieves 14%. So 14% of 500 is still a healthy number of stocks. So all we need is 5 to 10 of those remaining stocks that are outperforming the S&P 500, and have them in the portfolio. So you have to start looking at these infographics with a pinch of salt and going, okay, well, that's interesting, but what aren't they telling us? So we must look for stocks outperforming the average, outperforming the S&P. So going back to just the stocks that I've shared, since 2022, the S&P 500 has climbed 76%. Note how many times the internet is loaded with the word market crash. Yet the S&P has climbed up 76% since 2022. Going back to those stocks, Costco 162%, Fizzev 171%, GoDaddy 236%, Hilton 148%, Nvidia 1200, Visa 103, Walmart 166. All of these stocks have moved up. All of these stocks have moved up faster and quicker than the S&P 500. So they've all delivered superior returns. Our goal as investors is to know how to find these stocks, invest in them, take positions, cut out the ones that don't work, and hold and compound the ones that do work. Now, how do we find these stocks? What is it that's common about all these stocks that I've just shared? Well, one thing that I've learned in my early years when I went through all the learning and the back testing and try to figure this out is that all really good stocks, all trending stocks, all follow the same pattern. They all go through these 4 phases. Phase 1, proven performance. A stock that has performed well in the past is very likely to perform well in the future. Phase 2 is a consolidation base. So we're looking for a sideways market. Typically 3 to 6 months is what I'm looking for. Longer the better. You know the expression, the longer the consolidation, the bigger the breakout. This is what it means. We're looking for a consolidation. Then we're looking for that move out of consolidation. This is phase 3. And then phase 4 is where we take our position and we want to maximize that phase 4. That's the trend we enter in on. And this typically lasts 12 to 18 months, even longer. This is what I call the 4PS method, or the 4-phase sequence method. It ultimately follows the philosophy of buy high, sell higher. We know everything about Warren Buffett and the buy low, sell high methodology, but for me, there's a fundamental flaw with buy low, sell high. Buy low is you're buying a stock that's going in the opposite direction to what you want it to. It's actually going cheaper and cheaper, and it's discounting. And remember the expression, the trend is your friend until the bend at the end. Well, if a stock is dropping, the trend is down. That means it's only likely to continue going down until the trend reverses. And it could take months, even years, before it reverses. Now, someone like Warren Buffett, in the meantime, can collect his dividends payments, which is in the billions. Whereas most retail traders and investors do not have that luxury. They have a set amount of money, they have their goal for retirement, and they need to get going with generating wealth. And the way to do that is to find stocks outperforming the index that are moving up already in the direction that we want it to go. And we then learn to take positions and maximize the new trend. So that's what we're looking for. And that's the phase 4 sequence, the 4PS, what I call the 4PS method. So let's look at all of these stocks that I've just shared. Blue is phase 1, the orange shade is phase 2, the pink circle is phase 3, and then the green arrow is phase 4. So you can see cost, a proven performance history over many, many years. So the fact that it's gone through those 4 phases and then broke out and started setting record highs where the pink is, we know that we're entering a stock. This is another point to note, guys. Phase 3 is at all-time highs. Phase 4 is at all-time highs. Stocks that are setting all-time highs, think about it. We can assume the fundamentals are healthy. We don't need to go in and do X amount of work on PE ratios and really understanding the fundamentals of the company. It's all being done for us by stocks breaking out and setting record highs. Cost is a perfect example. Fizzev, look at its history. If you look at the bottom, that blue arrow, 2011 to 2020, that's 10 years of solid performance history. You can't argue with that. Beautiful 4 phases. GoDaddy, same. Phase 1, phase 2, phase 3, and phase 4. Hilton, phase 1, phase 2, phase 3, phase 4. In fact, Hilton, it has got numerous phase 1, phase 2, phase 3, phase 4s throughout its history. This is just the most recent phase 1, phase 2, phase 3, and phase 4. Nvidia Corporation, again, it's got 3 massive uptrends in its history. And don't forget, guys, it went through a 10-to-1 stock split last year, which has driven the price of the stock right down, making it more accessible. So if and when it breaks out, we could potentially see it go back to $1,000 per share because it's already done that twice in its history. Visa, again, it's a powerhouse of a stock. Visa, MasterCard as well. They both tend to follow each other. Look at their history. That blue arrow really showing you that it's got a good performance history. And look how short, guys, the current green arrow is compared to the blue arrow. So what that's telling us is that this new uptrend, this new phase is very much new, and it could last for an X amount of years. While everyone is calling a market crash, we are simply taking our positions and riding the trends as they continue. And remember, guys, how do you protect yourself from the fear mongering and all this calls about a market crash? Risk and exit management. That's the whole point of risk and exit management. The point of risk and exit management is to say, right, if this is going to fail for whatever reason, I must always have my downside protected. So there's absolutely no reason to fear a market crash if you focus on risk and exit management. In fact, what you're doing is two-pronged. You're first profiting from the upside by riding these trends, but you're also protecting your downside through risk and exit management. That is the hallmark of a good investor, focusing on capital protection and allowing your positions and your processes and the weight of the market to push your positions higher and into profit. Visa is a great example of the potential upside, the further potential upside that it has. Walmart, again, powerhouse of a stock. You know, everyone goes to shop in Walmart. No doubt, we don't have a Walmart here in the UK, not that I'm aware of anyway, but you know, I'm sure Walmart is a very popular store where people go to. But how many people actually consider buying their stock? Not many. Same with Costco. Yet these stocks are just going higher and higher and higher. In fact, they're leading the market as a whole with new all-time highs that they're printing. And a point to note, guys, I'm here in London. Some of these companies I don't even know about until they are picked up by Metastock and the scanners. And then I look at these companies, I think, wow, these companies are decades old. You know, for example, Fiserv, we go back to Fiserv. This isn't a company that I had heard of until 2022, 2023, when it started getting picked up by our scanners. I was like, yeah, this is a stock that absolutely must go into my portfolio. And it's absolutely delivered since. So do not focus on the brand name, focus on the performance of the stock, the 4 phases, and then getting in at the right time, which is at the beginning of the next uptrend. So the question then is, how do we do this? Well, this is where we go into the MET and the 3-step blueprint. So step 1, use the S&P 500 to establish market conditions. I'm going to go through this in a little bit more detail once we switch to Metastock. But the point is this, the S&P 500 is an average, it's a thermometer, it's a barometer of the stock market. If the S&P 500 overall is bullish, that means the stock market is bullish. If it's going sideways, that means the stock market is going through a breather. If and when the S&P 500 starts reversing and we have a real decline like we did in 2000, 2008, then we're in a bear market. So the S&P actually is great. You don't want to invest in it, but it's a great indicator of what the market is doing. So we'll look at that in a little bit more detail. Step 2 is when we then use the explorers to shortlist high probability stocks. So what does this look like? Well, we want the explorers, which is Metastocks, what Metastock called the scanners, to find all the stocks moving from phase 2 to phase 3. So we have programmed the explorers in Metastock to, on a daily basis, based on the closing prices of each stock, to get all the stocks for us that are moving from phase 2 to phase 3. And we get a lovely set of stocks at the end of each day. We then take those stocks and we then do some analysis on those stocks using the bespoke charting tools to maximize profit. So that's step 3. And what we're looking for then is to use those bespoke charting tools to maximize the phase 4 trend, the new uptrend as it is unfolding, because ultimately that's really where the skill lies. We've done the analysis, we've found the stocks, but up until this point, it's just analysis. And everyone on here, it doesn't want to be an analyst. You don't want to just be looking at stocks and going, oh, that's a nice stock. What you want to be doing is looking at that stock and going, yeah, I am going to compound the hell out of that stock, and I know exactly how to do it. And that's the difference between an analyst and an investor. So let's switch to Metastock, guys. So bear with me a second. Hopefully you guys can see my Metastock. Give me a second. Let me just double check. Audience view. Yeah, you can see my Metastock. Okay, so for guys who already have Metastock, you'll be familiar with this. For the new guys on here who will hopefully jump onto MetaStock, which you must. This is what you'll be presented with. MetaStock last year released MetaStock 19, so it's had some lovely upgrades and a revamp. When you first open it, it looks pretty plain Jane. However, the magic happens when you click on this P button in the top left corner, which is the Open Power Console. And you'll then be presented with this window where all the good stuff is done. Now, first and foremost, at the on the left-hand side, there's a whole bunch of features, but I'm going to keep it very, very simple for today. The first set of features is this Explore function here, the third button on the left-hand side. This is where you can then start looking to scan the market. Now, within let me just remove these two for a second. Give me 1 second, guys. Remove that, remove from favorites. Okay, so I've got them already set up in my favorites. Within the MET, you will be given 3 explorers. Two explorers look for shorting opportunities, short setups, and 2 look for long setups. The difference is in the volume. US stocks and other large cap markets, you will use the scanner that has volume over 200K. And for the small to medium cap stock markets like UK stocks and Indian stocks and Australian stocks, you will use the volume of 50K. So you can see that we have 2 scanners here that are designed across the board for whichever market you are looking at. And then we have, as already mentioned, we've got long and short for large cap stocks, and then you've also got long and short for medium cap stocks. Now, at the moment, I am only running long setups, and that is because the stock market as a whole is bullish. Regardless of what your fear is, whatever you're thinking, whatever you're hoping, whatever you're buying into, if you put that all aside and focus purely on the stock market itself, it's bullish overall, and it has been since 2009. So I'm running these 2 scanners on a daily basis. And if we go to the actual markets, if you look here, we've got the NASDAQ, you've got the New York Stock Exchange, and you've got the Amex. If you look at the number of stocks, you're looking at around 10, 11,000 stocks that I scan the US market alone every single day. Throw in Indian stocks, throw in UK stocks, throw in Aussie stocks. We run some scans for our community members. You're looking at around 20,000 stocks that we scan on a daily basis. And all of this is done within minutes at the click of a button, it's phenomenal, guys. It's absolutely phenomenal. We have developed bespoke scanners for the Explore system within MetaStock. Then what I do is, once taking the US stocks, once the scanner has gone through 10, 11,000 stocks, it will then give us a more manageable shortlist, typically somewhere between 100 to 200 stocks on a daily basis, sometimes less, sometimes more. But 100 to 200 stocks is what you can expect on a daily basis. What we then do is we save that list of stocks, and I have a way of doing it. I basically, if you look at these 3 examples here, for example, this is the last scan that I did yesterday for UK stocks. It's the name of the stock, which is the UK market, and then the date, so 26th of February. I ran a scan yesterday for the US market, and you can see that 24 stocks were picked up. So even though it's been a bumpy few days, stocks are still being picked up. That's because there's a lot of stocks that are still pushing up and setting record highs, because there are stocks outperforming the index. So even though the S&P may be going down, the NASDAQ might be going down, a lot of stocks are being pushed up. Remember, they're weighted indices. Indices are weighted, so that means they aren't divided equally across 500 stocks, say on the S&P. The bigger stocks like Nvidia have a much bigger say on the index. So if Nvidia has a bearish day, the S&P and the NASDAQ may have a bearish day as well, but there'll be a whole other set of stocks that are setting record highs. So focusing on just big tech and the S&P and the indices can give you a very inaccurate picture of what the stock market as a whole is doing. So what I then do, guys, is I save these lists, and I've got a list here that I've created for today, and I do some analysis. And I'm going to start with the S&P 500, and I'm going to open the chart. What you will get once you open up the chart that you want to analyze is a bespoke 4-screen setup that we have developed. In the top left is the monthly, in the top right is the weekly, and then we have 2 daily charts, bottom left and bottom right. What we're looking for are the big moves in the market. So to look for the big moves, we must have the higher time frames. When you start moving down to intraday time frames, you come into day trading territory. That's fine if day trading is part of your portfolio, but you just must be open to the limitations and the risk of what comes with short-term trading. What you want are proven long-term processes that hold and compound your money, where you're ultimately doing less work, less screen time, and you're making more money. To do that, you need to have the higher time frames. So we have the monthly, the weekly, and the daily time frame. These are the 3 analysis charts that I use. And then the daily in the bottom right is my strategy time frame. That's where I find my entry points, my stop losses, my trailing stop losses, and I can then transfer those into my broker account. So let's start with the S&P 500. What we're looking for, just like any other stock that we've looked at, is that 4PS method. The S&P has a history of moving up, so that's proven. Since 2009, it's just, it goes up, it goes sideways, it then goes up again, it goes sideways, it goes up. That's the pattern the S&P has created since 2009. What we're looking for right now on the S&P is for it to move above the highest point of last year. So this green line is the highest point of last year. So that's one of the tools that we have developed. An asset that is trading above the highest point of last year is bullish. So the only factor that is keeping us from really sort of going full throttle on the S&P on the stock market right now is the fact that the S&P is trading below the highest point of last year. January and February are synonymous with sideways and corrections because of the first earnings window of the year. But March, April, May, it's when the trends start really kicking in. So as we come past, as we're now coming towards the end of February, which is tomorrow, believe it or not, Monday is March, we can potentially start expecting the trends to start coming in. Of course, it's not guaranteed that it will happen on Monday, but at some point in March, April, May, we are very likely to see the trends start kicking in and moving up towards the summer months. The sign of that is when the S&P moves above the highest point of last year and starts pushing towards that 7,000 round number. So that's what we're waiting for. You can see here up at the bottom, we have a ribbon which tells us when the S&P is bullish. Right now, that ribbon is missing, and that's because it's waiting for the S&P to move above the high of last year. The ribbon will start moving. Now, I'm going to show you some stocks that already have that bullish ribbon because they're outperforming the S&P 500. Now, if you go to the weekly, what we're looking for in the weekly is a set of trend filters and a set of indicators to tell us that the stock market is moving up. Look at our trend filter, guys. If you look at our trend filter, we've got green, gray, and red. Since November, our trend filter has remained green. So even though all you ever hear on the internet is the fact that the market is going to crash, our trend filter since November 2023 has remained green all the way through. It's above the 50 simple moving average. It's above the 200 simple moving average. It's above all these key levels of support and resistance. If I compress the chart, we have all the key levels of support and resistance marked on there for you. The logic behind these support and resistance levels are all explained. The beauty of having this system is that you're not wasting time drawing support and resistance levels yourself. How much time is wasted marking levels, trying to figure out what is a key level of support, what is a key level of resistance, then getting your tool, then marking that level, and then doing that across 20, 30 charts that you're looking at. It's just too much time being wasted doing things that you can spend your time doing better things on. So this is where the system comes in really, really handy. Let the boring and the mundane stuff be handled by the software. All you need to do is make the right decisions and manage your portfolio. So you've got all of those levels, those key levels of support and resistance marked on the weekly. You've got your trend filter, you've got your moving averages. And guys, notice, sorry, let me just go back to the weekly. Notice how it's already telling us that overall the weekly is bullish. So we got that ribbon there telling you when the weekly falls out of alignment, when the indicators fall out of alignment, you can see that the ribbon disappears. So the weekly is telling us that it's bullish. What we're waiting for really is the monthly to catch up and move above the high of last year. The daily in the bottom left is little sister to the weekly, which is big sister. So whatever little sister is doing, or sorry, whatever big sister is doing, which is the weekly time frame, we want little sister to be following. So if you actually have a look at the daily time frame right now, if we looked at on the weekly time frame, the trend filter was green. So if I just go back to the weekly time frame, on the weekly time frame, you can see that the trend filter, let me just reset that. The trend filter is green. So as long as big sister is green, we don't need to worry about the sort of fluctuations in the trend filter that happen on the daily time frame, because there's a lot more candlesticks on the daily time frame. Remember, there's 5 daily candles to 1 weekly candle. So there's going to be more noise. Now imagine if you go down to a 1 hour time frame or a 5-minute time, how much noise you're dealing with. Most of that information on intraday time frame is just purely noise. It's all getting lost in all the candlesticks that are being produced every minute, 5 minutes, hour. We want to get rid of that, and we want to just really stay aligned with the long-term trend. The weekly trend filter is green, but the daily trend filter is currently gray, and that's because it's gone through a bit of a pullback, a bit of a correction. And you can see that the bullish ribbon has disappeared because the trend filter is not green, it's not above the moving averages. It's telling us that this is a pullback or a correction phase, and this is where we want to stay out of the market and stand aside. Remember, guys, the expression standing aside is also a position. People tend to forget that because the goal is to trade every day, make money every day, go for it full throttle, trade. Really and truly, what you want to be doing is trading when the markets are high probability and standing aside and protecting your capital when markets are uncertain or low probability. And that can happen when markets correct, pull back, particularly in January and February. So there is a real system to the way we do things here, and the way you really should start adopting these principles into your own portfolio management. So overall, guys, the S&P is bullish. We know that since 2009. Right now, over the last few days, it's going through a bit of a pullback, bit of a correction with some of the earnings that's come out. For example, Nvidia, for example, Google, for example. Big tech hasn't had the best earnings window, and so it's dragged down the indices. But a lot of the other stocks have been pushing up. So my point is this: the S&P 500 overall is bullish. Right now, it's going sideways. It means that we need to be a little bit cautious. But now that we know that, and we can see how we're analyzing the market, specifically the weekly and the daily, that alignment being above the 200 moving average on the weekly and the daily, the trend filter is green on the weekly, waiting for that trend filter to turn green on the daily, waiting for the monthly to move above the high of last year. We can see the factors that we're looking at for the market to confirm the next uptrend. Okay, now let's start looking at some of the stocks that are outperforming the S&P 500, that are outperforming the index. Let's start with Visa because we looked at Visa earlier. Okay, let's start with the monthly time frame. So the S&P was below the highest point of last year, which was this solid green line. Look at where Visa is, guys. Visa is already 2 months. It's into its second month. This is January. We're now in February. It's into its second month above the highest point of last year. That means it's leading the S&P. The S&P, we're waiting for it to move above the high of last year. Visa is already doing that. We already know, based on the charts that I shared earlier, that Visa has a long history of performance. If I compress the chart, going all the way back to 2010, 2011, solid performance history. Went through a sideways market, phase 2, broke out phase 3. Now it's currently in phase 4. It's a beautiful stock. If you look at the ribbon, it's very much bullish. It's telling us the S&P 500, I'm sorry, the stock of Visa is bullish. Okay, if we go to the weekly time frame, now if we go to the weekly time frame, the trend filter is green. It's above the 50 simple moving average. It's above the 200 simple moving average. It's above all the key levels of support and resistance. The trend filter is green. The ribbon at the bottom says bullish. So we have monthly and weekly alignment. Okay, things are looking very, very good. So what we now need is the daily time frame to match the weekly and the monthly and the weekly. So let's open up the daily, and there you have it, guys. The trend filter is green. Look at today's move. If you look at today's move, it's actually created a new all-time high. Went through a pullback to the 20 simple moving average. We've had a bounce off it, and as of today, Visa is now setting a new record high. Fantastic. I have positions in Visa. However much that's moved up, let's say that's moved up 1%. Let's say I have 4 positions in Visa. all of those positions have all moved up 1% each. So that's 4% of growth on my portfolio. It's above the 20, the 50, the 200 simple moving averages. The ribbon says bullish. We have what we call multi-time frame alignment. When the monthly, the weekly, and the daily are all aligned, that is a high probability stock. And you throw in the fact that it has a performance history and you apply that 4PS method, you have one of the best performing stocks in the stock market right now. Okay, so we've done our analysis, we've done the scanners, we've applied the analysis across the 3 screens. We now want to take a position. Beautiful. This is where the daily in the bottom right comes in. So if I open up Visa in the bottom right, first thing to note, we have blue bars. This is one of the great features of Metastock. What the blue bars tell us is multi-time frame alignment. What it's telling us is that the monthly, the weekly, and the daily, all the indicators that we have programmed into the MET are all aligned, and they are all telling us that Visa is bullish. And when that happens, the daily in the bottom right turns blue, the bars turn blue, which is a fantastic little feature. So you know off the bat that you're looking at a stock that is aligned. So that's the first thing to note. The second thing to note is these little diamonds. See the little green diamonds? These are actual entry points. So each time you get a diamond, it's telling you enter. So let's say you entered on this first position here, all the factors are aligned. This was a stock that you want to consider. You look at that diamond and you go, yep, this is a position I want to take. You can then add this into your portfolio. Once you add it into your portfolio and the stock starts moving in your favor, subsequent diamonds are what we call compounding positions, compounding opportunities. So you can buy more at each of these diamonds. So again, it completely removes the guesswork. When do I buy? Well, wait for the software to tell you when to buy. Now, again, it's all based on an algorithm. It's all based on a logic that we back tested, that we use, and it's all explained. And one of the ways it's explained, guys, is the brilliant expert commentary. So if you go to view, click on expert commentary, within the system, we have programmed the software to be continuously updating you on what is happening bar by bar. And so you have a wonderful window that pops up and it gives you the running commentary of what is happening day by day. So you can see there, the blue bar indicates Visa's daily, weekly, and monthly charts are aligned and bullish for 27 bars since 21st of January, giving you all the information you need. If you scroll down, it gives you where last year's high is. It gives you the breakout signal levels, where the stop loss should be, the risk-free level. All of this information is in the commentary for you, and that will upgrade and change as the bars are produced. Now, with each diamond, you will get its own entry point, you will get its own stop loss, and you will get your own risk-free level. You can't see it too well because it's now just being produced, but this purple level here, that's the risk-free level. This green level, 361, that's your entry point. And then you've got another red dot here, that is your stop loss. So for each entry, each diamond that's produced, you're getting an entry, a stop loss level, and a risk-free level for every single entry point. All you need to do then is take those values and transfer them into your broker account. Again, how the entry is calculated is explained. How the stop loss is calculated is explained. How the risk-free level is calculated is explained. This isn't a black box system. You aren't blindly following signals that are just being pumped out and you have no idea what is happening. You have full logic, full transparency to how this whole system works. We have a wonderfully detailed manual that we have created, and there's some extra support that we give you as you start learning this process, which I'm going to be covering towards the end. Now, the final point to note, if I just compress the chart, is how do you manage the stock once you're in it? And that is where the trailing stop loss comes in. So you can see this red line down here at the bottom. This is our trailing stop loss. Note how far it is away from price action. If you took a position, let's say in November, when that first breakout signal, that first diamond appeared, if you took that position, you would still be in that stock right now. November, December, January, February, 4 months later, 5 months later, that position would still be open because it hasn't got anywhere near that trailing stop loss. I typically hold positions for 12 to 18 months, sometimes even longer. And that's because the way I manage my position in line with this trailing stop loss allows the winners to run. I'm not going to take profit on every little pullback and allow the fear to get into me. I know that a trend is a function of time. To eliminate time means to eliminate the trend, and to eliminate the trend means to eliminate profit. So you have to give stocks and a trend the time to develop and unfold, and you will be handsomely rewarded. Okay, so that's Visa for you guys. I hope that gave you a really clear understanding of what we're looking for and how we're managing it. Let's have a look at another stock. Let's see what else is on my list. We have Wabtec. Okay, so let's have a look at Wabtec. So, good performance history. Currently below the highest point of last year. So this is a stock that is on my watch list. It's a stock that I'm waiting to move out and break up. Great. So I have stocks in my portfolio that are already moving and compounding, but I have another watch list of stocks that are currently in phase 2, the sideways market, and I'm waiting for them to go to phase 3. So it's a little bit of patience here. If you look at the weekly time frame, however, the weekly time frame, what is it telling us? Okay, look, it's just going through a sideways market, and we know from its history that it trends, it goes sideways. It trends, it goes sideways. So all it's doing is repeating that pattern. It's just going through a sideways market. It's now around the 50 simple moving average. We know that it comes to around this level and then bounces. So we're waiting for Wabtec to do exactly that. But the trend filter currently remains green. If I go to the daily time frame, well, we know that the daily time frame, we want to see alignment with the weekly time frame. It's very much out of alignment at the moment. But all it's doing, excuse me, let me just realign this. Give me 1 second. Yeah, there we go. You can see that it trends, it goes sideways. The trend filter goes from green to gray to red. That's clearly a sideways market. Then we have this nice green phase. Now it's going through another sideways market, and it's got the 200 simple moving average as support. It's just doing what it normally does. This is the pattern of a stock, which is why it's really important to study the history of the trends. That will give you far more information than, say, the PE ratio, because if you know how it's behaved in the past, then we can align that to what's happening right now and the potential of what it can do going forward. All we're waiting for, guys, now is a bounce from the 200 simple moving average and a breakout of the all-time high, and we can then start taking positions. So you can see the difference between Visa and Wabtec, but also note how quickly I did my analysis. I've literally looked at that in a few seconds and gone, yeah, it has potential, but not just yet. And that's how I get through a list of 100, 200 stocks very, very quickly. Okay, what comes up next? Amphenol. Okay, Amphenol is a stock that's in my portfolio. This is a stock I had no idea about this company until it came up. But I mean, if you look at Amphenol's history, it is a real powerhouse of a stock. If you compress it, guys, I mean, it's just gone up and up and up and up over decades. And it has a history of up, correction, sideways market, up, sideways market, up. That was Corona. Post-Corona, it just continued going up. So it really just up, up, up. Absorbed coronavirus, created a base, gone again, and now it's creating another base. I have been holding Amphenol since January of last year, so it's been in my portfolio for over a year. Okay, so what are we waiting for? You guys should know straight away now is that we're waiting for the highest point of last year to be broken, which is this green line. When the highest point of last year is broken, that's when we can then start. What I will then start doing is compounding, adding more positions into my portfolio. If Amphenol is not in your portfolio, then this is a stock that you must have on your watch list and wait for the markers that I have discussed, which is a move above the highest point of last year. Currently, there is no bullish ribbon because it's going through that correction phase. It's going through a phase 2. If we go to the weekly time frame, now the weekly time frame, we can see this green, a little bit of gray here, green, a little bit of gray. Is now at the 50 simple moving average. Looking at its history, we know that it likes to come back to the 50 simple moving average and bounce. So that's all we're seeing right now is a move to the 50 simple moving average and bouncing. So because I know that logic, it also allows me to manage my stop losses in a particular way. I can look at that history and say, well, I'm going to keep my stop losses just that little bit wider to allow for any sort of corrections that come to the 50 simple moving average. It gives you that flexibility. What we're waiting for now is a bounce and then a breakout above that all-time high, which is around $80, and a continuation. And that's when I can start adding more positions into my portfolio. Now, based on that logic, the daily time frame, of course, will now be out of alignment. In fact, the trend filter has turned red, but this is where people will generally start panicking because the internet is saying, hey, the world is coming to a crash. But when I look at the chart, I know that there's always a chance that for it to turn red, come to the 200 simple moving average, and then find support and move back up again. So for now, all I'm doing is applying patience. I can see the consolidation phase that it's going in, and I'm managing my positions. If there's any weakness, I can cut out on my positions for a fairly healthy profit. If it moves back up and starts breaking out and setting record highs, I can then start adding more positions into my portfolio. So for now, Amphenol is a stock that is very much on my watch list, and I'm looking to compound and add more positions into my portfolio. Okay. Brinker International. I mean, guys, if you guys are not familiar with this stock, then you got to get to know, because this stock has performed phenomenally well. I mean, first of all, look at it. It's gone from around $30 at the end of 2023 to just short of $200. A stock that's just gone through the roof. So again, apply that logic. I just want to look through a few more stocks, but apply that logic of the 3-screen setup and then going through to the daily to find the right entry point. For now, it's going through a correction phase. You can see the trend filter is green. Here on the daily, it's green and gray. Let me just expand that so you can see that in a little bit more detail.
Hey, Zaheer. I just wanted to make sure you're aware of the time right now.
Yeah, sure. Bobby, yep. Sorry, Jeff. Give me 5 minutes, please. Okay. And here's your final stock. Entergy, ETR, which is Entergy Group. Again, beautiful stock. Follows all the parameters that we mentioned. Bullish on the weekly, bullish on the daily. The bars are blue. A stock that's in our portfolio and performing very well. This actually is a good example of where you can see the entry points. See that green line on the last diamond? Entry points, stop losses, target levels, all produced there for us. Okay, let's quickly switch over just to bring this over to a conclusion. You can now see, guys, how we're achieving these returns, growing that portfolio to 130% over the last 2 years. You can see how these numbers are now coming together. Instead of getting 11% a year, you're getting 30% a year investing in stocks, and how that will really push your funds to a much larger pot of money. How these goals, how you can then get back on track for these goals and these visions that you have for yourself and your family. This is the 3-step system that we've just gone through. Market conditions, use the S&P, use the explorers to find the stocks, and then you've got that the daily in the bottom right, where we have the strategy, where you can find the entry points, the stop losses, all of that good stuff. I'm going to leave this on the screen here so that if you watch the recording, you can see the whole process of what the MET does. This is what you get for explorers, advisors, bespoke indicators, one template, a very detailed manual, and an excellent support structure for myself and Metastock, from us here at Sublime Trading and Metastock. It is 1497 one-time offer. We are also got some wonderful bonuses for you. There's one-to-one onboarding call with myself. You have a private community, which is specifically for MET members, and you have a 3-hour recorded boot camp, as well as free invitation to all future boot camps. So all of that is 1497. You get the bonuses as well for free, guys. We have a one-time offer going for 997 for the whole MET. Jeff, over to you.
All right, thanks, Zaheer. Really appreciate it. Let me go ahead and grab this real quick. And one of the things that you didn't mention, but I think is really important, is we just sat down and recorded that bootcamp training that's available immediately as soon as you get it as well.
Yes, I had that there in the bonuses, the 3-hour recorded bootcamp. So I did get that in there, Jeff.
Cool. All right. Well, let me go ahead and just kind of reiterate the things here. So here, again, thank you very much for being with us. Really appreciate it. Really appreciate all the work you've done in this as well. Can you see my screen?
Yes, we can.
Okay, very cool. All right. So as part of this, Zaheer does a really good job of outlining it. I love his 4 view out layouts. I love the support resistance. I love the way that this is kind of formatted. Very, very nice looking indicator system. Does a really good job of helping outline everything for you. It's going to include all the indicators you need to run it, the expert advisor. It's going to draw those pivots. It's got that layout, so you can kind of have everything laid out the same way Zaheer does. And of course, it's going to have scanning. You're going to be able to run this as an exploration. You're going to be able to see it as well. If you want to try this out and you want to try it with Metastock, we'll give you a free trial like we do with everything. We're going to back it with our money back guarantee. I can tell you, we just released this, I think earlier, or late last year. It's been a very, very popular product. What we're doing right now as far as a conference special is we're going to offer it for $9.97 here at the conference. So it's normally $14.97. $9.97 will give a money back guarantee on it, 30 days. You can give us a call, 800-882-3040. You can go to metastock.com/salespchat, or you can go to metastock.com/conf promo. So with all that being said, get in touch with us. If you have any questions, let us know. Be more than happy to kind of help you with this. And Greg, thank you for putting all of those links in the chat for me. Thank you again, Zaheer. Great to have you here, and I really appreciate all the work that you've done. Let me go ahead and do this. And as we transition into the next speaker, before we do that, I want to say thank you to our sponsor, Stocks and Commodities Magazine. You can find out more about Stocks and Commodities Magazine at traders.com. They've been a supporter of the Online Traders Conference since we started doing it like 15 or 16 or something years ago. We really appreciate what they do. As you know, you're here, you're learning more about the markets, that kind of stuff. I feel like in life, you either get better at what you're doing or you get worse with what you're doing. Stocks and Commodities is a great way to kind of make sure that you're kind of just staying up to date on the current market trends and that you're learning about technical analysis. Great magazine, www.traders.com. We mentioned Metastock, we've talked about scanning, all that kind of good stuff. So I'm going to kind of move, and since we're just a little bit behind on time, I'm going to migrate over to our next presenter, which is Alex Spiroglou, who's also joining us from the United Kingdom, actually. Alex and I just worked together to kind of get his MACD-V indicator ready for Metastock. It's an indicate this. He's got a version of it that's free that'll work in 19. He's going to talk about that today. He's a winner of the prestigious Charles H. Dow Award, and he's going to do a great job. I just know it. Alex, how are you doing today?
Thank you so much for the invitation. It's always a pleasure to be presenting for Metastock. I've had the pleasure of knowing Jeff and the team for a very long time. So let me first of all try, because we're running slightly behind time. Just first of all, let's do the F5 trick. Can you see my screen?
Everything looks great to hear, and you look
Perfect.
great.
All right, so let me try to proceed. Again, of course, thank you to all the very good people of Metastock. Fantastic software. I've been using it for many, many, many years, more than I would like to admit. So today's presentation is called MACD-V. It's about an indicator, the volatility normalized momentum. Basically, we've built a course called MACD-V, the MACD-V Momentum Mastery course, and it's got 3 parts to it. Today, we will be watching the first part called MACD-V, the core concepts of momentum trading. So without further ado, let's do the first part, which is the introductory, but hopefully very interesting. So as usual, the risk warning. There is a high degree of risk involved in trading. Past results are not indicative of future returns. And I refrain to give any kind of advice and also guarantees during my presentations, except one, that you will have losses in trading. That's the only guarantee I can give you. And now with that out of the way, so what is the topic today? It's about momentum, one of the most important factors, return driver factors of trading. So this is what we'll be talking about. Basically, the upper chart is the S&P 500 and then the two indicators at the bottom. All right, so the story is about a paper I wrote in 2022. This is the paper called MACDV, Volatility Normalized Momentum. And I submitted that paper to two professional bodies. The first one was the Chartered Market Technicians Association, which is the largest technical analysis association professional body, organizes an annual competition for research, the best research in the world. And I managed to win this award through this paper for outstanding research in technical analysis. Then I submitted the paper again to the National Association of Active Investment Managers, because they also run a similar type of competition, research competition. That's the Founders Award. So I think, without trying to promote myself, but basically I put these slides here so I can make sure I got your attention and that it will be worth your time. So with that out of the way, this is usually how my presentations end. In order to make sure that you stay awake during the presentations, I have managed to offer you, I'll give you some gifts. First of all, I will offer you the awarded paper. It's about 49 pages. It's a very thorough job. Then I will also offer you for free the indicators for the MACDV and the histogram, MACDV histogram, for the fantastic software called Metastock, and of course the MACDV Momentum Mastery course. As I mentioned, today we're doing part 1. We'll be gradually releasing parts 2 and 3. So all you have to do is stay awake, and secondly, just email me, alex@alexspiroglou.com. That's all you have to do. All right, so let's put some context before the content. So where are we? This is the first part, how I begin my presentations, because I always want to be giving the big picture. So in my approach to trading, I believe that there are multiple time frames. For example, and the multiple time frames I use is the weekly, the monthly, the weekly, and the daily. But there are also multiple factors, multiple return drivers. I don't do just price analysis, simple, run-of-the-mill trend following, but I try to filter this with fundamentals. Hence, my approach is multiple time frame, multiple factor, and I generally think it's advisable for people to be combining technicals and fundamentals rather than be just techies, buy high, sell low, and just add some context to your trading. So, for example, I believe that in the monthly chart, the biggest factor, the biggest return driver is the business cycle. Then I go to the weekly chart and look at my macros, for example, a commitment of traders report, seasonal sentiment, and so forth. And then I go into the daily chart, which is I look at the technicals, because the technicals is just to get me into the market. And of course, then I actually take the position using the 4S framework. And I'll show you in a minute what's the 4S framework. So this is my approach: multiple time frame, multiple factors, MTMF. So the macros, I believe, are there to are the key return drivers. Is the reason why markets go from point A to point B. There is always a fundamental reason that markets are bullish or bearish. So macros offer the why. Then I look at the technical, the markets, if you will, and which answer the question, the when. One is the why and then is the when. And then I put this into the information I get from macros and markets, technicals, into a model, the 4S framework, which is the how. So first I try to see why a market should move, because if you got that pinned down, then you have a better chance of having a lasting move rather than just randomly buying highs and lows, which will result in most of the cases in whipshaws. And so what are the macros I follow? First, I'll look at the business cycle, the intermarket cycle. Then I look at commitment of traders report, what are the big funds buying and selling, what is basically their open interest, sentiment, and seasonal. So these are the core 4 macro factors I follow. So what are the core 4 technical factors I follow? First of all is the trend. I've got an 8-stage trend structure roadmap, very quantified, everything I do is very rules-based. Then I look at relative ranker, basically rank the markets within this the roadmap. Then I look at momentum, MACD, and then the volatility. So trend momentum, volatility, and relative strength are the core four of price action. And then I'll put this into a model, the 4S framework: setup, setup, signal, stops, and size. So this is my roadmap. This is how I construct strategies on a step-by-step fashion. So today's presentation is about this momentum, and it's very important to have an idea or a context before the content to show you how, first of all, how fundamentals should be combined with technicals, and more important, that there shouldn't be any factor be presented as the be-all and all of technical analysis. So the momentum and MACD is extremely important, but it's one piece of the puzzle. So the presentation outline, whenever I do these educational presentations, I follow a presentation system called the TIRE. TIRE means is an acronym for, first of all, I flesh out a theoretical framework. What's the background of what we will be talking about. Then I go to flesh it out with some indicators. Then I take these indicators and make them into a rules-based model, and then go to examples, exercises, and basically that's go from theory to practice. I have we're building a small community when we're actually putting this into practice. All of the courses I do are for free. I don't charge for this kind of information because I don't believe in charging information. I believe in charging for implementation. So today's topic, as I mentioned, the MACD momentum model. First part is why this matters to you. Why is this important? First of all, we'll talk about the two basic frustrations and how we will be solving them. The first frustration that traders have when they try to deal with momentum is this, what I call indicatoritis. Plotting 500 indicators on a chart and then having it look a mess like this. The second frustration that traders have is not knowing what are the three big reasons for losing trades. So the first one is your setup. As I mentioned, we'll be looking at this from the 4S framework: setup, signal, size, and stop. So the first are being directionally wrong, and being directionally wrong means that A, you haven't pinned down the factors that drive a trend, and B, you haven't locked down that trend itself. So being directionally wrong. In this example, you can see that the market is in an uptrend, in a strong uptrend, but you can see these short signals, and that means the gentleman that was trying to short this market was defying the trend and also the macros. So being directionally wrong. So the second reason is wrong timing, which means you are directionally correct, but you're getting at the wrong time. So for example, in this first signal, you were too late. You were trying to buy the market, but you were too late. In the second signal, again, you were trying to buy the market, which was the right thing to do, but you were too early. And the third one, too late. So the timing was wrong. So the signal with the timing was wrong. And the third one was, of course, the exit. So the timing, the entry was right, it was directionally correct, but the timing was wrong. So all of these issues can be solved with momentum. Timing is everything, eh? And that's why, jokingly, as Ralph Campora said to me one day, always listen to your mom. Momentum, MACD. This we'll be talking about. And this is the gentleman, the founder of the Market Technicians Association, Ralph Campora. All right, so what is momentum? Sorry, brief explanation of what momentum is. Basically, this is the map of England where I live. Suppose you were in London, okay? So if you were to go north, that's the trend. Direction, that would be an uptrend. Or if you wanted to move south, for example, near Portsmouth or Southampton, that's where I live. Basically, that would be south. So that would be a bullish trend and a bearish trend. So that would be the equivalent, this analogy, of the bullish and bearish trend. Momentum is your speed. So you may be moving in one direction, but the speed, sorry, the speed is what dictates your momentum. So you could be driving with 60 miles, 40 miles, 80 miles. So this is what momentum is about, speed. So if you know the adage, I'm sure you do, the trend is your friend. Well, momentum tells you how close of a friend the market is, because you may be doing trend following, but if a market is chopping around, then you don't have much luck. Or if the market is too strong, you have to be using different entry and different exit techniques than if the market is has a different level of momentum, a different level of speed. So purely trend following doesn't work as well. I mean, unless you actually pair it with momentum. So let's go, now that we know roughly what momentum is and why it is important to us, what problems we'll be trying to solve. Let's look into the issues themselves. First of all, as I mentioned, we'll be doing the first frustration, which is indicatoritis. So let's look at the momentum indicator taxonomy. Try to understand how momentum indicators are classified. Again, this is the problem I've seen with a lot of newbie traders. Plot 500 indicators on the chart. Now, if you open up our wonderful software, Metastock, and you try to place on your chart indicators, momentum indicators, you find that there is a huge number there. So which one do you pick and why? So by and large, momentum indicators can be categorized into broad families, if you will. The first is range bound and normalized, like the RSI, the CCI, the stochastic, percent B and percent R, or unbound and non-normalized, like the MACD, rate of change, and so on and so forth. All types of indicators can be grouped in these two broad categories, and by and large, they sing the same song. So try next time you plot an indicator on your chart, to see it from this point of view. So the question is, of course, which family of indicators do you choose one from? Well, I have used both types, indicators from both categories, but I'm not entirely pleased with either category. I'm not saying that there's anything completely wrong, but in just some cases, one type of indicator works in one particular environment, and in another particular environment, another type of indicator works best. So that's why I wasn't entirely pleased, because I found myself switching from one to the next category depending on the market condition. So let me show you exactly what I mean. So let's bring an evaluation scorecard, and with this, what we will do is we will use criteria to objectively measure or rank or understand the indicators in each family. So we'll be seeing the trend influence, and also seeing what's the influence of trend of each type of indicator, and also seeing it at the scaling it has. So let's begin first of all with range bound indicators. I'll pick an example, stochastic indicator, but you can replace it with any other type of normalized range bound indicator. I won't go into the construction of it. I think the formula is pretty well known. So the advantage it has a normalized scaling, which you can see at the bottom right chart. It goes from 0 to 100. You can plot the same thing with the RSI, the CCI, and so on and so forth. So it goes from 0 to 100. The advantage of it is, I mean, you can go back in time, so it's stable across time. These are all the readings you can get: 0 to 100, 75, 80, 33%, and so on and so forth. So it is it's a very consistency to the scaling. So it's normalized across time, but it's also normalized across securities, because the stochastic indicator, or the RSI, that's 80 rating on S&P 500, and then you've got a 60 on another market like the moon. Then what's the picture there? It's comparable. So the indicator values are comparable across time, which is an advantage. They're comparable across securities. And also you can do momentum life cycle signal filtering. Basically, you can say if, for example, momentum is low and you want to be defining that as an indicator who has a threshold below 20, or you can see overbought. I'm just using the textbook definitions. I'm not saying I agree with them, but let's say if it's above 80, it's oversold, and then you can use that as a way to define high and low momentum, and you can use that across markets and across time frames. So range-bound indicators have that distinct advantage. But let's see what is their disadvantage. Their values do not adapt to trend. So let's look at this example again. The S&P 500. It was rallying from November till April. It had a huge rally, about 20%. But the indicator did not adapt to this 20% rally by also increasing by, say, an equivalent amount of, say, 20%. The reason is because it is range bound. It has a max value of 100. So the market was rising, the max value could have is 100. So the market was rising, the max value could have 100. So its absolute value, although it is comparable across time and securities, the absolute value itself doesn't have much, doesn't convey the information of a market that keeps rising and rising, as we see in these two particular rallies, because it's getting pegged at high levels. Now, the other problem that range bound indicators is they get prolonged extreme readings. So for example, in this particular case, you can see again two huge rallies by the S&P 500, and the indicator was getting pegged at high levels, and it's giving you a so-called overbought reading. So by the time it was November all the way up until April, the indicator was telling you this is overbought, 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 while it should have been telling you this is strong, this is strong, this is strong. And the indicator could not adapt to the market because it is, again, range bound. So that's a big problem they have. So in trending environments, range bound indicators are very, very bad idea. So let's evaluate them. Again, the influence, the indicator values do not adapt to trend. They have extreme readings, they're very prolonged. And as such, the divergent signals you get on normalized and range-bound indicators are not as accurate for the reason we mentioned previously, because they cannot adapt to the trend. I mean, the market can be rising, the other one gets pegged at high levels, and you can say, oh, it's a divergence. But no, it can't. The indicator cannot adapt to that. So these are the pros and cons of range-bound indicators. So let's check out unbound indicators. Are there any better? So the first one we'll be looking at is the MACD. The MACD indicator. So let's see how that behaves. A brief introduction. As we all know, it was created by Gerald Appel, presented in his book Technical Analysis Power Tools for Active Investors, created in the 1970s, and it was awarded by the CMT Association 2009 with its annual award for contribution to technical analysis. The formula, again, we see the same chart, the S&P 500 with the MACD on the bottom. We saw previously with the stochastics. Now we have got the MACD. So the formula is very simple. I will briefly go. I mean, there are a lot of videos on YouTube, so we won't go into. I mean, we will go into more in depth on the second webinar we'll be doing together. So the formula is very simple: short EMA minus long EMA. By default, that's 12 and 26. And then we've got a signal line, which is basically a moving average of the MACD. That's by default, that's 9. Sometimes I get asked, can we change the settings? Absolutely, yes. And then you have the histogram, which was created by a gentleman called Gerald Asprey, which is the difference between the MACD line and the signal line. So let's examine the MACD and the histogram. Is it any better? So do the values adapt to trend? Basically, let's see straight, where the range-bound indicators failed. How do these types of indicators do? As we can see here in this particular case, when we had the crash of COVID, the market was falling and the indicator was falling with it. So it was adapting to the trend. So as long as the market was falling, the indicator was falling with it. So it was very good in adapting with the trend. And the reason, because it's boundless. I mean, it doesn't have a scaling of 0 to 100. As long as the market falls, as long as the market rises, the indicator will be falling. So that's good. So in a trending environment, this type of indicators shine. You also, because of that, you don't have prolonged extreme readings. So let's check out exactly the same type of situation that we saw before. This the rallies in the S&P 500, and you can see the indicator, the stochastic, was getting pegged at high levels. Someone could have said, you know, it's a divergence, but the MACD was rising and with the market. While the as you can see, the stochastic was flatlining, the MACD was actually increasing. So getting higher and higher and higher and higher values. The MACD was getting pegged at high levels. So in this trading environment, these indicators are much, much better. And of course, you have much more accurate divergent signals. So someone using a range band indicator would see that the stochastic is flatlining. So they say, oh, we have a divergence because it's not confirming, it's not making new momentum highs, but actually it was. Because if you check the MACD at the bottom, it was making new momentum highs. So there was no divergence there. And this is the points in time I'm actually referring to. So the trend influence seems to be something that unbound indicators are much better to deal with. The indicator values are adapting to trend. Extreme readings, they have no problem. They adapt to it as the market goes, in a rally or has a decline. The indicator can adapt, and the divergent signals are much better. So, looking just on that factor, it seems that it's better to use unbound indicators. But let's try to see compare them against the advantage of normalized indicators. So this is the MACD, and if you notice at the right hand of your chart, this is the readings. Now, the problem that the MACD indicator has is that its readings are not normalized, is what we call an absolute price indicator. That means its absolute value depends on the underlying, on the value of the underlying instrument. So if you're having a high priced item, you will have a high reading. That means it doesn't mean that momentum is high. It's just that it's been calculated on a market that is a high price. So you can see the price scale on the right hand of the chart is an absolute. It goes 0 points, 50 points, 100 points, but this is points, not percentage. You see it goes minus 150, minus 200. So this is points, so it's not normalized. So if you want to have a better perspective of this, because of it's not being normalized, it's not stable across time. You can see how it is oscillating on the right hand of the chart a lot more than it was oscillating in the left hand of the chart. And the reason it does this, because as the market, for example, bottomed out in 2008, it was increasing. Its absolute value was increasing, so the absolute value of the indicator, being an absolute value indicator, was increasing as well. Its oscillation, so it didn't mean that they had more momentum. It's just a function of the price of the underlying instrument. So it was not comparable across time. So I did a study of this. I mean, among other things in the paper, which I will be again very happy for you to share if you send me an email. From 1957 to 1971, the MACD had the maximum value 156 and a minimum of minus 3.3. From 2019 to 2021, and the study stops at 2021 because that's I submit the paper 2022. The maximum was 86 and the minimum was minus 225. Now, compare the maximum values. This doesn't mean that the MACD had 40 times more momentum. Again, as I mentioned previously, it was just a function of the period, the 2019-2021 period. The indicator had the market had a much higher value than in 1957. So it's not comparable across time. It's not stable across time. Basically, you cannot use it to say if it's high or low. So, and for that reason, it's not also stable across securities. So the momentum for a high-priced item like the S&P 500 will be for example, this particular example, it's 30. And for a lower priced item, it will be 5 or 4, as we see in this particular example. So you can't say MACD is 5 and the other MACD is 30. So one market has 6 times momentum the other. It just depends on the value of the underlying market. That's it. So it's not normalized. So it's not stable across securities. Basically, the readings are completely worthless, both for the same market and for across markets. And with that brings you to the third problem, which you can create a life cycle model. Basically, say when momentum is high, when momentum is low, when it is slowing down. So you can do signal filtering. As I mentioned before, following the trend is very useful, but you also have to measure its momentum. And you have to have an indicator that says if momentum is strong or if momentum is weak, because you'll be using different techniques, but in other entry techniques, that is. But in order to count, to measure if it's fast or slow, you can't do it through the MACD. So that's the third problem the MACD has. It's not doable. You cannot create this scale, if you will. Now, it also has 2 more problems. So this is exactly what I'm talking about. You can see how it oscillates for different periods. Now there are 2 more problems that the MACD has, and don't get me wrong, it's a very useful indicator. I'm just seeing its limitations, aware of it, so we can perhaps improve them. These limitations have to do with the signal line, which the solutions I have not presented in the paper. I've created a more advanced version how to do with the signal line. So first of all, the signal line, the problem is it gives a lot of false signals. A lot of people use the signal line as for what it's called a signal, but I think it's a big misnomer. It shouldn't be used as signal line, as for signals, for entries, that is. And the good thing about, of course, the MACD, it's a trend following indicator. The bad thing is, like all trend following techniques, it has a very low win rate. You get a lot of whipsaws. So it will get a lot of signals. The good thing is when a trend starts, it will get you in, but it will give you a lot of false starts. So signal line accuracy. And the 5th limitation of the MACD, again, because it uses moving average for its calculation of the signal line, when, as I mentioned, when the trend starts, it will let you know for sure. But in high momentum environments, high volatility environments, because of the moving average tend to take some time to catch up. It will take a long time, so you might miss a good part of the move. And that's another reason. So again, these are 2 limitations of the signal line, which I have also improved, but they're not part of the paper in today's presentations. We'll be doing them in the 3rd webinar, actually. So this is the evaluation scorecard. So when it comes to trend, unbound indicators and non-normalized are much, much better. So when you have, but if you want to be comparing markets or comparing the same market across time, you have to use a range bound indicator. So you're basically caught between 2 different agendas, if you will, depending on what you want to create. So is there any way to, for example, normalize the MACD? Well, one indicator that tries to normalize the MACD is called PPO, percent price oscillator. Basically, it's a MACD percentage. So the literature says that the MACD percentage is the following. So basically, we take the formula, the 12 minus the 26 period, EMA. We just divide by the 26 period moving average to put it in context. The spread between the 2 moving averages, we divide by the second moving average. You can also divide it by the price itself, the close, and then multiply it by 100. So basically, you're trying to put the spread between the 12 and 26 as a percentage of the underlying price. So put it in as an have it as an and multiply it by 100, have it as a percentage. So this sounds as an extremely logical solution. It's in the bibliography, and it makes sense because at the end of the day, it's a percentage, and percentages, as we all know, are comparable. One market rose 5%, the other one rose 10%, or even in everyday life. So in theory, this should be solving the problem, right? Let's actually see it. So the first limitation. Again, this is a chart taken from the paper. I'm just showing you at a very high level the information in the paper. So again, feel free to email me. There's no pitch today. I'm not be selling anything. Again, S&P 500, and at the bottom you see the PPO, MACD percentage. You will find this PPO referred to in the literature, but I prefer to call it MACD percentage. And you can see it's rather stable across time. So it has been stable across time. Now, there are some spikes of momentum to the downside and to the upside, but this is actually an advantage, and it's a function that the indicator is unbound. So if it is unbound, it means that it can, as I mentioned in the first part, earlier on, it can fall as long with the market. So you can see the 1987 crash. You can see how low the momentum indicator was falling, the MACD percentage. But by and large, it is within confines of two ranges. Now, again, I put some elementary stats around it, trying to find what 95% of the range values of the indicator were. Again, it's mentioned in the paper. So the upper bound was at 2% and the lower bound was at -2%, just trying to find where 95% of the values are. And I thought, okay, the rest is the overbought and oversold. So above 2%, overbought, below -2% is oversold. And lo and behold, you can see that, yeah, it's true. So yeah, there is stability across time. So normalizing by price does solve the problem. So the PPO is good. It solves our problem. So for now, it seems that we have a very good indicator, much better than the previous ones. Yeah, so as I mentioned, the PPO MACD percent is stable across time. So I would prefer to use that than the classic MACD or the RSI or the stochastic. So let's, at least so far, let's look at the second limitation. The second limitation, can we compare it across securities? This is a chart of the Bund, German fixed income market, and we can see it's stable across time, the PPO, MACD percentage. And that's very impressive, because normalizing by price seems to be solving the problem. And this is a completely different market, natural gas. Again, at the bottom panel, we see that the PPO seems to be normalizing, normalized across time. But if we look a bit deeper, again, do the same exercise, try to find where 95% of the values are, between which ranges, we will find that the PPO for the Bund is overbought and oversold as 0.7 and -0.7. So almost 95% of the last majority of values are 0.7 and -0.7. And that's different than we had on the S&P 500. Because if you remember, that was 2 and -2. So let's see natural gas. Now that's 7 and -7%. So 0.7 is oversold for the Bund, and -7% is for the 10 times over for natural gas. So let's put the things in the table. As you can see, yes, it does normalize across time, but normalizing by price, it makes it stable across time, but not across securities. So this means that for each security you have to be having different overbought and oversold levels. If you're interested in just one market, feel free to use the PPO. You might do a bit of research to find its individual overbought and oversold levels. But if you want to be trading more than one market, good luck. So the second limitation does not get solved. So it's not stable across securities. And if it's not stable across securities, that means that limitation 3 is still valid, which means we cannot create a universal, if you will, momentum life cycle model where objectively, in a rules-based fashion, say this is overbought, this is oversold across all securities. So it's not normalized. So it is an improvement, but not a solution. So I was this is what I was facing up until 2014, when I started trying to get a bit frustrated, and I said, look, I want to create tool. I want to have one tool. I can't be using this for this occasion, that one to do back testing, that to use in trends. So my goal in 2014 was to create an indicator with the best of two worlds. So on one hand, it would be unbound, so it wouldn't get adversely influenced by trend, but also normalized, like the range band indicators, so we can have an objective reading. So you can test it, you create rules around it, and open up new doors. So that was my goal. There was no indicator that existed at that time, so I said, okay, let's try if we can create something. So around 2014, I said, as I mentioned, range bound and normalized. I want to keep the normalized from that category and the unbound from that category. Try to create a hybrid indicator, if you will. So around 2015, I had my eureka moment. And I figured it out. And I figured it out because I said, why doesn't the normalizing by percentage, by price, and putting it percentage, normalize across securities? Because you're comparing something that is seemingly the same, it's percentage. So 5%, 3%, 10%, it should be the same, but it's not. And that's when I figured it out. And around 2015, I wrote a huge amount of work on it. But around 2022, I decided to publish it and share it with because I found it extremely useful. It opened up doors for pattern recognition that were not available before. And I decided to share it with the community in the form of this paper, and also submit it and see if what others think of my work. And this is how I did it. Very simple formula, but the aftermath is huge. So if we mention that normalizing by price doesn't work, and that was strange, but why wasn't it happening? Why does the Bund fixed income market have completely different than natural gas? Well, one is more volatile than the other. So perhaps we can normalize by volatility. So this is exactly what I did. I normalized by volatility, by the average true range. And let's see what happened. Again, let's try to see the first case if it's normalized across time. Again, this is the S&P 500. Is it normalized across time? You can see, it's rather stable. Try to find again where 95% of the values are between 150 and minus 150. So above 150, so basically the one momentum is 1.5 times its volatility. It's 4.4% of the times below 150. Again, it is also the oversold level. You can see the difference between the two because there's an inherent upward bias for the S&P 500. But by and large, these two levels are the overbought and oversold levels. So I said, okay, interesting. It normalizes across time. It's stable across time. And this is how it would look like. Again, the top chart is the MACD. The bottom chart is the MACD. You can see how more smoothly it oscillates across time, while the MACD gets almost vanished on the left side of the chart relative to the right one. And you can see that's why MACD is so much better. MACD is so much better than MACD. So let's try to see the normalized across securities. Again, same thing. Try the same exercise to find the range of values for the Bund. And lo and behold, it was exactly the same. Above 150, it is overbought. Below 150, minus 150, it's oversold. That's funny. It had the same overbought and oversold levels as S&P 500. Let's try natural gas. Again, normalized across time. Let's try to see the numbers. Again, same thing here. Above 150, overbought. Below 150, oversold. Again, these are the numbers. So it is normalized across time and normalized across securities. And these are the more in-depth statistics between the various ranges for the S&P 500, for the Bund. I won't go very deeply into this. I'll refer you to the paper. But through, again, statistical analysis, you can see that the numbers are very, very equivalent. So MACD is stable across securities. We solved our problem. So basically we've created an indicator where it is normalized and unbound, stable across time and across securities. Does the same thing go with the histogram? Let's see the histogram. Again, as we know, the formula is the signal line minus the moving average minus the MACD. Again, this is the histogram. Again, take a look at this. This is the S&P 500, the middle panel. The bottom one is the histogram. The top one is the histogram normalized by volatility. The top one is the classic one. And you can see the huge difference. So it was normalized. Again, I've got some statistics there for you, for those that may be interested. On the ranges, above 40 is the overbought, below minus 40 is the oversold, and you can see how similar the levels are for three completely different markets, three completely different asset classes. Above 40, it's the overbought level for the S&P, natural gas, and bond. Below minus 40 for these three. So it has been normalized across time and across securities. Now that we've constructed the indicator, let's go to the tire system on the next part of the presentation, the R, which is rules-based model. So we created the indicator. Let's create a rules-based framework on how we can use it. This is what I call the MACD ranges. So what are the MACD ranges? Again, through analysis, as we mentioned, we found that the overbought is 150, the oversold is minus 150, but we can also create more interesting levels in between, not just overbought and oversold, but also when it's weak and strong, when the momentum is really strong. So we've got that is the 50 level. So you've got 0, 50, 150 to the downside, minus 50 and minus 150. So which means we've got the black line, which is the MACD, the signal line, which is the dashed blue line, and the levels. So let's see the interaction of these, because we create 7 different ranges. And the last one, I think it's my favorite one. So let's try to quantify this. Again, rules-based, all of this is in your Metastock platform. We created these indicators, open code, and as I mentioned, we'll be doing more seminars on this and launching a community to show you how we can use this. So the 50 and the minus 50 levels. So let's try to see the MACD, the ranges. The range rules. So these were the ranges in the range rules. First of all, the risk range. Let's put the rules. The MACD is below the signal line, and MACD is below 150. That is the risk range. 7 ranges, all begin with the letter R. So basically what we will call, this what they call the oversold level. MACD is below the signal line and below 150. That's the risk range. What is the rebounding range? So if you want to find the market that is coming off of a low, how do you actually define it? Because as I mentioned, following the trend is one thing, but unless you quantify momentum, you're really, throwing darts, as in not adjusting your entry techniques to that particular market or that particular state of the market. So rebounding. So when a market is fallen a lot, oversold, and then it's coming off of a low, rebounding, from risk to rebounding, the formula for that is MACD above the signal line, and the MACD is above minus 50 but below 50. So again, you use the scanners, open code. I would encourage you to download all the work we have done, the good people at Metastock have done to program these ideas. So the MACD is above the signal line and between minus 150 and 50. That's a rallying market. So if you're going to go load up your stocks or other futures or other ETFs or other asset classes, and you find the market that is coming off of a low because you want to wrap a strategy around it, this is how you define it. So the next stage is the rallying stage. So the market has bottomed, rebounded, and now it is even more strongly rallying. So how do we find that? Sorry, how do we find that? It's very easy. The MACD, again, above the signal line, it's above 50, but below minus 150. So this is the rallying range. This is the risk range to the upside. It's the same thing as to the equivalent of the downside. As you can see here, it's the market before the COVID crash went into the risk range above 115, above the signal line. Retracing. So if you want to see a market that has in pullbacks, MACD below the signal line, less than 150, but over minus 50. So if you want to find a market that's having a pullback, very, very easy. So if you want a market that is reversing or has a round down basically the opposite of having a rally, again, MACD below the signal line and below minus 50. So a market that is falling very strongly. As you can see, you have done very advanced pattern recognition of core concepts. And this is the last range, which I'm very proud of. How do you find a market that is ranging? And it's very important to find a market that is ranging because markets don't trend most of the time. So if the market is between minus 50 and 50 for 20 consecutive bars, and this is how it does look like. So we can find a market that is ranging. It's in a trading range. Very quickly, what are the MACD histogram rules? Again, above 40 is the risk range, below minus 40 is the risk range to the downside, overbought and oversold. Again, the numbers, this is how it looks like, the histogram. The range rules, I'll be going a bit quickly because I don't want to be going late. And as you can see, the MACD histogram, it manages to locate overbought and oversold levels, short-term overbought and short-term oversold levels, below minus 40 and above minus 40. Now, if you study this long enough, you'll find exceptions and special rules to this. Again, this will be part of the third webinar because I've been toying it with the MACD for about 10 years now and studying it very, very intensely. So there are exceptions to these rules, but by and large, they work very well. So this had a ripple effect, this invention, if you will, this innovation, but because it allowed me to volatility normalize a lot of other indicators. And one was the LBR, the 310 oscillator by my good friend Linda Raskin, the market wizard, which uses the 310 oscillator. And that was also normalized, as you can see at the bottom part of the chart. This is the 310 oscillator used by Linda Raskin, the market wizard, and that was also normalized. I've also done improvements of the works of Alex Elder, Chuck Dukas, and all of this is mentioned in the paper. Again, these are some relevant statistics for the 310 oscillator, for the overbought and oversold levels for that particular indicator. So now that we've done the results, let's look at the MACD in Metastock. Let's look at some examples and exercise. The MACD Metastock. How can you get it? Very simple. You go to there are two ways. Either you go to the website, you can click on support, then go to download updates, then try the Metastock update and patch files, and you can go to download MACD volatility normalized momentum. Or you can directly go to this part by typing tiny URL. It's a URL shortening service, MACD Metastock. So you can do this and you can download the MACD. It's free for everyone. As I mentioned, I'm just scratched the surface here. Guys and girls have just started. There are a lot of patterns we can do. I've given you the 7 core ones. So what does the indicator have? Again, it's free. First of all, you get the manual for the indicator, how to install it, how to run the feature we'll be showing now. You also have the indicators. One is the histogram, and one is the MACD, the MACD histogram. You can get both indicators, and you can also now at the bottom you can see the ribbon, a trend ribbon. It's very simple, basically based on the 200-day moving average. Now this is the histogram you see right at the bottom. You can also have the template. You can use a template for you to how you can have this displayed as I do, the histogram on top on a different panel, because I see a lot of people mixing this in the same, and I really get frustrated with that. And also at the bottom is the MACD with the ranges, so you can have that. You can also have commentary, some basic commentary which can help you whether what is the range of the momentum, it's ranging or increasing. You can also have highlights with highlight bars based on the range rules. You can also have explorations. You can find the 7 core ranges, or if market is an uptrend or a downtrend. Again, all of this is free. There's no pitch. You can have it all for free. So where to from here? We managed to, because I don't want to be taking any more time. It's already 6 o'clock local time. So information and implementation. You've had the information. Will you get stuck just at the information plane, or will you go to implementation? Download the indicator, start working with it, do the 7 core ranges. We'll organize with the good people at Metastock a new upcoming webinar. Start implementing, go from theory to practice. And as I mentioned, we have got the free bonuses for those that would like to follow up on this. Whoops. And we're preparing the course. We just seen the core concepts of momentum trading. This is my email. Feel free and I'll send you all the bonuses. And if there are any questions, I'll be more than happy to take them.
How do I find my mute button? That's
Your
the first
unmute or mute button.
yeah. The second question, Mohammed wanted to know what the name of the paper that you published was.
MACD volatility normalized momentum. Send me an email. Mohammed can send me an email. I'll send him the paper.
Okay, and I'm actually typing that in the chat.
Yep.
I'm paying extra attention to make sure I spell your name correctly.
Absolutely.
Alex knows I have a very bad habit of not spelling his name right.
Yeah, no problem. What we have done here is just the core concepts, very introductory. There's a momentum in the MACD. In specific, it's a very, very deep well to drink from. As I mentioned, we started working this in 2015 when I figured it out, published this in 2022, but I've done over the years, 10 years now, we're working with it, a lot of patterns which I'm looking to program with the good help of the wonderful people at Metastock. So have the free version. It's extremely useful, just even if you use just the 7 core ranges. And but we will be taking it to the next level. I promise you, we'll be taking a lot of
we're working on it. I was, just to not undersell the free thing, we've got a scan in there. We've got an expert advisor. You did a really good job with kind of helping direct that out. I put the link to download the free version in chat, so you can click on that. The only thing is it does require the latest version of Metastock to run, because that's where I built it.
And actually, what I will be, because now we have a one-time first of all, thank you very much to the people for Metastock for inviting me, but I have a 1 hour limitation. If I can take this a bit more slowly and explain the ranges a bit more, probably I could stretch this to 1.5 hours for the part 1, but for the part 2, I will make a deep dive. So a lot more techniques. Again, it's free, based on the free version of the MACD. More value and how to, and I'm hoping to have you replace your indicators from the momentum indicators. First of all, convince you to look at momentum as a factor, a long trend, and also to be switching to the MACD, because it is truly an innovation technical analysis.
Just one other question before we let you go. Carlos want to know, how do I get the course? And I think they just email you. Is that correct?
Yeah, just email me. And we will be, should I mention about the forum or?
We would talk about the Traders Forum all the time. So we're going to release.
I'm not sure if I should, but basically the Traders Forum, it's a wonderful forum, which I would encourage everyone to sign up there. I'll be looking to uploading these on the forum. Again, they will be free to attend. So you will be getting a lot of information. Just get in touch with us, send me an email, and then I will be making sure we upload all the material there to the forum so you can watch it at your time. Both the core concepts, which we'll be uploading, I will stretch it a bit more because, as I mentioned, I have the time limitation, and I don't want to be imposing on the next esteemed guests. And so we'll be stretching it more in depth, more examples. And we'll see if we want to take it to the next level, go from information to implementation into our community.
Right. Alex says, excellent job. Thank you.
Thank you so much for the invitation, Jeff. And I would invite everyone to stay along for the rest of the presentations, because they have a wonderful lineup of speakers.
All right, including Tushar, who's coming right up. Thank you very much, Alex. I appreciate it.
Absolutely. Thank you so much, everyone.
All right, let me go ahead and do this. Go ahead and take control real quick. And for the next contest, let me go ahead and show my screen real quick. Make sure you grab that. Actually, it was very, very fun to actually help Alex kind of get that coded and ready for Metastock. It's a really good value add, and it doesn't cost anything for that version. There's an expert advisor, they're scanning, all that kind of good stuff. Tushar, it's good to see you on here. Before we get to you, we are going to give away a little bit of a prize. So, but what I'm going to do, we're going to do a prize a little bit differently. I'm going to go ahead and give you a number range in chat. I want you to guess a number between 1 and 1,000. And then I'm going to say thank you to our sponsors. I'm going to mention a sponsor. You don't have a lot of time to do this, but the number closest, using Price is Right rules, to any number between 1 and 1,000, I've got it written down on my paper. The number closest is going to win a prize. So go ahead and start typing in your number now, and I hope good luck. The rules on that are anywhere between 1 and 1,000. Greg's already guessed 567. It can't be higher than this number. It has to be this number without going over. Okay. As we get through, I do want to say thanks to Alex for mentioning the Traders Forum. You can find the Traders Forum at thetradersforum.com. They're a sponsor of us, and there's a lot of good content up there. There's a lot of educational materials. We're growing it out. There's an active market chat. There's people up there talking about chats the stocks they're interested all the time. We have guests. We do lessons. It's all free. You can go to thetradersforum.com to join. Okay. All right. While we're on here, I'm going to go ahead and go to my prize sheet. Thank you for all the guesses. There's a ton of them coming through. Let me look here. And the prize that we have next is Silas Peters' $997 price action weekly playbook. Silas came in yesterday. He talked about the 3S code in case you forgot, or the kind of M tops, he calls them 1, 2, 3 tops, W top bottoms, those types of things. Really, really cool. With his price action weekly playbook, you'll get weekly price action alerts. You'll receive the top trade of the week, and it'll help you avoid hours of research in the market. That $997 is a yearly subscription, and it's going to be for free. Now, you might want to know what the number is, and I can tell who the winner is already. Well, unless we get another closer thing. The number that I wrote down, if you can even read it, is 492. So, and then looking at it, Jerome was really close at 499, but he went over. The next closest was YouTube with 467 in the chat. That was Camille. Camille, I'm going to go ahead and write down your information. And I'm going to need you to actually email me because I don't necessarily know if you are. I don't know if you're registered or not. So I'm going to go ahead and write down your information. I'm going to ask Greg to put my email address, which is jeffrey.gibby@metastock.com, in the chat. And we'll make sure you get that price action playbook set up. Thanks for all the guesses. That's kind of fun. We might do it again. Who knows? But thank you for all the guesses. Ray God says, great presentation. Tushar is ready to join us. Tushar is camera on. I can see you. You look great, Tushar.
Oh, thank you very much. So do you, Jeffrey.
I want to know how you stopped aging.
Day before yesterday.
All right. Let me make you the presenter. Tushar is somebody that I've been familiar with a number of years. He did a lot of work with a gentleman by the name of Stanley Kroll. Stochastic. He did a lot of work with a gentleman by the name of Stanley Kroll. He develops a lot of indicators. The one that I'm most familiar with, because it works so good in a lot of testing, is called the stochastic RSI. Tushar, what are you talking about today? What are you going to share with us?
So I'm going to talk about being consistent in your trading and using some of my tools, particularly the trend ribbon, to make it easier for you to trade well. As we know, because of social media and everything else, there's a lot of noise. And as some of your speakers have been referring to earlier, they're sort of long-term traders. And so I'm just going to dive into some charts, trying to give you a framework to understand your own trading style. And then you can see how the tools I have in my toolkit fit in to help you either trade systematically or trade with discretion, whichever is your particular style.
Right on. Okay, cool. So I've got, I can see your screen. It's not full screen yet, but I'm assuming you're going to do that. I'll get out of the way.
Right. So should I get started?
Yeah, it's perfect. I can. Everything's looking great. You're ready to go. I'll get out of the way.
Okay, thanks. Thanks, Jeffrey. Well, good morning, everybody, or good afternoon, depending on where you are. Well, thank you very much for being here. It's wonderful to be here on a sort of interesting day in the markets. So my background is primarily in systematic trading. I was a money manager. I traded mechanical systems for more than 15, 20 years. So the idea is that that's where I come from. So I have a very systematic approach to the markets, but I also recognize that a lot of people use discretion. So I'll give you a framework to understand your own trading style and how you can get better with some of the tools that I have. So let's get started. So this is the usual disclaimer. You can look at it. Mainly remember that past performance is not necessarily indicative of future results. So the first question you need to understand about yourself is, what is your trading style? So what I've done here is that I've used this idea of relative speed, and on the vertical column we have the speed of entry, and for the rows we have the speed of entry, and for the columns we have the speed of exit. So you could have a fast exit and a slow exit, or a fast entry and a slow entry. So depending on how you combine the speed of entry and the speed of exit, you get different trading styles. So let's explore that. If you have a fast entry and a fast exit, that usually means you're a short-term trader or a discretionary trader. Conversely, where I used to be, if you have a slow entry and a slow exit, then you are a trend follower, meaning, as some of the earlier speakers said, they hold positions for many months if needed. And then you also have other possibilities. If you are quick to enter and slow to exit, you are basically in what is known in the industry as strong hands, which would be sort of if you're an industry pro. And then the opposite of that is if you're slow to enter but quick to exit, then you're considered weak hands, meaning you're itching to get out and you're reluctant to put on the position. So regardless of how you trade, it's important for you to understand how you could classify your trading approach. And this could be on any time frame. And then just to be clear, for any trade, you must have a few things, right? You also, of course, you have to know what you want to trade, and then how you're going to trade, which means that you need to have entry rules, exit rules, and trade sizing rules. So whether you hear somebody on TV or you read about it in a blog, you need to have some entry rules. And then, most of these people don't tell you when to get out, so you need to have exit rules. And then you have to decide whether you're going to commit 10% of your capital or 1% of your capital, and so on. But the most important thing is that you must have the conviction to follow your rules, and that's really vitally important. If you keep switching styles all the time, as you saw in the previous chart, it's a little hard to be consistent. So the question is, which is the fastest way to improve your trading? And the fastest way to improve your trading is to ignore the noise, right? This is the most important bit of information you need to recognize. And it's very hard to ignore the noise, because the human psychology is to respond to all the stimuli you get. And because of social media and all the different means of communication, we are constantly bombarded with noise, and people are always talking of gloom and doom, and they're saying it's going to go to infinity or go to zero. So how do you do that? And to do that, you need an unbiased assessment of the trend. So you need a very mechanical, formula-based assessment of the trend, which is kind of what you saw with the earlier speakers. And I have 3 tools in my toolbox. That is the package. The one is the Chande trend meter, which is sort of a measure of momentum. Then there's a swing system, and attached to the swing system, there's a trend ribbon. So I'll show you that what these 3 things do is give you a completely independent assessment of the trend. So you can look at the bar and say, this is what the trend is, and then that tells you, okay, now what I want to do in this trend environment. Okay, now let me give you an example of noise. So this was I just did a search for what were the top Wall Street banks or brokerages predicting for the S&P 500 return for 2022. Remember, we had a strong trend going into 2022, and then the market tanked. So only 2 predicted losses, 8 out of 10 were bullish. The 2022 year-end forecast ranged from 4,400, which was a 5% loss, to 5,300, a 14% gain. And the actual was down minus 19%. So you see that even the biggest brains on Wall Street were, mostly wrong. And the converse is also true. Then we had a rally in 23, and this headline says there's a huge dispersion. Again, the experts range from 3,600 to 4,500. So say -5 to +17, and the actual was more like 24. And I don't know if you remember, but if you're listening to the news at that time, people were, expecting it to go to 3,200, very dire numbers. And conversely, at the top, people were expecting it to go to 5,000, 6,000, really bullish numbers. So if the best brains on Wall Street can get it so wrong and there's so much dispersion, it reinforces the need to have a consistent framework for just saying what's the trend, what's happening. Let's dive into some charts just for some fun. And I picked ELF Beauty because they had an incredible 10x move in less than 2 years. So let's look at the chart, and that'll give you a sense for where my stuff fits in. So this is ELF Beauty. We don't really care what it was. It was down here in 2022. It was down here 21. Then it had this incredible rally, and it topped out, and now it's down, back in the mud. So the question is, this is great. We can see the whole move, so it's easy to sort of react. But if you're down here, when you're trading 1 bar at a time, you don't really know where it's going. If you were sitting over here, there was no way to know what was going to go all the way over there. So it's easy to react to the chart when you see all of it. But when you're trading, you only can trade at the right edge, so to speak. So what could you have done from a charting point of view? You could have drawn this line over here, sort of pointing out the top. And there's a couple of interesting things here. The first thing is that we had a false breakout. Then we had a breakout and a retest, and then the trend broke out above the initial breakout high, and then the trend continued. So this behavior you'll see over and over again, where you get a breakout and a retest of the breakout. Now you could have used the retracement tool in Metastock, which is a very standard tool, everybody knows about it. And using that high and this low, the 38% retracement puts you right kind of where the low actually was for this pullback. So yes, you could have predicted that in real time, but what about this high? So okay, you could have used the extension tool to predict from this point. You could have said the high would be somewhere around 213, 214, and sure enough, that's kind of where the prices eventually got. So you could have made some predictions in real time, but if you were sort of here 1 bar at a time, it's really hard to know where the market's going to go. So we're back to this chart. What else could you have done? You could have drawn the double top here, sort of similar to this line, and then you could have drawn this massive head and shoulders pattern much later in the chart. So you see that if you're just going to use conventional analysis, may have some benefit, but it's generally slower to react. You want something more rule-based that can just trade the trend without having to worry about what's happening or what patterns may be forming. So this is an example using a long-term trend following system. In that box, there's slow entries and slow exits. So for example, here we would have, this was the low. We got in sometime after the new high was formed, we would have followed the trend, got stopped out. Another entry followed it, got stopped out here, a false breakout, and then long here and stopped out there. So essentially, we could have captured most, but not all, of the up move, which is pretty good for a mechanical system. And then we would have stayed out of this whole choppy retracement back down here if you're mostly thinking of a long only trade. This is another tool. This is the same chart of the daily chart with the long-term system on it. But here I've plotted another indicator, momentum indicator. I'll explain that in a second. But essentially, this is on a scale from 0 to 100. We have lines at 80 and 20, and then 90 and 10. So say, for example, during this strong up move, you see the value rose above 90 and kind of stayed there, but it was choppy because price action was choppy. And then during this whole decline, you see it was, it never got above 80 during this decline. And of course, during the first leg up, again, we had values well above 90 and above 80 for long periods with a few pullbacks based on what the price was doing. Now we could smooth this out a bit if you went to a weekly chart. So if you look at the weekly chart, that's the low, that's the high, you have a 10x move, and the same indicator, you see it was above 90 for almost the entire duration of this move up, and then of course a little bit here to the top, and then did signal the top, but not quite, and then pull back, didn't really matter. So if you're looking for confirmation, if you're trying to decide what should I do, here's a tool that tells you upfront that, hey, it's above 90, you don't have to think about it. And then over here again, above 90, you don't have to think about it. So these are tools to confirm whether you want to stick or what strategy you want to use for a given symbol. This is the ELF beauty again, ELF chart, but we have a different system here. We have a counter trend long only system. So for example, we have the sell off, we get an entry point in the middle of the chart and we follow the trend, we get stopped out. So you see it's moving much faster, it has a faster rhythm. And then another entry point here near the top gets stopped out. Then you have a pullback, a couple of false trades here. Now, this is the counter trend, so it's buying weakness. So a completely different philosophy. And we could still have done a fully mechanical trade because on any bar here, we didn't really need to know what was going to happen 6 months or 8 months or 10 months later, because we had a trailing stop and we just had to pay attention to the trailing stop. But I would like to draw your attention to this ribbon at the bottom. So the ribbon is working on a different rhythm yet, and it's telling you another measure of momentum and is labeling it as strong up or down or weak up and down. So another way to check what is happening here was to look at the trend down here. So when you are doing on any time frame, and I'll show you examples of intraday, etc., the trend ribbon here coupled with the breakout style system here give you another way to think about what's happening in the market and how your individual trade fits in. Of course, you could use this directly as a system, and it's in the package, and you get a scan, and you could get an expert commentary and all of that. But what I want you to understand is that we can only look at the market one day at a time, and when you're here or here or here or here anyway, you don't know where it's going to end up. So you need some rule-based approach unless you want to use discretion. And this trend bar down here gives you another assessment. For example, from all the way from here down there, you see it was more or less red all the way across. Now this is a Visa. One of the speakers referred to it earlier, and they were doing whatever they were doing. But again, here I want to show you that I've got all three tools here. This is weekly data, so we got an entry here with the counter trend entry, and you see the counter trend entry came when this trend signal was down. So some other measurement said this is down. So we want to buy strength during weakness or after weakness. So this is how we get the counter trend entry, and then we just keep following this along. Here we have a strong trend. You see we have the trend meter up here. It's above 90, so we're going to get a strong trend. And you can't look at the chart as a whole. You have to think of it as one bar at a time. So somewhere over here, you don't really know what's happening, but you look up here and you say I have a very strong trend. You look down here and you say it's strong up, and then you have a trailing stop. So at that point, you know that you should be long this trade, and so on. In the most recent situation, again, this is red. We had a downtrend. We're buying a little bit of strength after weakness, so it's a counter trend entry, and then trend meter above here is above 90, strong trend, and then down below here you have strong trend again, strong up. And these are three completely different measures of momentum or rule-based approaches for buying and selling or buying and exiting, and they're giving you sort of independent measures looking at different time frames, different internal logic, multiple indicators. So when you get to trade, you don't have to worry about all those things. They're hidden from you, they're under the hood. You don't need to know much about how the engine is built to drive your BMW. So this is much the same way. That is, a lot of market expertise has been combined into some very simple indicators, and now you can either use them as they are, or you can trade the way you always wanted, but you can use them for reference. So looking at the package that I have the most important tool here is the Chande trend meter, which answers the question, is the market trending? And I've given you some examples where when there's a strong uptrend, you get values above 90, strong downtrend, you get values below 10. Then we have a long-term system. I showed you an example of that when we took all those breakouts during the big up leg of ELF. And then these are counter trend systems, and I show you an example of the swing system along with its ribbon, which is a counter trend entry, is buying after weakness, and then it gives you a specific exit point, a trailing stop. So essentially now you have a very diverse, fully mechanical, rule-based approach that you can use as, for example, you can use a CTM to scan things and find trading opportunities. You can use a swing system to scan, find trading opportunities, or if you're just trading one market, you can use it on that. So just to sort of fill in a little bit, I'm using weekly NASDAQ data. So to access the trend advisor or the strip, you'll have to right-click on the chart, look for expert advisor, and then use the attach function. So once you look at the attach under expert advisor, you will get a list, and in this case, it's the swing system. So I'm attaching the swing system, and this is sort of what you get. You get a system that works, that gives you an entry arrow and an exit point. So you have an entry level and an exit level, and then you have this trend ribbon. And this is weekly data for the NASDAQ futures. And a couple of interesting things. If you could draw a trend line here after the fact, no problem. And then you have a downtrend line here after the fact. We got an entry here when this was strong down. So if you look at, if I come up from here, roughly right after when we got this trend break, we got the first red sign here, and it pretty much went red all the way across, except for this one little uptrend here. And then we got two false entries here because we're going counter trend. And then our third entry actually worked out beautifully and gave us entry into this very long up move, and we got in, say, 3 or 4 bars after the absolute end low of the move. So this is an example that shows you that the two signals are working on different time frames. This is giving you like an overview in terms of it's weak, it's up, weak up, and strong up. So you don't have to take someone else's opinion. And I showed you how Wall Street can be wrong, consistently. And then oddly enough, I just draw a parallel line to this initial green line, and the lows for this most recent uptrend have essentially touched the same trend line as that. Of course, you could have drawn the trend line here and use it as an entry point, but it's not obvious that it will hold. So the point of this chart is that you can attach the swing system expert to show you this ribbon, and this ribbon will give you an independent assessment of the trend and the trend strength. So if it's red, it's just down. You can be short or you can be out of the market. If it's light up or light green, it's up. So you can go in with a trailing stop, of course. And then if it's strong up, we can go into the larger size or with greater conviction, whatever suits you. Now, just reiterates on the ribbon, we just have 3 colors: red, light green, and dark green. So it gives you 3 independent measures of what's happening to the trend. Now, I just want to backfill a little bit. I'm still on the same NASDAQ weekly chart, and I showed you in the first chart just the arrows and sort of the exits, but I wanted to show you here is that we have like a dotted line. I don't know how well you can see it, but you can think of it as an entry trigger line. So there's a trigger line. So if something happens, you're above the trigger line, you go long, and then obviously the trailing stop gives you an exit point. So again, these are mechanical. They are, you just calculate them automatically. There's no judgment involved. The system just does it for you. And the nice thing about that is some of these signals are coming in very close to the absolute low. And if you think of the market environment, it's very negative. People are projecting it's going to go much, much, much lower, and et cetera, et cetera. So it takes a lot of conviction and courage to go long at that point. Or conversely, you can argue that's the best time to go long, because if you're a value trader, it's a great value, blah, blah. So the point is that the counter trend entry comes at a time when it's psychologically difficult to take it. And then just to reinforce that point, this particular entry comes when the other measure, the ribbon, is down, is red. So clearly the counter trend must give us entries when the other measures are down, and this entry and that entry again occurring in the red region. So the point is that some of the best gains are available when you take a counter trend move. So this is 2020 first quarter. We had the sell-off due to COVID, and then we get an entry right here within just 3 or 4 bars after the low of the move. And I don't have to remind you how negative the whole psychology was, and people were projecting the market was going to go much, much lower, etc. So there's an advantage to being systematic, to using something else as your unbiased measure of the trend, so that you can overcome the noise that surrounds us when it comes to the markets. Okay, just to add the trend meter onto the weekly chart we're talking about. Now, trend meter, you see that here it was above 90 and stayed above 90 mostly for the entire move, confirmed by the strong up on the green bar. And this is 2020, so COVID lows, and you see we had this nice uptrend, and the trend meter stayed above 90 for the whole duration. So the point is that it's difficult to overcome the noise in the markets and the self-doubt and whatever psychological aspects, unless you're being very systematic or you have something else, and this gives you, or this gives you, or that gives you a completely unbiased mechanical measure of, is it up, is it down, is it strong, is it weak, and then you can, it'll help stabilize your trading and help you trade better. Okay, so just to remind you, we have number one as the trend meter as a tool, number two we have the counter trend entry as a tool, and then we have the ribbon from the counter trend entry as another measure. So these are the three tools you can use. You can use them either in combination or in isolation, or of course you can ignore them. Just a close up of the trend meter, the scale is from 0 to 100. During strong uptrends, we get values about 80, and then strong downtrends, you get value below 20. And then this just to reinforce what the trend meter does, so we have a daily chart of Costco down here. There are many indicators. There are 4 different time frames: 25, 50, 75, and 100 bars. Lots of noise, a lot of computations underneath, and then we are reducing all of these things into a single number between 0 and 100. So instead of having to look at all these squiggles and wonder, is it this, is it that, you don't have to worry about it. All that is sort of buried under the hood, and you get a single number, and that's all you need to look at. So the CTM is a very powerful indicator because it collects and combines patterns, momentum, and multiple time frames, and it gives you a single number to look at. So you don't have to waste time. Imagine if you had 100 charts or 20 charts to look through, and each one of these things, where's it going, is it coming, is it going, or what, and how do you weight them? So the CTM solves that problem for you and gives you a single number to look at, and you can use it on any time frame and any market. So the previous speaker talked about how he had to normalize it. Well, this already normalizes it for you, so you can apply this on any market, on any time frame, and it gives you the same values above 80 and below 20, and you don't need any other shenanigans to make it uniform across all markets. Now, I just want to again reinforce that the CTM is not the RSI. Because it's on a 0 to 100 scale, it's tempting to think that it's just RSI, and it's not. So I have plotted the 25, 50, and 100-day RSI here, all on the same scale. And you can see that the RSI is more or less flat and never really gets above 90 or below, say, 20 in any of these in the entire. I'm going from 2000 to 2025, so a very long time using weekly data. And you see that the CTM value rises above 90 or above 80 for strong trends much more often than the RSI does, because it weights things differently. So one of the artifacts of the way the CTM is designed, it uses closing prices. So it looks visually similar to other indicators that also use closing prices like RSI, but the dynamics and the internals are completely different and gives you a different view of momentum. That's already been normalized to give you the same value across different objects and time periods. Now, so just a reminder, 3 tools that you can use together, to make sense, and I'll show you more charts rather than just, dump a bunch of test data on you. So a reminder, 3 independent trend checks. The trend meter is a multi-indicator combination. It's it's an indicator of indicators. The swing system is a long only counter trend system with an entry and an exit. So it gives you like an independent measure. Is it higher going? Does it think it's going to go higher? And then the trend ribbon, so you get a third check. Okay. Now, this may get complicated, etc. But what you have to think about is ultimately the market has momentum. And what is momentum? It depends on the time frame you measure it. Depends on how you smooth it. Depends on how you measure it. You want an open scale, you want a closed scale, then you want to weight it, you want to combine multiple things. So it's momentum can be measured many different ways, as the people have before us today have already mentioned. So I'll just try to use monthly data because that just gives you a smoother data series to look at, just so that you get an intuitive understanding of how this thing works. So this is E-mini NASDAQ monthly data, so massive long frame from 2005 to 2025, so forever. And then I've got the CTM at the top, and then we have the counter trend entries in the middle chart, and then we have the trend ribbon down below, or the strength ribbon below. So just visually, you see, we were in 2008 was the last truly major low. Then we had the long uptrend. Then we had the hiccup due to 2020. Then we had the sell-off in 22 because of the Fed raising rates, and then we have a rally since then. So during this entire move up from 2008 to say 2022, the CTM was mostly above, almost entirely above 80, and even above 90 for most of the time. So if you go back and look at the newspapers, you'll see countless stories about how it's overbought and the market is going to go lower and the bear market is inevitable. We never go this long. A lot of negative commentary. And yet, the CTM was above 90 for the whole time. And if you look down below, it's been green almost the entire way except for a little bit down here. So, we don't have to rely on the opinions of others to drive our trading. We can just look at mechanical rules, and we just have to believe what they're telling us. And this is just an example of where we've had the most phenomenal uptrend. Buy and hold, you could have closed your eyes and sort of lived through the volatility, and you'd be very happy at the end of the time period. And the indicators have basically supported that approach. Okay, this is SPY monthly. The reason I put this on here is, again, I want you to see the 2008 decline, and then we got an entry on the counter trend, which was 1, 2, 3, 4 bars or 4 weeks or 4 months after the absolute low of the move, when there's massive negativity. Same thing here. We got an entry after 2020, which was again 4 months after the move, because of course it's monthly data. And then when this was closer to the rebound from down below. But if you look at the trend ribbon here, it was red during the decline. The counter trend entry came before it turned green, and then it more or less stayed green for the whole uptrend, all the way from say 28 through today, which is like ridiculous. But in the meanwhile, there were hundreds of trees felled, to spout negative views on the market. Again, weekly data, a little bit closer look at the 2008, the incredible meltdown in 2008. And on weekly data, you get an entry, the counter trend entry 1, 2, 3, 4. So 4 bars, like 1 month after the absolute bottom of the move, when negativity was everywhere. And again, look at the trend bar here. The objective reading of the trend is it's down, and yet we get a counter trend entry, and it worked out very well. But of course, the counter trend entry gets punched out a few times here because it's pushing against the trend. But during this up move, we get this strong up. It's green all the way, and then it turns green, but a little bit hesitant, So again, it's very important to have the larger picture in mind, and this way it helps your own trading to be comfortable with what the rest of the trend is going to look like. Again, a longer term view with the S&P, the big slip off here. Again, during this major uptrend, the trend ribbon stays green all the way through. So the point here is that it's good to have a third party, something else that you can look at and say, what's happening to the market, what's happening in the market. Again, S&P weekly data, a fantastic move off the 2020 lows. The trend ribbon stays green during the entire move, and then we have the 2022 sell-off. And I showed you the examples before about how the Wall Street estimates were either too optimistic or too pessimistic. And then during this, say 1, 2, 3, 4, 5, 5 swing decline, they stayed red for almost most of the major portion of the decline. And again, we got a counter trend entry very close to the low, but we had 2 false trades here or losing trades here, etc. So the point here is that it's good to have another way of classifying the market, and this is clearly a system-based approach. It gives you a specific entry point, specific exit point, or you could have a sort of momentum-based approach where it gives you a strong up, but doesn't know when it's going to change. This is again a view of CTM combined with those 3. Again, I've shown this chart before. Let's skip forward a little bit. Okay, so this is this is NASDAQ daily. So this is weekly data. Just look at the chart. You get the CTM entries, and you got a strip down below. Then we can go to daily data. It looks exactly the same. When you have a strong uptrend, you get a CTM above 90. It's strong up on the ribbon below, and then you have week down or week periods properly identified. Then you can shrink down to a 30-minute chart. It works exactly the same way. When you have a strong period, strong up here, then you have a CTM above 90, and you have a strong move up in the market. A big sell-off here. CTM drops below 10, very, very strong, and then you see that the trend ribbon here turns negative a little bit below before the start of this big sell-off. So a lot of people like to trade the indexes on short time frames. So I'm just giving an example of we started with say monthly data, then we did weekly data, then daily data, now 30 minutes. But the tools have stayed the same and they've behaved exactly the same way. So the idea is that these tools are normalized not just for momentum, they're also normalized for time. So regardless of the time period, they're giving the same consistent answer, and they've been properly framed and normalized. So the amplitudes and the messages are always the same and consistently on a 0 to 100 scale. But it can be minus 100 to plus 100. It's just a matter of how you want to set it up. So again, I want to just point out that when you have strong downtrends, the CTM goes below 20 and say below even 10, and then similarly the ribbon here has been weak or has been turned red before we got this big sell-off. Again, still a 30-minute NASDAQ, another sell-off more recently. Again, if you look at the ribbon, it turned green very close to the high of the move, and then stayed red for most of the time. We had this big strong sell-off. The CTM was below 10 and below 20 for most of the down move. So one of the questions was, is it neutral, and or is it trending high, trending up strongly or trending down strongly? So clearly, as part of the normalization process, the 20 to 80 is a neutral range. So there's nothing magic about finding a neutral period or neutral zone. We already have a neutral zone here, and clearly the market kind of maybe doesn't have the same level of momentum, though clearly it could make a low and then rise very quickly to the top. But there's nothing magical about finding a neutral zone. We already have it in this indicator. Same thing here. We got 5-minute on the NASDAQ futures. Again, strong sell-off, CTM below 20, strong sell-off, CTM below 20. So we've gone from a monthly time frame to a 5-minute time frame with the three tools, the trend meter, the counter trend entry, and the trend ribbon, and they all work consistently in the same way, correctly pointing out neutral regions, strong up regions, the strong down regions, without having to worry about the details of how each indicator is built. And for example, here, if you look at, say, the middle of the chart, we had this long downtrend, and the trend ribbon stayed red almost throughout the entire down move. It's not a very long time period because it's a 5-minute chart, but it did show you that the price is expected the prices to decline. So again, regardless of what time period you're using in your own trading, it's good to have a consistent system or process that'll help you identify the major or minor trends in the market. And you're looking at 3 different ways of momentum, counter trend entries, and trend ribbon to give you 3 independent measures of what's happening in the market. NVIDIA 5 minutes, this is not limited to any particular market. One of the speakers is very excited, they got to normalize on many different things. Well, this is NVIDIA, it's a stock. And again, it's a 5 minutes, a very, very short period. Again, exactly the same appearance, strong uptrends, we're above 90. There's a consistent downtrend in NVIDIA. We see that the values are below 80, and then some of them below 20, and then the ribbon was red all the way across. So again, you don't have to guess where it might be going, and you can take a position if you wanted in the direction of, say, the ribbon, and of course with the appropriate risk control. So if it reverses, you're going to get out. And of course we have the counter trend entry to help you with that. 10 minutes, same thing. We have a strong uptrend, values above 80. Ribbon is showing you green. So my point is that you don't have to have a lot of gymnastics to identify major trends in the market. So for example, here we had the reversal after earnings and a downtrend. the ribbon was red for the whole duration for several days in a row. So if you're an intraday trader, you could say, oh, the ribbon is red, I'm expecting it to go down, so I'll take short side trades. And of course you could use it for confirmation if you need it. If you need, you could use a trend meter for confirmation if you wanted. NASDAQ, NVIDIA 30 minutes, again, works the same way. So again, it's normalized, it's consistent across markets, it's consistent across time periods, gives you the same answer as you would expect during strong uptrends, is above 90, strong downtrends is below 10. 60 minutes, exactly the same way. So I just want to show you that, we already have tools that are normalized across time and markets and, can identify neutral zones and strong up or strong down zones. Let's see, SPY 5 minutes. Again, I know many people love this market. So I showed you the monthly chart, the weekly chart. So here's a 5-minute chart of the NASDAQ, of the S&P, and clearly during a strong uptrend you get values above 90. Ribbon is green. Downtrends, ribbon is red, but the momentum is not quite all the way down into the mud yet. NASDAQ 5-minute. Okay. This is this is a company called FTAI. This has the most unbelievable uptrend. So if you're a trend follower, this is what you dream about. So it went from like 40 to 180 and just kept going higher and higher and higher, defying gravity, if you will. So what do the indicators do? So again, we have the counter trend entry, we have the ribbon, we have the trend meter on top. So from the previous chart, there was a strong uptrend. So what do you expect here? On the daily data, you see that during the uptrend, the CTM was above 90 and above 80 for almost the entire move. And then the counter trend entries sort of got you in and got you out, got you in, got you out, but you're using a trailing stop. But you got a series of long entries into this mega trend. So you may not have got, each little reversal took you out, but you would have, ridden it all the way up. And then look at the ribbon down below. During this major leg up, it was solid green all the way up. And then once you got the little consolidation, it turned red, telling you, hey, look out. Cocoa futures, again, this is a very, very volatile contract. It's rather thinly traded, but I love chocolate, and it pains me that cocoa prices have gone up. So I wanted to show you this chart. Again, we're putting the same 3 tools. This is daily data, as a continuous contract. Trading futures is a whole other can of worms, but I just want to show you the basic message I'm trying to give. Again, what do we expect? We have a strong uptrend. The ribbon is green. The trend meter is above 90. This is a different market. There's no normalization. It's already normalized. There's nothing magical about inventing something that's normalized across markets. We already have it here. Then you have a little strong downtrend, strong downtrend, strong downtrend. Counter trend entry close to a low when the ribbon is red. So that's how the counter trend system works. It gives an entry when you're uncomfortable taking it. And then if you want to trade swings, you have an entry and an exit, entry and an exit, and then so you can trade swings with the the counter trend system. So again, a futures markets which rather thin. I don't recommend that you trade it as such, but we just want to say that the rules are ready to be applied to anything in any, I can show you many examples applied to foreign markets, etc., where we have a momentum measure that's already normalized that can identify strong uptrends, strong downtrends, and neutral zones. And of course, we have a ribbon that tells you independently, and that sometimes is going against. For example, here is neutral, but the trend is down, so it tells you the trend is down. So it gives you a different reference point. And you're free to use it any way you want. You can use it as a scanner, you can use it as an expert system, you can use it as a system that gives you an expert advisor, or you can use it, hey, what's happening in the market? What do I think? Tell me, what do you think should be happening? Let's see. Okay, I'll run a few more. So this is Boston Scientific, another stock that's had a fabulous move. It consolidated and broke out, and boy, it's just been straight up basically. So what do you expect? During the uptrend, all the way uptrend here, you see the trend meter was above 90 for most of the time, and 80 for most of the time. And then you see during this consolidation, we got a number of false breakouts. So we have a few false readings above 90 that didn't get followed through. But you see that the trend ribbon was mostly red. I mean, during the entire very tight consolidation where you got a number of attempts to break through, And once it broke through, the ribbon was green all the way, except for a little pullback here when it turned red, and a strong dip in the trend meter. So again, you could have used a long-term system and been long the whole way with a trailing stop, or you could get multiple entries with a shorter-term horizon with the counter trend system, where you're buying weakness and you're getting out as part of that weakness, or you could use the trend ribbon, which gives you just another measure. And again, this is normalized, and we have neutral zone, etc., etc. KKR, KKR is very interesting because it's like not an obvious stock for it to trend. It has whatever, it is its own unique thing. A reason I wanted to show you this chart was, you see, if you just draw a trend line, a break of the trend line doesn't immediately result in a reversal. So I've drawn 3 trend lines here, and we really had to we broke this one trend line, then it formed another trend line break. So we had to break 3 trend lines before we really got a measurable trend. And then a better was we had this channel. So a breakout of a channel is somewhat more useful than a break of a downtrend. So just basic trend, basic charting. But I just wanted to show you particularly the downtrend. Sometimes you can break a downtrend line, but that doesn't necessarily, that just leads to more consolidation, not a breakout. And look at this fabulous breakout. Now, what do you expect? We have this fabulous breakout. We get an entry very close to the low. The trend meter is above 80 and above 90 during the strongest bits. When it's strong up, it's green, and then during this consolidation here, the ribbon is mostly red and just starts turning green a little bit. But during this main downtrend, it's all red, and during the downtrend, you see that it's below 80 for sure, and we have some values below 20. So again, a totally different stock. Not a mainstream stock in the sense that it's not sort of a big dominant part of the indexes, and yet the indicators behave exactly the same way. And then this shows you, if you go to the weekly chart, you get a much smoother reading. We got in counter trend very close to the bottom of the move. We are still sort of long, and the trend meter was above 80 and above 90 for the entire up move. So obviously there's a difference between daily data and weekly data. You get more smoothing with the weekly data. So if you look at KKR, you see we got this noise up here. But if you go to weekly data, that gets smoothed out. So obviously that's just because how we're ineffectively we're compressing time and using longer time period. And then again, here it's important to note that during this long consolidation and downtrend, on the weekly data, the ribbon was red, well, mostly red all the way across, and we got one little up period and then down again. So you can use these tools across time periods, across market types, and essentially it's telling you the same question. It's telling you, is it long in the terms of the counter trend, giving you a sense of momentum, and then giving you a sense of direction. So you have momentum, direction, and bias, if you will, all using these 3 indicators on any chart. And then I just put this out here just to show you that this is a 100-bar channel, so you got like this standard breakout. So if you want to trade a 2-year like a 52-week breakout, which is what someone was trading earlier today, you can do the same thing with a 100-bar channel. And then during the uptrend, you get this strong green bar all the way across, and of course CTA was above 90. Same thing with Meta. How are we doing? Okay, I'll wrap up here. I just want to show you Meta briefly. During this downtrend here, we have values below 80, so a strong downtrend. Ribbon was red. We got a counter trend entry when the ribbon is red, so hard to resist. And then Meta slowly crawled up, gave us a very nice trend on the weekly data, but you see CTM is still not showing momentum, but you can still have a very profitable trade. And then we have this rectangular sort of consolidation. We get a breakout and a retest of the breakout I showed you at the beginning, and now we have a resumption of the uptrend. And then, of course, when the momentum was very strong, it showed up over here. So to summarize, so we can talk about any questions. I've looked at chart intervals from monthly to 5 minutes. You get 3 independent assessments of the trend using the trend meter, the swing system, or the trend ribbon. They're all part of the package. They come with lots of documentation, and you don't have to know the details. Just start using them. There's no learning curve. There's no training required. The 3 tools are independent but consistent. So they give you similar messages when everything is in the same direction. And then, of course, by definition, the counter trend entry will often occur when the ribbon is red, because that's how it's designed. And primarily, you can use it to ignore the noise, overcome the noise. Believe me, it's not easy to overcome the noise. Okay. 3 tools: the trend meter, the counter trend system, and the ribbon. And then again, just to remind you that how do you trade? You need to have entry rules, you need to have exit rules, you need trade sizing rules, and you need to overcome the noise. That's it, Jeffrey. I'm happy to answer some questions. This is a package. It basically says what is trending and how the systems, and there's lots and lots of tools to help you trade. Okay, I think I'll stop there and answer any questions or any other comments.
Perfect. Mark wanted to know, is this long only, or will it also work for shorts?
I'm sorry, I didn't hear that.
Oh, I'm sorry. I'll speak a little closer to the mic. Mark wanted to know, will this work for shorts or is it long only?
The counter trend system will not work for shorts. The trend meter, but that's long only. But the trend meter will work for shorts because it drops below 20 or below 10, and the ribbon will work for shorts because it'll go red.
Sounds good. We also get a question quite a bit. Actually, we polled the audience yesterday, and about 40% were not here in the US, which is interesting, right?
Cool.
So,
that's a lot.
A lot of questions that we get, will this work on international markets? London's very common. India is very common. Australia, Singapore. So maybe you can talk to working on other markets as well as other instruments.
Yes, I showed you examples of Coke. It can work on any market and on any time period on any exchange. So that's normalized fully. So I showed you examples of cocoa. If you go back and look at my talks in previous versions of this of Metastock conferences, I've talked in detail about showed charts on stocks in India, stocks in Germany, stocks in Tokyo or Japan, and stocks in the UK. So it works on any instrument, any exchange, any time period.
Yeah, that's great. Okay, thank you, Tushar. I think I'm going to talk a little bit about how to get it.
Very easy. Buy the package, and it comes with lots of documentation. It's very, very powerful, and it's consistent, and you don't require 6 months of training. You can just start using it.
All right. Thank you very much. I appreciate it.
Thank you very much, everybody. Have a good day.
You bet. Thank you.
Bye.
All right, let me go ahead and do this. I'm going to kind of take control here. Yes. Greg says he likes it, how I kind of, I'm going to do this, and I'm going to click this, and all this kind of stuff. So, Greg, I'm doing that just for you today. All right.
I'm still spoiled.
I do want to, it actually helps me kind of stay focused too, because there's a number of buttons you have to press, as you know. So in any case, I want to talk a little bit about what's included in the Tushar Chande toolkit. Here are a list of the indicators. My face is in the way. Let me move it over here. And this does work, Hide, with Metastock. And if you don't have a copy of Metastock, we'll throw in a free trial with it. If you haven't heard about Metastock yet, best rated software in its price category for 32 years in a row. So, of course, he talked a lot about the trend meter and what that does. It comes with the long-term system, the swing system, the volatility breakout system. And I really like the approach that he used for all of these systems. With the long-term system, he's looking as trend following. It holds for a longer time period. As a result, it uses wider stops. That's included. You get a swing system that looks to focus in on buying strength after weakness, and you get a volatility breakout system. I like the way that he uses average true range to identify when a breakout actually happens and when it occurs on a chart. Does a really, really good job with it. So, of course, with Metastock, one of the things that I love to do is scan. I can scan all the optional stocks. I can scan the ETFs. I can scan whatever I want. You can scan for any of the buys or sells based on that. You can even do just a scan for the Chande trend meter as well. The expert advisor is very detailed. I made sure that when we put it together, I like to kind of make sure that you understand what's going on and why it's going on. So you'll see right here in the commentary, if you read it, there's a long position. It tells you why there's a long position. It talks about the short-term trend. It kind of gives you some ideas behind the design and kind of mechanics underneath it. And really, again, that's just designed to kind of help you, especially if you're brand new to the system, to get up and running with it. Had a lot of questions about if their system test with this one. Look how good that swing system performed, 100% gain over over, I think the basket that I use. It's been a while since I ran that test, but I think the basket I used was the S&P 500, and it performed over 100% on that particular swing system. So in any case, $4.99 is the price that we normally retail this for, so it's very affordable. If it helps you make trades, it's probably going to be well worth $500 for you. At the conference, we're going to do a price of $3.99. That's $399. We're going to back it with our money back guarantee. If you need Metastock, we'll give you a copy of Metastock, a free trial to evaluate it with it. I've already talked about how Metastock's been highly rated and has been rated #1 for 32 years in a row. And we also have, as soon as you order it, it'll a boot camp training that's available. So you can do this. You can call us if you're here in the US or in Canada, 800-882-3040. You can go to metastock.com/conf promo, and you can go to metastock.com/saleschat. I do want to, and as we kind of transition into the next speaker, I want to say thank you again to our sponsors. We'll talk a little bit about AAII this time. AAII is a hugely well-respected, well-reputed organization. They've been doing stuff since the 70s. They're a nonprofit. If you've heard of the AAII sentiment surveys, they do that. They do a bunch of stock research. They do a whole bunch of active investing stuff. Ray Rondo came in earlier this week and talked about that. I'd encourage you, if you want to find out more about the AAII, go to www.aai.com. So I think we're all caught up on questions. Ray, this was custom built for Metastock, so it's not available in Thinkorswim, but you can get it, and we'll give you a free trial to Metastock. And I think if you start doing that, you'll just use Thinkorswim to do trades like I do. So in any case, Mr. Lewis, let's go ahead and kind of do a prize if you don't mind.
That sounds good to me.
All right, I've got my
never
list.
mind. Ever once.
Yeah, it's always fun to give away prizes, right?
It is.
yeah. And we're going to actually kind of do something. Yeah, I love giving away prizes. I only wish we had more time to give away prizes. We could do it for a while. Let me kind of go to the prize list and see what's next. The last prize we gave away was the Silas Peters one. We're going to give away Lawrence McMillan's Options Strategist newsletter. Lawrence McMillan came in and spoke earlier this week. You probably remember, Greg. He wrote what's widely considered to be one of the quintessential, I pulled out a new adjective, a quintessential guide to options trading. It's what's called Options as a Strategic Investment. Very, very popular book. And he came in and gave a really, really good talk. His newsletter service is normally about $129 a month. We're going to give you all 3 of his newsletters for 3 months for free if Greg randomly picks you using his Google random number generator.
I am using my Google random number generator, and I've just generated the number 5,519, 5519.
Okay.
By the way, while you're looking that up, I have to say I really enjoyed Tushar. I couldn't listen to as much of his presentation as I wanted to because I was pushing buttons and pulling knobs in the background, but I really just enjoy his style. He's just very, even if he doesn't know what he's talking about, he really sounds like he knows what he's talking about. I appreciate that in a presenter.
He's going to have that as a testimonial on his page after this. No, I can attest that Tushar is a great technician. He knows what he's talking about.
Obviously he does.
McMillan. Okay, I've got that. We went outside of the U.S. for that prize. That one is going to, you'll never guess, Afghanistan.
Oh, I would never have guessed that.
To Pat with a yahoo.com address. So if your name's Pat and you have a Yahoo address and you're in Afghanistan, I'd say that you probably just won that prize.
That's quite the trifecta. There's probably only one of those.
But that's my guess. Yeah.
I don't know.
Now, I liked what we did last time, and we're going to do it again for the prize giveaway. What I want you to do right now, Greg, do you have a pencil? Do you have a pen and paper?
I do.
Okay. I want you to, we're going to give you some time to do this.
Okay.
But I want you to write down any number between 1 and 1,000.
Okay.
If you're listening in the audience right now, I want you to type in any number between 1 and 1,000. I'll collate those during the next speaker, and we will find out who's closest. So
Price
write down a number.
is right rules, right? You can't go above it.
Price is right rules. Closest without going over.
Okay.
All right.
This is very exciting.
Go ahead and type in those numbers. We had a lot of guesses.
So this blank, which is now blank, will have a number on it.
Yeah. Oh, yeah. And write it down before people start typing in numbers too.
I will. I've already got the number in my head.
Type in those numbers. Let's get them coming in. All right. Our next presenter is Buff Dormeier. Buff, very smart gentleman, does a lot of volume analysis. Works for Kingsview. When I knew him, he was doing some important stuff for Wells Fargo when I met him initially, but he always comes in, always has a great presentation. We're always happy to have him in here. Buff, I'm going to go ahead. I can see you. I'm going to go ahead and have you start talking. I'm going to turn on you. Well, I'm going to have you turn on your mic, and then we're going to go ahead and get you going.
My apologies, Buff. I think I actually muted your mic earlier. Thinking it was mine, so I beg your pardon.
I've unmuted it. Buff, can you talk to me?
Yep.
Okay. Perfect. You're unmuted. I do have your screen, but I don't think
that's the right one, huh? That's the right one.
Yeah.
Let's try this again. Okay, so you know how I switched the screens there, Jeff?
Yeah, if you look at the GoToWebinar console, there's a sharing area. And if you click on the down arrow, it'll kind of expand out. You should be able to see show screen. And there's a little down arrow next to that.
Okay, got it.
Okay.
I'm with you now. I had another box that. Okay, we want to go monitor 1. All right.
Right on. That those are good awards. Yeah, I can see all those awards. Okay, I can see you. I can hear you. I'm going to get out of your way. Your turn. Go.
All right. Well, thank you, Jeff, and thank you all for joining my session. I'm Buff Dormeier. I'm the Chief Technical Analyst of Kingsview Investment Management, and I'm an index specialist with Monarch Funds ETF. But today, I'm speaking to you as a volume evangelist. And my goal today is to unearth a few more volume disciples. So the presentation today, well, this is not going to turn you into a market guru or reveal to you the holy grail of investments. You can find those offers in your junk mail. Rather, my objective today is to provide you with some new volume-based tools and give you some new applications and teach you the how and the why volume may allow you to better interpret the charts so that you can be an improved trader and investors. So the markets, they're extremely efficient. And here you have the most capitalized institutions employing the wisest mind. So if you're going to go up against them head to head, it can be a difficult game. So today I'm going to provide you with an edge so that you too can track or follow the path the smart money's ablazing. We're going to update my award-winning research today from going back to my 2002 Charles Dow Award. These updates were recently published in 2024's Technical Analysis of Stocks and Commodities magazine, shown here on the slide. And it's also in my new book, The Volume Factor. But most importantly to you, today I'm going to share where you can obtain these resources for your own use within the MetaStock platform. Okay, so just to kind of as a backdrop, this is a technical discussion. I'm going to speak about some of my more basic indicators and the how and the why they work. And we're going to focus on some of the fundamentals of the technicals, and then we're going to build off of that base. Now, it may start off a little basic at first, this presentation, but you're going to need to pay attention because these are principles that we're going to use to build a foundation for your own understanding that you may need as we progress along. Okay, so why should you use volume? Volume provides you with an edge. Now, this is not just my opinion. This is research that has been applied and tested time and time again, over and over again. So what I'm going to give you today is four reasons to apply volume information. And I said I was upfront with you when we started. I'm a volume evangelist, and so we're going to start with a good sermon. And any good sermon starts with 4 logical points, starting with the same letter. Okay, and here we're going to use the letter R. So here are our 4 R's of volume. Volume. The first R is responsiveness. Okay. Volume provides quicker information. You may have heard the term volume leads price. And that has been a mantra going back, way back to the days of Charles Dow. And what it means is that changes in volume generally occur before significant price movements or breakouts. Now let's go to R number 2, reliability. Volume also confirms price. So think about it kind of like this. Price is the market's testimony, okay? And volume then is its polygraph. Volume validates and substantiates price. The more investors participating at a given movement, the more that movement is validated. And this way, volume not only can get you into a trade quicker, but simultaneously increase the probability that that trend or that momentum will continue on into the future. The third R is risk. If you can identify a legitimate trend from a failing trend or identify a trend weakness early on, you should be able to reduce the risk in your portfolio with the proper use of volume. And number 4, this is one everybody looks at, returns. If you're in a trend earlier and have a higher probability of being positioned correctly, you're putting the odds in your corner and positioning yourself for a better return. These are the 4 R's of volume. Now, what powers the markets is volume. Now, I like to think of volume as being synonymous with force. And so if we were to look up the Webster's definition of force, it says force is a power operative against support or resistance. Support or resistance, those are technical terms. What is support? Support is an area where buyers reside. And what's resistance? Resistance is an area where sellers reside. Moving on to technical analysis 200, what's an uptrend? Uptrend is a rising support line. And what is a downtrend? A downtrend is a falling resistance line. Okay, and then as you get into more advanced technical analysis learning, you'll discover that volume is the force required to sustain these trends. Okay, so moving on to another definition, if you were to open up the physics dictionary, you might find this definition of force. Force is a vector quantity that tends to produce an acceleration. Okay, so this confirms another major tenet of technical analysis, that volume leads price, meaning that significant changes in volume often precede major price movements. Okay, this statement also infers that volume plays a crucial role in momentum analysis. So let's look at that. Let's look at momentum analysis, and we can understand volume's role in momentum analysis through the laws of Newtonian physics. So let's take a look. Newton's first law of motion is inertia, and it states an object at rest remains at rest, an object in motion remains at motion at a constant speed in a straight line unless acted upon by an unbalanced what? An unbalanced force. Yet most all momentum analysis, momentum trading neglects force or volume. So if we rewrote this definition in technical trading terms, a price trend in motion or momentum tends to remain in motion at a constant speed in a straight line unless acted upon by unbalanced volume. Or my old old friend Joe Granville would probably like us to say on balance volume. But he had the right concept, an unbalanced force. Does anybody here remember Joe Granville from the 80s? You know, there was Jones, there was Buffett, there was Lynch, but no one shined brighter at the peak of his glory than Joe Granville. If you don't know about Joe Granville, you should look up. At one point he was said to had more influence in the market than the Federal Reserve. And he was a volume guy, a big volume guy. One of the things that Joe said was this: is that volume is the cause, and price is just its effect. Yet most momentum analysis focus strictly on the effect, and they ignore the cause. We're going to correct that today. Okay, and we're going to start here with this understanding of this physics principle by taking a look at one of my most basic indicators, the volume weighted moving average. Okay, and this indicator is available to you in the Metastock add-on called a volume weighted moving average. Okay, so what's a volume weighted moving average? Okay, they differentiate from price moving averages is that the moving averages only include price data, where volume weighted moving averages include the proportional changes of price as well as their volume data. So in effect, a moving average just shows you average price, where volume moving averages show you the average price in which investors may participate. So here in this illustration, say that we're going to create a 2-day moving average. Okay, so contrast that to a volume weighted moving average. So on day 1, to construct the moving averages, let's say the price is 10, the next day is 12. What's the average price? Well, it's 11, and that would be the simple moving average. Now, what that neglected was the volume information. How many people participated at those given price levels? So now we're going to add some additional information. Day 1, the price is 10 and 100,000 shares traded. And day 2, the price is 12 and 300,000 shares traded. So we can deduce that 25% of the shares were traded at 10 and 75% of the shares or investors participated was at a price of 12. So the average price in which investors actually participated was not 11, but 11 and a half. Let's take a look at it here on a chart. Here we have a candlestick chart. The blue is the SMA, the red is the volume weighted moving average, and in the bottom there is what's driving this is the red bars. And notice when the volume starts to spike, how much more responsible the red volume weighted moving averages become. So why would we want to do this? Because adding volume information into our moving averages creates the 4 R's: increases responsiveness, reliability, reduces risk, and increases returns. Those are 4 good motives. And so how do we know this? Well, here's a study that I did. Okay, we looked at 60 stocks over 5,000 trading days. And over that period of that study, we broke it down into 3 categories. We looked at small stocks, we looked at large stocks, and we looked at mid-cap stocks. And we looked at stocks with 4 traits or characteristics. We looked at stocks with high volume, stocks with the lowest volume, stocks with the highest volatility, and the stocks with the lowest volatilities. Okay, we take those three sizes with those three traits, created 12 groups. Okay, and we studied a total of 60 stocks. Of those 60 stocks, 93% of them showed faster signals when using the volume weighted moving averages. Only 5% of the time did SMAs produce faster signals. Okay, so volume leads price. Okay, so here's another study. This was a multi-decade study done by the Wharton School, and this is Wharton School's concluding statement in their paper. I'm looking for, see if I have the title of the paper here. I don't think I do, but here's their concluding statement from the Wharton School. We find that in individual stocks whose trading activity is unusually large over periods of a day or a week, as measured by trading volume, during those periods tend to experience large subsequent returns. So if that's not good enough for you, it wasn't good enough for the University of Texas. They read this white paper produced by Wharton, said, what are these guys smoking? This says that you just need to look at volume to get better returns. So what they did was they said, can this be possibly true? So they went out, they did their own study, but they just didn't do it on the US market. Their study was all over the globe. And here's their concluding statement. We studied the existence of the magnitude of the high volume return premium. And by the way, I was looking for the title. That's the title of the paper, the high volume return premium across equity markets in 41 countries, and find that the premium is a strikingly pervasive global phenomenon. Yes, it's a striking, pervasive global phenomenon, and we find evidence that the premium has significant presence in almost all developed markets and a number of emerging markets as well. So this is one area of volume where not only is it traders, not only is it fundamental analysts, it's also even academia agrees with. So next R is reliability. So we got the facts, faster signals 95% of the time, and now we're going to test can these faster signals also be more reliable? And in 60% of the cases, yes, the volume weighted moving averages were more reliable. Only 28% of the time were the simple moving averages, and 12% of the time it really didn't matter. So not only does volume lead price, it confirms it as well. Now we're going to measure risk in this slide by drawdown. Over 70% of the issues tested had lower drawdowns when using the volume weighted moving averages in a crossover system. And then finally, returns. We had 4 traits: low volatility, low volume, high volatility, and high volume. All 4 made more money when infused with volume information. The 3 styles, small, mid, and large, all 3 made more money, particularly the mid and the small. You take those 3 categories, or excuse me, 3 sizes by the 4 traits or factors, creates 12 groups. Of the 12 groups, 11 of the 12 showed improvement when infused with volume. Okay. Next, let's go to Newton's second law of motion, force. Okay, or other words, volume. Okay, so Newton's second law of motion or force is defined as this: momentum is the acceleration of an object depends on the mass of the object and the amount of force applied. So we could rephrase this again in technical volume terms, that the more volume or force being applied to price, the stronger the expectation of its momentum. So a volume analysis is all about this, is understanding the amount of volume required to move the security a given distance at a particular speed. So how much volume or force is required to move a security, the object, at a given distance, the price change, at a particular speed or momentum. So the analogy is this: price acceleration or momentum is powered through volume. Okay, so I'm going to reveal to you another one of my indicators. Okay, this is called the trend bus indicator, and like the volume weighted moving averages, is available in the volume analysis toolbox. Okay, so with the what we're doing here is we're going to flip out we're going to take the MACD and we're going to flip out the exponential moving averages, and we're going to use instead volume weighted moving averages. Okay, and that creates what we call the volume weighted MACD, and it gives you the same traits as we looked at with the volume weighted moving averages, except in the MACD. But the next thing we're going to do is we're going to significantly enhance that by using an adapted approach. Okay, and this is the trend thrust indicator, or TTI. Okay, so conceptually, what TTI does, it goes back again. These concepts go way back. Okay, and in 1935, Harold M. Gartley stated, as the stock market, I'm going to read this quote here: as the stock market student progresses in his learning, he finds that relative figures are most always more useful than the raw data or actual figures. The more advanced observers study that not only are the actual volume of trading stocks for a given period, but also, and this is the key, the ratio or percent that the volume represents of the whole total volume. So keep this concept here in mind, okay, because the TTI is going to use adaptive volume ratios to exaggerate volume's impact with the MACD, okay? So let's take a look at this, okay? So here we have the chart, bar chart, volume, and then we have our traditional MACD. Here we have the volume weighted MACD, and then here we have the adaptive trend thrust indicator. Okay, what you'll find is that the TTI looks similar to both of these, but it tends to be faster and it tends to be more reliable with fewer signals. Okay, so let's just study this. So we did a study comparing the MACD to the TTI. Okay, and the second R was reliability. And so you might expect that the MACD to be reliable about a third of the time, because stocks trend about a third of the time. And if you thought that, you were correct, because it turns out that the MACD showed reliability 34.6% of the time. Okay. However, when we infuse the volume infused TTI, improves that for 34.6 to over 51.6. What that tells you is that stocks may trend approximately a third of the time, okay, but much of that time the trend is not being confirmed by volume flows. So TTI tells you when it is and when it isn't. Okay. Now, again, we looked at the different groups. All four characteristics were in the 50, were near or very near that 50% reliability ratio. Whereas if you look at the MACD, they're all in the low 30s. So this was very consistent regardless in the style. And in the same with profitability. So if you're getting higher probability, faster signals, as you might expect, you're getting better results. So now let's move on to Newton's third law of motion. Okay, so whenever that says, okay, so this is, I like to think of this as the law of asymmetry. Okay, price, demand pushes, supply pushes back. So whenever one object exerts another, exerts a force on another object, the second object exerts an equal and opposite on the first. So this is also known as the law of action, and then the law of reaction. Okay, this is the most important law. Okay, people know about the first law. They know, and that talks about trends and momentum. The second law is utilizing volume with that trend and momentum. Okay, the third law is all about understanding asymmetry. Okay, the difference between price and volume. Okay, is not adding volume; it's the difference. Okay, the asymmetry, the pushback. Okay, and being able to capture what that pushback is. So here's the analogy: the difference between the price trend and the volume adjusted trend exposes the asymmetry between price and volume. Okay, so let's start here with one of my indicators, the VPCI. Okay, and what this is we're going to look at trend. Okay, so here you see the volume weighted moving average in red, the blue is the SMA. And what we're not concerned about either one of these trends, simple or volume weighted by themselves, but what's the difference? Okay, the difference between these two exposes an asymmetry between the two. Okay, and that asymmetry confirms or contradicts what's happening with the blue line. Okay, so here we take that asymmetry and we use it in an indicator called the volume price confirmation indicator. Okay, in it, what the VPCI does is it tunes price and volume into an observable relationship. So here we can see that at point 1, the stock bottoms before the stock bottoms at point 3, and VPCI breaks out at point 2 before the stock breaks out at point 4. And this is how we kind of look at it more logically. So here we break it into 4 quadrants. Okay, so first, a couple definitions. Okay, so an uptrend is based on greed, and greed is needy. It always wants more, 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 right? Kind of like that song. Okay, a downtrend is based on fear. Fear kind of looks like this: get me out, we'll figure it out later. Okay, it's a herd reaction. Okay, rising volume is about force or energy, and falling volume operates under the laws of not energy but entropy. Okay, so here's how it works in the quadrants. If you have a security that's going up with rising volume, okay, this is greed with energy, or security with invigorated greed, or a stock that's under strong demand and the uptrend is being confirmed by more people willing to participate at ever increasing prices. That's a bullish scenario. Keep in mind, volume, capital, is what makes the market go up, and what makes the market go down. It's all about capital. Okay, rising volume on high prices tells you that there's capital moving into that security. Now we have a trend that's up on falling volume. Okay, so we're going to move down to the next quadrant on the left. This is greed, but not empowered with energy, but operating under the laws of entropy. This stock or market is one that's operating under complacency or weak demand. The uptrend is being contradicted by fewer people willing to participate at ever increasing prices. The outlook for this condition is bearish. Next, we have a stock that's going down right on high volume. This is fear being energized, or an issue under strong supply. The downtrend's being confirmed by high volume, and the outlook's bearish. And finally, we have a trend that on the upper here, we have a trend that's down, but the volume's falling. So this is fear with entropy. This issue is under a state of apathy. It's an apathetic stock. Okay, under weak supply, the downtrend's being contradicted because fewer and fewer people are willing to sell at these ever depressed prices, and that is a bullish outlook. Okay, so we have three signals. We have the rising and falling VPCI. We have the VPCI crossovers when we cross over one another, and we have, is VPCI above or below its zero line? Is it above zero or below zero? And then finally, I didn't put this in the slide here, but there's also a pattern. You see the VPCI V, that's usually a capitulation sign. We'll look at that next. So here we have a stock here. This trend is undoubtedly down. The VPCI was down, but turns up and then crosses the zero line. What happens? The stock goes up. VPCI follows it until 0.2. We have a cross under. The stock continues to rise until it falls underneath, the VPCI falls underneath the zero line, and then the stock starts to drop. Okay, it drops until we get a pattern, a VPCI V bottom, and then the VPCI starts to move up, the trend starts to move up, and the VPCI confirms it. That's how we use the indicator. Okay, what happens if we just use this? The indicator is really designed to be used to confirm trends or with a trending indicator. Here we use VPCI alone, and in this study we just bought the stocks in the S&P 500 that had the highest VPCI, the top 10% or top 50 stocks in the S&P with the highest VPCI. And when you did that, over the period of our study, the S&P returned 5.6, but we added 3% of alpha by only investing in the stocks with the highest VPCIs. Okay. Next, we're going to study what happens when we put this into a system. So let's talk about the system real quick. Here's what we're going to do. Okay, we're going to take the VPCI, and then we're going to compare and we're going to put it in a system with the MACD and the ADX. Okay, why that? Okay, the MACD tells us what direction the markets, what direction the security is trending. Okay, the ADX, a high ADX, tells us if the stock is trending or not. Then we're going to use the VPCI to validate those trends, and we're going to test. Our testing is going to be on the SPY. Okay, and then we're also going to compare it to the on balance volume. So let's take a look at how our system did. If you invested during this period, which I think this was from like 92 to 2006, somewhere around that period of time, the S&P earned approximately 10%. Okay, our trading system alone, where we just use the MACD and the ADX, a high ADX, lost approximately 4%. When we add volume in through the on balance volume, we cut the losses in half, but still we lost money. But when we take out the on balance volume and input the VPCI into the system that lost 4% with the MACD and ADX, we take a system that lost 4 and we make it one that makes 8. Okay, so underperforming the S&P in this very poor system. However, let's look at some of these other stats. It was only invested 35% of the time, and it had very low standard deviation. So you got most of the return, 80-some% of the returns with about a third of the risk. Okay, when that 65% of the time when it wasn't invested, if you would have went in T-bills, you would have actually beaten the market. You would actually return. Okay, here's the year by year of each strategy. Notice that there was only 2 years, 2000, 2002, where the strategy lost money. Again, if you would have put the money in T-bills, you would actually never have lost from this study from 93 to 2006. So let's go back here and talk about why this system may not have worked. Okay, why didn't the system work? Okay, why did, if ADX is supposed to find stocks that have high trend and MACD is our system to tell us the direction of the trend, we would have thought that system should have done well, but it didn't. But it lost money. It lost actually quite a bit of money. Okay, so how can we change that system to make it a winner? Okay, so what I did is I updated the system, bringing it up to, I think this test was done in the end of August of 2023. We updated it to that period of time. And we did one thing that significantly changed the results. As opposed to looking at the spider, we looked at the spider of the S&P 500's components, okay? Because the S&P is a very diversified index, right? Consisting of a lot of different sectors, a lot of stocks, a lot of different factors, okay? That makes it less volatile and less trending. But if we look at the components, those individual stocks, and do the same test, we actually beat the market and this is with the BPCI. So here we take that system, and we, as opposed to earning in the S&P 9.3, we earn 20.7, 20.7% with the ADX, MACD, and the BPCI. So the next thing that people ask me is, well, why are you using the MACD? Shouldn't you use the TTI? So if we use the TTI, our returns are improved to 18.3%, and our risk goes considerably lower. Our beta drops, our volatility drops, and so we're getting better returns, stronger returns with the TTI, and while reducing our risk. I think I forgot one here. Oh, I think I'm gonna go back a few. I missed one. Okay, this is the TTI. It's 23%. Okay, and the next one, how do we find even stocks that trend even more? Let's switch this from the S&P to the NASDAQ. And when we do that, our annualized return goes up to 27.8. Okay, $1 million in the NASDAQ grew to 4 million. This strategy grew to 107 million. Okay, so next you can run this system in Metastock. All right, and so these screens are already built into the Metastock platform, so you can screen for this too. And I did this Monday morning, and here are some stocks that cleared the screen. One of the things I want to point out to you is that all these stocks that I'm going to show you signaled on Monday, but many of them had an earlier signal. Okay, so this is Abbott Lab on the daily. Okay, so you can see that it's signaled daily at the beginning of the month. But on my weekly screen, it also corresponded here. This is the weekly. That weekly signal also, the daily signal also corresponded here with the daily. Next is Alibaba, very similar, signaling at the beginning of the month and a really strong breakout. That was also confirmed by an earlier signal on the weeklies or the intermediate term at the end of the third quarter. And notice how it exploded, came back, but never went below this red dot. Okay, let me tell you what about these dots, because these are really important. Okay, so the green dots, if you're short, is a stop loss. The red dot is if you go below that red line. Okay, that means that that's your stop loss. That's the point where you sell. Okay, if the system's green, it's buy, and like right here you can see it's red. That means it's short. So when it goes above the green line like it did here, we take off our short. Okay, and so notice here it went right down to the red line, but didn't cross, so we're still in it. Okay, so Baba just recently had a signal on this upcoming Monday. Okay, another one is Goldman Sachs. This is, I believe, on the weekly. This one signaled in the middle of the third quarter of 2020 24, and then just recently signaled again last Monday. Here's another one. Notice it signaled again. This one signaled way back at the beginning of the year, and has based out, and now signaled again. So this one has consolidated and just recently re-signaled. And that makes me interested. Okay, next is we got Yum Brands here. That signaled on the daily at the beginning of the month, and it's confirmed just last week, not this week, but just last week on the weekly. So this is a very recent signal, confirmed by the daily. And then this is our last one. This one just signaled Monday. Okay, this is Coca-Cola Europe, CCEP, and this is a stock that has just recently signaled again, and ripe and poised according to our analysis. So, my book is The Volume Factor. Just came out last July. You want to learn more about this process? You can order my most recent book. It's again The Volume Factor. You can also find more information at my website, buffdormeier.com. And then I'll let Jeff talk about all the different things, all the different studies and indicators and systems that you get when you purchase the Metastock add-on. Okay, is there Jeff? Is there any questions from the audience I can take, or you want me? Is there any charts that people would like to look at? You with me?
Buff, are you waiting for me?
Yep.
I'm sorry, I was on the phone with Greg. He was having some questions about an email he was working on. What did you need from me, Mr. Buff?
Well, I've concluded the presentation. I wanted to see if there was any questions or if anyone wanted to look at any charts.
Yeah, so one of the questions that we've got, if you guys have symbols that you'd like to look at, let us know in the chat. One of the questions we got from you, Day, is what platforms will this work with?
Well, you know, anyone that has it coded up, and I can't tell you, but I can tell you by the best one that is definitely the Metastock. So you're going to get all these different indicators, and it's going to give you the logic behind them all. And what you can get here at Metastock, you can't get anywhere else, is the setups. So the setup system. So you can run that screen, and you can find the stocks that are meeting the criteria. What I do is I run the screen, then I look at each of the charts individually. When I showed you the studies, it doesn't look at any, you know, it's not it's not subjective. It's just you just buy every stock that has the signal. But I like to look at them individually, and I'll pick out the ones that I like.
Cool. Mark wanted to know if you could repeat your website address.
Oh, it's just you see my name down here in the corner. It's buffdormeier.com.
And I'll put this in the chat for us. Let's see, for everybody. Buff, Neil would like you to look at NTR and CSCO, if you don't mind. Let's see.
Okay. All right. So let me kind of tell you what we're looking at here. Okay. Okay. In this particular version, okay, we have the chart. This is a bar chart. We have the green lines, which is the stop on the if you're short. We have the red the red dots if you're long. Okay, you can see we're not too far off. You know, we've recently kind of crossed over here and are above the red dot. So if you're long, you would stay long until you fell underneath that red dot. The red dot is the stop, and the stop is based on really three things. Okay, The stop is based upon 1, trend, okay? 2, volume, okay? So if volume is confirming the trend, then we're going to give, if it's an uptrend, we're going to give it more room, okay, so that you don't get whipsawed, okay? But if it's contradicting it, we're going to raise that stop so that you so that we can preserve more profits. And the third piece is volatility. Okay, if the stock is more volatile, we're going to give it more room. If it's less volatile, we're going to give it less room. Okay, so then we have these color-coded these color-coded volume bars. Okay, and each one, depending on the color, gives you the code. And you can go into the Metastock program and look and see what these colors mean. Okay, and this is called volume spread analysis. And so if you're familiar with volume spread analysis, this is volume spread analysis decoded by color. Then we have the VPCI. You see that the VPCI, we're gonna zone in here, is zero. It's below the 0 line, which isn't ideal, but it just crossed over. So that's a good signal. And then we can see that down here, the TTI signal. Okay, so there's a couple things that are happening here on NTR on the daily that are certainly positive. This is another one of the okay. We didn't get into today the VMI, but notice if we just take a look in the past, when VMI got high, it's usually a time to buy. Okay, that means the asymmetry. This is a momentum. VMI is a volume momentum indicator. It works just like the BPCI, except with momentum. Okay.
Cool. Dan would like to look at REGN.
RE what?
REGN. Robert Echo Golf Nancy.
Okay.
Thanks, Dan.
One I haven't looked at. You sure you got that right?
Let's see. R radio.
Oh,
E,
R. I started right.
Echo.
REGN. Okay, yeah. Regeneron.
Yes.
Okay, Regeneron. All right, this is one yeah. So I'm gonna switch it over here. I'm gonna go to a different template. This is the one you would see if you're in the if you bought the add-on. Okay. Notice here we have a pretty good short right here, but the short's off. Okay, the short is just recently taken off. Okay, the TTI is not. It's starting to trend up. Okay, it started to trend up way back here as the stock kind of started to bottom out. The VPCI is rising and it's almost to the 0 line. Okay, and the VMI is also rising and it's also getting to areas where typically it's been a good time to buy. So notice like here we had well, this isn't the best one, but here are all different buy and sell points where it got higher or low on the VMI.
All right. One thing that's kind of interesting, and this is a question I've had a few times today, but we did a survey yesterday, and about, I'd say 35%, I don't remember the exact numbers, were people that were outside of the US and Canada. Is this applicable to markets if I say trade in India or London or Australia, etc.?
Absolutely, yeah. It doesn't matter as long as you have good volume data, and all those countries have good volume data. This should work. I mean, you go back to the University of Texas study. It says this works in all developed markets and in most of the emerging markets as well. So as long as you got good data in the exchange, these principles hold. Okay, this is all about this is all about conceptually following the money. Okay, we're looking at where the money's moving. Okay, that works whether you're looking at stocks, where you're looking at commodities, if you're looking at crypto, is all about supply and demand, and that's what we're looking at here, is stocks through the lens of supply and demand.
All right, that comes to the end of the questions. I'm going to spend a little bit of time talking about the add-on, what's included, how you can get it, and all that kind of stuff. But before I let you go, I wanted to say thank you for spending some time with us today, Buff. It's been really good having you on again.
All right, well, thanks for having me. And one last note for your audience: volume. Never leave your chart without it. Thank you, my friends.
You bet. Oh, one question real quick from Dan, if you haven't gone yet.
Yeah, I'm here.
Can you use this to determine tops, bottoms, and targets?
Well, you can. You definitely can use it for that method. However, where it's really strong is bottoms. Okay. And in my book, in both my books, I talk about what they call the VPCI V bottom. We talked a little bit about in the presentation, but when you see that formation in this indicator, the V bottom, it's been exceptionally accurate at calling market bottoms. So the VPCI V bottom is specifically very good to identify that. And I also have that reminds me, I have a newsletter, and I publish publish that. You can get that on thebuffdormeier.com. And we've called out those VPCI V bottoms on the market very accurately over the last several years.
Right on. Thank you very much, Buff. Appreciate it.
All right, thank you, Jeff.
All right, let me go ahead and do this. And we should have everything ready. Go ahead. All right. Okay. So just to recap what we've got here in the add-on, Buff, another Charles Dow Award winner, who has all of these indicators that he talked about in his analysis toolkit. It includes the two systems that he kind of covered. Of course, it includes scanning, because that's my favorite thing to do in Metastock. You do have the ability to test it. That's been a question that's come up over and over. Can I test this? This does have system tests that are included, templates, over 24 different custom indicators, all of it included. So here's a list of everything. I'm not going to really read through that due to time, and I'm not really good at reading out loud anyway. So the systems that are included are the trend momentum, the trend thrust. What we've got here in terms of a special, normally the Buff Dormeier analysis toolkit is $149 a month. We're going to do a special conference promo where it's $99 per month. If you pay for a month, we'll give you a second and third month for free. And if you don't have Metastock, I know somebody was asking, is it available on any other products than Metastock? And while it is, you should try with Metastock. I believe we have the best scanning. There's a reason it's been rated #1 32 years in a row. We'll actually give you a free trial to Metastock to go with this. So 800-882-3040, metastock.com/sales-chat, metastock.com/conf promo. All of that will get to you to where you can do it. Before we move on to our next speaker, I want to say thank you to our sponsor, Technical Analysis of Stocks and Commodities. They've been supporting the event that we've been doing here. All of them since we started just about, 10, 15 years ago is when we started doing these big multi-speakers. And I remember calling up Task and just talking to the people I know over there and kind of giving them the idea, and they were all on board. They've been supporting the event, helping us get people to it ever since we started it, and I appreciate them. Also, if you're a trader and you're looking to improve your education, I think this is a great way to do it. You know, every month you're going to get articles. You have access to all of their 17,000 articles. I believe the pricing is about $100 for a year, and you can sign up at www.traders.com. So if you haven't yet, it's the last time, right before the break, Greg wrote down a number. Now that number was anywhere between 1 and 1,000, and it is the last chance you have to get a number. And if you haven't typed in a number, it's the closest without going over. And I forgot to grab what we're giving away. So give me a sec.
Hey, while you're doing that, Jeff, I'm going to go ahead and mention there's a viewer on the YouTube side that's asking if we're what we used to be
saw that.
called. And I said, well, we've always been called Meta stock. And he said, you mean you were Meta stock? You were Meta before Meta? And I'm like, yes, we've been Meta stock for 30 plus years.
We're the original Meta stock.
Right.
Yeah. Actually, I think our YouTube channel, I was up there on the studio side, the back end side of our YouTube channel, and I believe we just hit our 17 years on YouTube.
Oh yeah, I started this channel. Oh, I think I started the channel when I came to the company 20 years ago, thereabouts. Or
There you
maybe it
go.
had just started. I believe I'm the one that actually kicked it off.
Oh yeah. I remember how much fun it was when we were streaming in the early days where nobody knew what we were doing.
I'll tell you what, you guys might think there's a lot of bugs and hisses along the way in these presentations, but it's a lot better than it used to be.
I remember there were times, Greg, where I'd be like unplugging cables and plugging them in somewhere else. And this is in the wrong place. Yeah, it was fun. Good times.
Kick the PC.
Something's
I
not
sure
working.
did enjoy Buff's presentation. He's very, man, he knows his volume.
Yeah, for
There's
sure.
volumes of volume in his volume.
So you wrote down a number. The book,
Yes.
I'm almost out of these. This
All right.
might be the last conference we're giving them away.
Yes.
But this is the Around the Horn book by Dr. Adrian Mance. Very good book. Adrian, I think, is speaking tomorrow, if not Saturday. But it's a very good book. It has a lot of his patterns in it. It's out of print, and it's a $95 value. So, and it's actually really good. It's got a lot of illustrations, all of his patterns, which are really well thought out. And if you've guessed a number, we're going to figure out who's closest. What was the number you wrote down?
Actually, I got it from Google Random Number Generator, and it's this number, which is, if you can't see, 481.
I want to compare that to how nice my number looked.
I'm just saying. I didn't realize I was quite so close to you, but that's what's random about random numbers. You can be a number, and that's still random.
All right, so let's find people that are, the closest I have is Robert at 324. Okay.
I haven't seen anybody on. Yeah, we should probably. Yeah, I don't think anybody. Yeah, the people on YouTube are above it.
Okay, yeah, I see that too. So 324, Robert, you won.
Congratulations, Robert.
Yeah. So you may have heard this before. I've got your email address, so you don't need to worry about that. I know who you are. I might not have an address. Next week, as we're kind of dusting, cleaning up all of the confetti, getting cleaned up after the conference, all that kind of stuff, I will go to the post office and send you this book. Maybe not this exact copy, but one of 4 or 5 that I've got left. So let me go ahead and send that to me before I lose it. And thank you for the assist, Greg.
You're very welcome. I'll see you in the next hour.
All right. And our next presenter is a long-term friend of Metastock, Mr. Peter Dalal. Peter actually wrote some very, very popular methodologies quite some time ago that were all built around trading the Forex market. It's called the Forex Trader Trading Advantage. And it's been one of our most successful add-ons of all time. Over the last several years, he's been kind of refining the strategies, doing a lot of work, coming up with a methodology that uses a lot of core ingredients. And I really kind of like the way that he's got that he spells everything out in his kind of key ingredient strategy. So without further ado, I'm going to go ahead and get Peter on here. Peter, let's go ahead and get you on here. Robert says, cool, thank you. You're welcome.
All right. All right,
Hello,
can you hear me? All right, can you hear me?
I'm going to go ahead and make you the presenter, and I'll make sure we can see everything before I let you go.
Okay, let me see something. Hold on a second, Jeff.
Take your time.
I'm trying to put these slides on, and before I go too far, my voice is not that great because I've been on weather for a long time. Besides all of the headaches I have it, but anyway, we're gonna get started.
I have a cold. Are you starting to feel better yet?
Not really, but anyway, I collected the strength. I didn't speak much all day. Can you see my screen now?
I can see it, but the one that I can see is the speaker view. Now, if you're okay on that screen, if you just click on where it says.
No, I will have to do it.
Okay.
Hold on a second.
Yeah.
Can you see it?
I can see it, but what I see is the speaker view. So I can see like the slide preview and stuff like that.
No, but you cannot see the slide?
No, I can, yeah, what I see is the speaker view.
Hold on a second.
Yeah, no problem. I can walk you through how to change that if you need me to.
Yeah, please.
The easiest way to do it is, you see where it says display settings right there?
Yeah.
Click on that and just say swap presenter, and I think it's like swap presenter and thing view is like an option that comes up. Yeah, the very top option,
Okay.
swap presenter view and slideshow.
Because
Yeah,
I have a new system and not the greatest one. All right, can you see that?
it's perfect now. Hey, Eugenia,
Okay.
good to see you. Thanks for saying hi. Thanks for coming in. All right, Peter, I can see you. I can hear you. And you know that means I'm going to get out of your way. Your turn.
All right.
I'll be
So
here if you need me.
you could see the full slide.
Yeah, it's coming through perfectly now.
Okay. Thank you very much for coming in today. My name is Peter Dalal. I'm a fan of Metastock. I started with Metastock in 1990s, and out of all the other software I use, which kind of competition, but Metastock has its own place, and I never left that. And 2003, I met somebody at that time was Reuters, and we strike a deal and give them an idea. That's what Jeff was talking about. And I started trading at that time Forex in 1999. I was one of the few traders who started trading Forex because I always like to touch new things, right? And back in days, there was no Forex retail charts. So I used to ask the broker open, high, low, and close prices. And at that time, I was involved heavily in the construction. So we got a lot of blueprints coming in. So in the back of those blueprints, I will draw the candlestick charts. And that's how I started eventually in 2001, 2002. Right, people started putting the charts together for retail traders, and I have nothing but a lot of fun. And in 2003, we did the first product, which was Forex Traders Advantage. But I was trading securities, options, everything. Because trader is a trader, doesn't matter which chart you're looking at, as long as you understand the concept of trading, right? And at the same time, I was traveling with Jeff and Kelly and all other people, including Scott. I always get frustrated that by the time I tell broker what to do, because I'm traveling 4 cities a week. So I had to call the broker to put the orders in. And by the time in the night time, you're tired, you put all this kind of trading plan. Next day, market opens up different, everything goes to haywire. So that's why I said there got to be a way to do something better. And that's how Magic Trader was put in action, but I didn't tell Metastock what is going on in my mind. And I was secretly designing, writing formulas. And the first Forex Traders Advantage I had at that time was Reuters. Jeff was there, Kelly was there, and I, what do you call, have them do the coding because I didn't know what the hell I was doing. And eventually, when we file for patents, I got to keep all the secrets. So even though I love them, I trust them. Now I give them all the formulas, but patent attorneys won't let you do a lot of things, right? And my journey started actually for Magic Trader 2004 and 2006. First time I used Magic Trader for, I could tell them because now it's no, they don't even exist. Bear Stern, and my partner came to me. He said, I need you to help somebody. He's losing money, and they're all losing money on a Bear Stern. I said, bring him over to my home because I don't have protection of my formula. So he has to come to my house. So in 15 days, let me put you this way. He's the only guy had portfolio positive, right? We recovered the losses, and then I realized I could do portfolio correction. Wow. Then I filed more patents how to do it. And it is true, I filed for the patents that I won't even have a margin call, right? So I figured out a risk table because everything is related to risk, and to avoid that risk, right? So you avoid the margin calls, right? So a lot of inventions were done. And before we get started, I want to be very honest with you. Magic Trade is huge. Not because I said so. Jeff has a pretty much idea. It is very, very detailed. And you don't get to intimidate. It is designed to it take one symbol and you could make good trades. I cannot guarantee anything. I get in trouble because we are registered. And even though if I was not registered from SEC when I had a Series 763, I'm trained that way. Everything is about risk and capital preservation. So let's get started. All right. So I'm going to talk about a couple of things. This presentation was almost never done except few things, basics, right? So I will tell you all these years we kept quiet, right? And Jeff will have surprises too. But I had a discussion with the programmer. He has an idea what I mean for all AI kind of stuff because people we are not we are very conservative company. I don't need to brag people, right? As long as it works, who cares, right? So now it become popular, so it's easy for Jeff to sell it, right? So that's the idea. But AI was part of Magic Trader, and a lot of people who came here, I don't know who came here, but I heard somebody's name. They know from day one the forecasting feature was there, and our forecasting is a forward looking, not based on what happened in the past. And we do not use any of those AI because our AI was in place since 2006 when it was released. We just did not tell people, and that's the best way to do it. Now I feel more comfortable because Jeff and Kelly helped me to lock all this and hide all these inventions somewhere nobody has an access except you. So basically, those formulas will be very difficult for people to know. It's a very complex formula. Today, you're going to get a proof of those. All right, so I just want to give you an idea. So I'm going to teach you today what are those 12 symbol out of, we have 112. Out of that, 51 are for the option. And out of those 51, 12 for bearish side and 12 for bullish side can change your life, right? They are low risk entries for bearish side as well as bullish sides, right? And today, pay attention and you will be surprised how insight of Magic Trader, right? Everybody talks and everybody regular indicator. Technically, everything is technical indicator, but we took a different route. So stay away from traditional. And I was the one who was teaching all these years, but it has to be done in a way traders don't have time. And the person, hopefully, I don't want her to tell my account information, but I do share with people my account information. And as it happens, I send it to them. So this is not like smoking mirrors. She could put it out there, right? Don't please put the account, what happened today, but tell that those were all positive trades or not. As since morning to now, right? Every trade I did about 49 some trades, and this software allows me, there was no losses. It's unheard. And doing options like a scalp is unheard. But this software allows me to make the, but that doesn't mean you're going to do it. You need a lot of practice. But I'm going to show you how to do it, right? But not trading, what do you call it, day trades, right? Because day trade, you have to be very seasoned in your entries. But you could do a couple of trades, right? So let's get started. So I'm registered, my company's registered, so we got to read some disclaimer, but I want to tell you copies of slides or disclaimers only, because somebody asked me, can I get the presentation? We don't give it out, even though it's a patented and everything, but we are very conservative and lawyers don't let us do a lot of things. And Jeff also has a pretty much idea. But we are supposed to tell you it is risky business, and especially options are risky, but you could limit the risk. That's what I would say. Now, everything in trading is risky. Past performance not indicative of future results. You cannot borrow money on a credit card and trade. That's why NFA stopped using credit card to the FCMs, right? Because the brokers are not allowed to take what do you call credit card. But probably deregulation, they may do a lot of things unusual in current administration. We'll see, right? So everything is risky. Now we are registered, so we have to at least tell you. CFT says that even though you do live trading, it is considered hypothetical trading, even though, and it cannot be repeated. So people are giving statements everywhere, consistent results. We are not allowed to say that. We cannot guarantee anything, including my brother wanted to use Magic Trader. I said, no, because I cannot guarantee you anything, because he wants to brag overseas that my brother invented this thing and guaranteed you could make 18%. The minute he told me, I do remember sending Jeff, don't give him any more, any Magic Trader access, because he will get me in trouble. India is very restrictive. People in India, they do whatever they want. It's a wild west. I can't do those things. Options are risky. So everything, if I read it, will be whole hour talking about disclaimer. But they are here. You are most welcome to ask Jeff. He will send you disclaimer slides in PDF format. Now, my company is registered 352991. We took exemptions minute I decided to do things with Metastock because I can't manage money. I did manage people's money, right? And I told them I am not doing any brokering, so I have nothing to do with broker business. I let all the income go in order to do this thing, because whole idea is the little guys, I want to give them something which I believe it works, but there is no guarantee. And I don't use traditional stuff at all. Okay, intellectual property, we are very big. I have spent hundreds of thousands of dollars between lawyers, filings, patent examination, and so many things between both products, right? So we are very strict. We have a lot of trademarks. We don't allow people to use. People do things, and we give it to the law firm and let them go after that. I don't worry too much. Now, AI, we have notified some of the companies, and we have told them that they should allow it, otherwise we will have issue with them. And some of their names are here. So we don't want people to put anything about Magic Trader because it's intellectual property of ours, right? They could give it away for free. We do not want anything. So be careful, because on top of that, they also stream the data. So be careful. Here, President Trump is back. He made those rules streaming data, so blame it on him. All right, this is again our registration number and testimonials. We've been stopped 2 times by CFTC, Watchdog, NFA. So we do not want to put any testimonials, even though bad or good, they don't like it. People do that, but then go and deal with regulators. I'm old. I don't have time and energy to fight it out. All right, everything is stimulated. My company is also telling you scalp swing is a great success. It's a methodology we created out of the Magic Trader. So my whole fight with a wall sheet when I institutionally traded, I don't like drawdowns. So minute I enter in, I need to go positive. So I don't have the bad energy coming to me. And with this scalp swing method, we have accomplished, and it's not in theory. People in my alert room, my mentoring, they see as soon as I enter in, it's a positive trade. So our entries are good, and with this method, right, it is producing good result for me at least, and some people, but you need to practice. Zero drawdown or almost 1 or 2 penny drawdown it's a joke. And that's how you feel comfortable to take higher risk. All right, so this is something I want you to see here. These are the things I'm going to accomplish today. So how to trade ingredients with the Magic Trader. Then what I added, the lineup was there. And today I'm not going to go into too much detail, but you're going to see a lot of slides for lineup. And no, I think this November we did the last webinar. There's a long webinar. If you want to see the lineup and about a lot of details about ingredients, please refer to that. Metastock hosts them, so you could ask Metastock tech support or customer service. They could send you the video for that. And today, what I am going to do, because multiple time frame is my thing, right? Both set of patterns were based on multiple time frame, which I'm going to talk about it. And today, AI, we're going to talk about it, which we never talked before. Believe me or not, since 2006, it is very hard for me. I'm very vocal, very open, and even in my trading room, I never said these are the places the AI is there. First time we revealed was in November, a little bit about it. Today, I'm going to pinpoint them. I think Jeff talked about it in his slides about AI, right? A couple of places, some kind of markings, but we never pinpointed them. Today I'm going to do that. So that's nothing big deal. Artificial intelligence is there since 50 years. We just don't talk about it. I have a close friend. He was a partner in one of my business. He worked for IBM in a mainframe, and that was 25 years ago, right? And he showed me IBM had artificial intelligence 50 years ago. So all the bandwagon on all the hype, I don't like it, right? I'm very vocal about NVIDIA, SMCI. I write things, people who are on my list, they knew it, right? And yesterday was earning. Why NVIDIA didn't go to the moon today? Just think about it. They had a good earning result. At the end of the day, right, people will find out. I'm not telling to short or go long. I'm just telling you, Wall Street is nothing but a freaking hype, right? Don't get carried away. All right. So multiple time frame is your thing, but when which we do it, even on a 50 minutes, I could see what is happening in daily. I'm going to show you some evidence. It was right under my trading room traders' nose, and they did not know it. Just think about it, how deep Magic Trader is. So don't get intimidated. This can change your life. And this was done for little guys, not for institution. I started, unfortunately, when software came out. Okay, I have a retail platform and I have an institutional client, so let's keep it separate. And then, I have a lot of health issue. All these little guys, I want to help them, but it is not a free ride, right? Not money wise, but you got to understand it, because this technology does not exist outside. Everything is new, but it was invented in 2006. It was working model. All right. So now I have a couple of pets here because we have cats and dogs. But so what I did it, the lineup strategy, I put a picture of 13 cats and dog combination here. So they are all lining up to take a picture. I think I got a royalty free picture. I found it, and we are going to touch this strategy. As I said to you before, you could get a detail. It was an hour and a half, 2 hours, the last recordings. So please contact customer service. They're pretty good people there. Now I have two picture. One hand is all the different colors of fishes and galaxies. So Magic Trader, not because I designed it, you will feel that way. And people who are with me for years after years, right, they know every day, every time you go to the trainings repetition, oh, this is something new, same chart, they find new things because it opens up over a period of time their thinking power. So galaxy, we just started knowing, right? Proxima Centauri or whatever, Proxima B or whatever. Oh, it was already there 4.5 billion years ago, but we just found out. So this is how you're going to feel with Magic Trader every single day, every single time you trade. It is spectacular demonstration of the risk changing in front of your eyes. As it happens, it is like forming galaxy in front of your eyes. You never even think that way. Okay, so this Magic Trader Elite is for everybody. For new traders, that's why the gear is big. I'm an engineer, so I always think that way. So presentation also has to have that theme. See, I goofed up here. So too bigger format, right? So in short, we don't care about how it is spelling or misplaced. I don't care. Advanced traders, there are few only, and we have advanced traders coming into this webinar. So I want to give you a nice idea that we're going to talk about multiple time frames. That doesn't mean that the others don't exist, but give an idea to the new traders. These are the different time frames I use every day, right? That doesn't mean 240-minute chart I will not be looking at. I do. All right. So please try to keep your eyes open. Then multiple time frames. You could read it later on, right? But this is the most important. So the cumulative desire to buy and sell securities in multiple time frame in trading was invented by me in 2003. So when people feel cumulatively that we want to buy Tesla, that time those multiple time frame on my first software, I will line up all these multiple time frame. You will see those things from 5 minutes to all the way to yearly chart. So that was the first thing we did. Then in later 2004, another invention was done where traders, including institutions, actually believe in real-time buying or selling the securities and pulling triggers across multiple time frame by pinpointing such event. This is a big thing. So now not only desire is important, but when they're really pulling the trigger, I want to know in a real time as it happens. Two different things. You could desire, but you never pull the damn trigger. What good is that? Right? It will come and go. Here, they're pulling the trigger in front of you, the institution, and this is not some kind of story, right? I have inventions all over the place in Magic Trader. When Goldman Sachs is buying or secondary grade institution buying tier 1, tier 2, tier 3, we know by color of the candles. All right, so you got to go through a lot of videos to get educated. So I was part of the team, right? So I don't want to call them up. Hey, Tom, did you buy New Zealand USD? How did you know? So I don't have to do that anymore. And let me be honest with you, I'm not going to talk about the which institution or which was the bank at that time, but they took a beating after even I told them, lost few $1 billion. And I have a paper trail somewhere. That was Magic Trader telling, not me. I'm just messenger. All right. So now today we're going to talk about yellow bar and indigo bar, or yellow candle or indigo candles, and those catalysts, right, can happen right in multiple time frame, and this is very interesting. You could look at what is happening in daily. There is a setup matching or not, right, in daily, right on a 15 minutes or vice versa, right? And Magic Trader, that is the artificial way getting around the multiple time frame what we use before to write a program, and that programmer is no longer there. Then I'm doing myself programming. I figured out at the last moment that I could do that, and I wanted to know on a daily chart if the weekly is showing or 15 minutes also lining up. So that gave me a booster in pulling the trigger very comfortably. So you will see those displayed today throughout many things. So now I'm going to go a little bit faster because I got to catch up the speed, but these are the basics. So risk cluster, this is one cluster, right? And we're going to get into that details why this software is unique. So when we file for patent, nobody want to believe there are more than 10, 15, 20. So I always be conservative, 50 risk. But in reality, it was much more than that. But I was afraid people have a controversy, just like we seeing with the current administration, thinking out of the box kind of thing, right? And I'm not the politician. So, but we know this guy very well from construction point of view. We get bonuses, so because we do the right thing and we do it before the due date. So risk clusters, right, are existing. I'm going to show you scientific proof, right? So you don't need to be skeptical because of those risks, and you don't know how to identify in real time. You are pulling trigger when you're not supposed to, right? Because this is part of the problem I had using the traditional stuff. So that's why it was developed that way. And this is not we smoking mirrors. We, we file for patent and spend a lot of money for that, right? So I have my own commitment. And let me tell you, sir, my health was one of the reasons we gave my portion of the company to the loyal employees, and they become all multi-millionaire. And I'm putting my time since at least I should say 2003, 2004 after these things. I have my commitment, my skin in a game, day and night. Jeff will tell you. We get text message at 2 o'clock in the morning, which I'm not supposed to. But this is the one type of risk cluster on a bearish side, and this is a risk cluster on bullish side. And you could see within that bubble here, there are 3 of them. Then is connection. So I don't want to get into how it was designed, but you could see the complexity, right? So this belongs to later on going to tell you which candle. All right, now you see the details. I'm an engineer, so I like to tag everything. So in one cluster, there are sub clusters, and we tag every risk that way. So otherwise I can't design anything. So you get an idea. Here also different tags. So that doesn't mean there are other tags I did not do just for sake of waking you up. That doesn't mean they are not counted in there, but they do exist in every candles. Those are the different kind of risk you coming across. So now look at this here. You talking about yellow bar, 3 major types of yellow bar. Here, this is very strong. This is a little bit weaker than these, and weaker than this is this one. So you realize each yellow candles you're looking at has a different kind of risk inside. It's a bullish risk. So for you, so when I went on watching all this year, buy and sell green and red, no, I invented and we got the patent. There are different kind of buying and different kind of selling, and there is a place which is we call is a what you call purple candles, where anything goes either way, right? We identified them as it happens, right? This was shocking to a lot of institutions, right? Because I realized trading on an institution side on order flow, what the hell is this going on? They say buying, but this is a set of people. So set of people were having follow those risks, right? Bad or good risk. You have to understand that. That doesn't mean the other people are wrong, but we went in a very advancement in 2006. Now you have seen many people who are my customer, yellow bar, right? YB4. That's the symbol, the big bull, small bull, and smallest. So the risk strength is different. So how you could tell that yellow, every green candle is the good one. Within even the yellow bar, you could see different kind of risk accumulates. And that's how you should be trading. So your success is much better. We are more accurate. If you want to get 95 plus accuracy in your trading, you got to go through the pain to learn it. Believe me or not, I cannot guarantee anything, but hopefully some of you or people who in the audience, I cannot see who came in, put it out there for other people. Is it true or not? Please don't put my account information, but at least you could see I have many positive trades. Maybe where I lose money sometime because I had to take a loss because market went crazy. So for having risk management, you got to take a loss. But I do not put myself in that spot often. And this is on a bearish side. So get used to this put plus. So for people who don't know anything, basic one, plus means is good. Plus one is a little bit inferior than this. And put is still, but it is still better than candles you're looking at, right? Because these are the concentrated risk out of, I will tell you how many. All right, so now you see I put the candle. So when you see the candle underneath, this is what is going on. Look at this, all the risk. cloud, just like galaxies, right? There is a cloud. There's no cloud here, but they are risk there. So that has no plus here, but they are, right, part of that. So these are the basic you got to understand. Then we're going to go speed. I'm watching at the time. This is the most important slide. I did not even forecasted into the webinar to put it in there until last year, right? First time, and I was hesitant because people think we are lying, but science don't lie. So there are 51 option symbols and 11 highlights. 11 highlights mean different colors, right? So you're going to see in a couple of slides different color, but let's see yellow. But there are 3 different kind of yellow. But even it is one yellow color, there are 10 more. So when you put the formula, which I did not create it, you put those 51 risk, right, or symbols or risk cluster. These are 51 clusters and 11 highlights. 11 highlights has their own risk, and this one has their own risk clusters. So when you combine, combinations are 47.63 trillion. However, they are much more than that because the expert, which Madastock put it in Elite, has 112 of them. I think it's 110 or 112 or 2. I think it's 102, right? I think the programmer got not too happy with me because I sneak it in more. So we had to take some out because, you know, it's a lot of work for him. So at least 102, put 102, get the permutation combination formula and put 11 highlights, right? And you will see this number will be out of the window. So at least for now, there are combinations. So when you add this guy with one of the symbol, this is one of the possibility you're going to see on a chart. That's why it's overwhelming. But they do exist, so you can't ignore that. But I ignore while I'm trading. I'm focused like a razor. All right, I want yellow bar plus plus. That's what I'm trading. And I need my other 5 ingredients lining up. I'm good to go. And I'm taking the risk. So I pull out, right? I'm laughing because now I'm going to talk about AI, right? Okay, so I like these ones, and we're going to go to the next slide. We're going to talk a little bit more in detail, but they're all good, right? You could count them. There are 17 important of them. They're all very important, right? And basically, plus plus and plus is my thing, or if I don't have it, then at least I will buy it, right? But they all have AI part of it, right? I cannot go into detail exactly how it's designed because that's not the way I will ever do that. Now you see here, so when I put plus plus, those are my favorite. That doesn't mean this is not fair, but it is true that the charts you're going to see, all the symbols you're going to see. That's why I put it here, YB3, and later on I'm going to teach you in the next slide what are these means, YB3, YB4, right? YB1 is very easy, right? When you go to even what do you call kindergarten, they teach you all these things, recognizing the symbol. So pick up what you like, crayon colors, and then you're good to go, right? So they all have a different meaning, which we're not going to get into that. Otherwise, we'll be here for another week, right? And Jeff will fall asleep here. Sorry, Jeff, because I want you to be fresh here. So now what I did it, this is right from the symbol list in the Magic Trader what do you call that expert, right? So 12 of them are the good ones, and 12 of them going long here, going short here. And you see there are numbers here. You don't need to get intimidated. I made it simple for you. Look what to look for. So here, right, these are the symbols in option expert, and they are of the same previous slide, and they are here too. But the most important here, what I want to teach here for the new intermediate or people who are with me for a long time, they may not even realize probably. So in here, right, see when I project it moves here, but they're supposed to be lined up. All right, so now this has artificial intelligence, forward-looking artificial intelligence, right? Otherwise, it was not possible to do in a regular programming with Metastock. I came up with the idea. The guy who what he could put it in a C++ for me, right? Understood it. First of all, he said it can't be possible. I said no, because it's a multiple time frame. I'm trading with that for all these years, so you got to do it because it's working, right? Then finally he went along it, and these are the symbols you see on a chart. Those are your ticket for success. This is particular, no guarantee. Otherwise, CFTC will cut my throat off, right? So basically, even though we took an exemption, they could still come after me. So I got to follow the rules. So here, let me show you a little bit here. So 15-minute has indication with a 4. So whenever it shows 4 on a yellow bar, that means we're looking at 15-minute lining up. On a daily chart, we show the YB4. That means it is happening on a 15 minutes. So I don't have to open up 15 minutes. That's what is the breakthrough. And that took me a while to figure all out, but it is programmed in. So Jeff is going to go on today, look into my formula. What the hell I did? I never talked about it. It is artificially done multiple time frame without writing the formulas for multiple time frame. I got it successfully done. Not me, inspiration from God, right? Because this one for humanity is a good thing. So you don't have to do too much technical analysis, right? So same way here on a bearish side, 15-minute, be going down. I'm going to show you the actual examples, and it is indicated by 4. Oh, I want to follow only 60-minute on daily. Okay, so 60-minute, you will see IB3. Oh, I want to do daily on a 15-minute, and you will see IB2. On 15 minutes, we know what is going on daily chart. It's unheard. In programming, it is kind of challenging. All right, on a weekly, all right, on a daily chart, it should be other way around. That's why we all thought about it, right? In a multiple time frame. No, it is also true. Things are happening, but you have to open the chart and identify. We don't have time. So I want to know what the hell is going on. And this all things, I was frustrated on a Wall Street, right? I spent a lot of years there, and I was just fortunate. Helping other people, they realize I'm not the threat. They could use my talents to make a lot of money, right? We don't have time to tell you the stories because it's not the time, but it is true. So I help a lot of traders were my competition, but I don't care. But as long as I could trust them, that is my biggest issue. Can I trust you or not? Okay, because I hang around with too many Italians, good ones, okay, for all my life. Okay, so this is a large portion. So 15 minutes YB4, that means 15 minutes, things are happening, yellow bar, right? Oh, I'm sorry, I mistakenly moved forward. So that's a 15-minute, the things are happening, and it is having plus plus, right? So this is the daily chart of whatever security. We're going to see the next chart, and here is a YB4. That means in a daily chart, we know what is happening on a 50. So I don't have to worry about too much on a drawdown side because 15 minutes lining up with daily without even opening 15 minutes. That's cool stuff for traders. Who knows how to trade multiple time frame, they know how many frustration you could take it away. And fortunately, daily is going along with that. That's even cool stuff, right? So YB4 application from here is done that. Now, 2 is a spike. This is not ordinary spike, right? Jeff had to put a PDF out there who were subscribed Magic Trader and explain because the trader was using regular spike symbol and challenging Jeff. So Jeff says, you deal with the guy. It was very beginning when, because that was artificially done. So this spike appears way before it anchors, and it starts happening before even you pull the trigger. So you are aware. So that eliminated a lot of my worries about short covering. So I know if I was short or if I had a put option, I got to get the hell out of there, right? So this was artificially done, not with the regular MetaStock programming, right? And programmer was a little curious, what the hell I'm doing? Because that's not normal. It's not the way MetaStock software should work. Okay, here is a working model from 2006. Duh. That's what I had to discuss. They go along with that. MetaStock has a smart people there. I'm the dummiest programmer. I have necessity because I put my skin on a game, right? So I'm always worried about all this stuff, right? So I was never a programmer. Jeff can tell you, I was never a programmer. I did not knew anything about programming. Right? My first software, I was this stupidest guy, don't know anything about and formula. He said, "Oh, here's the prime formula prime." I fall asleep minute I read the book. Right? I said, I got to do the practical way and worry about figuring out. That's what I like to do it. So this is also artificially done. Here, artificially done, right? So basically, welcome to our reality. And this is existing since 15 years. No, 18 years. No, 19 years, 2006. But in reality, I started programming in my side in 2004, but we don't want to brag it, but it is true. Right now, same chart you have looked at, I put more symbols. Let me go one by one. So this is where you're going to understand the whole thing. Here is a tree on a bearish side, the spike artificially done. This is the lineup, the lining up. So I had put up here, and this lineup means we have a direction line and we have a spike we call entry spike. So you could go long, and these are the catalysts. So catalyst is artificially done also, right? So as a plus plus, that means close your eyes and go to the moon, right? That's what it happened. So I want you not to get intimidated. You will have a slide. You could study and compare what is on a side here. So you get an idea, right? Only thing what you need to do while you're trading, I don't look at it much. I see 1 second, the lineup is there, yellow bar is there, you could scan it. There are many explorer there, and you could scan every single thing, most of the thing, except the forecaster, right? So these are the forecaster which are here. That is also artificially done. So the software is telling you that we're going to the moon or we're going to go to ditches before it happens. So you will get the 3, 1, and they have a different risk categories, which I don't want to get into that. Here is a 3.3, which is good. That's what you need to know. And I could buy a call option. So people who are buying call option, you could do 200 strategy. I do 30, 40 strategies on options. It is not theory. People have seen me, right? But I go back to the basic. I do not like to trade regular option calls and put, because I want market to pay for my risk. So I like to do vertical spread, butterflies, condors, right? Depends upon the theme, right? Then double butterflies, right? Iron butterfly. So many things I do, right? It depends upon what I see here, right? So I like diagonals very much, but this is called ship turning. So every single event happening, they have to be matched with the option strategy you're using. So most of the people teaching blah blah blah, right, by vertical spread. No, it has to be customized. So your output, and let me put a bombshell here, and it is true. You think that 200% is good, 500% is good. How about 5,000%? Listen, this is not some kind of fantasy. I hope some people comes from mentoring here. They could, I have very transparent way I do the people I do trust. Even though it doesn't do that, who cares, right? But it is true, 1,000%, 2,000%, you could accomplish with very small premium when you use this special option strategy. You could lose what you put it in. So now you put 60 cents per contract. What are you going to lose? $60. What do you care? But if $60 become $240 next day, what is wrong with you? I don't want to get it to give people an idea. People are too smart. Let me tell you something. How about they paying you money and you still make 2,000% on her, right? I'm not going to disclose how Magic Trader allows me to do it. It is not a theory, all right? And the trader who spoke, Jeff name, show the results even today. And I was trading until last moment, right? And I worked target goals and I did only 49 some trades, right? But I did not have a loser. That's what it matters. But that doesn't mean I don't lose money. I do lose money. I do experimentation. I know I'm going to lose, but that gives me idea why I did lose. But my regular trading, right? Nope, I don't want to lose any penny. Sometimes you get carried away, but I try to be humble with the market. You can't take revenge. You got to take a loss. Take a loss. But we have more odds in our favor. All these things means a lot to it. Not overwhelming. You just have to understand and pick up what you like. I show you one, right? This should be three, right? Numbers are wrong, but I was sleeping, I guess, but doesn't matter, right? So you see this thing lining up and yellow bar and plus plus, good to go. And you could see the result. Now, the forecaster is a big thing for me. This was not supposed to be in this version. Unfortunately, I said something before release. I will give it to those traders, which is institutional thing, right? I should not do it, but now it's there. So nothing I could do about it. But you will not get the scanning for that. Otherwise, it's trouble for me. All right, now you look at here, B, B, B. When is B, we going to the moon. That doesn't mean every time. So sometimes you will see B, but it did from the open to the high. So you could do intraday trading. That's what it means, right? And you still can look at it in 15 minutes if you want to. So these are not the lines you are doing. No disrespect to those people using it. For me, I wanted to do customize for every time frame. So they are not your traditional lines. So don't get the idea. I could do that because their values, trading method is different. Everything is different. So this is more or less about software, but this is the health window. It is very secretive. You got to learn, go and do my previous Metastock events. I teach you the two parallel lines and whole non-yet today. We don't have time for that, but you could review those and get curiosity resolved, right? So it is very important you focus on yellow bar, some of the forecaster, so you get confidence of trading. Okay, so I took the charts right from my software, right? And again, look at here, the symbol which you looked at before, artificial intelligence with the yellow bar, and 60-minute is shown on where? Daily chart. So this YB3, 3 is for 60 minutes, right? You could see what is happening in 60 minutes. So why I want to open 60 minutes? I don't. And look, and 60 minute is institutional favorite. When I traded on a Wall Street, we were allowed to always look at the 60-minute, and they will tell us if you don't look at 60, don't trade. Or 240, right, was the another choice, right? And if you want to entry like a retail trader, go to 15 minutes. When we did Forex and I changed the hat, we had to go down to 5 minutes to do design for multiple time frame, so retail traders don't get too much heart attacks, right? So drawdowns are less. So these are double spike. They both are artificially designed. My trainings will tell you more about the spike business, but here is the enlargement. The lineup is there, so that's the right number 3. So these are the numbers we give for 5 ingredients, 1, 2, 3, 4, 5, and previous trainings you could learn more about it. So today is not the day. So again, YB3 is the 60-minute lining up with the daily. So there is nothing wrong with that. Institution doing, I do it. That's what it was designed. This is the perfect, good stuff, right? Look at this here. And this is also AI, right? So in here, A is weekly put risk cluster IB1 in daily. So here on a week of 11/29, right, it was situating, same indigo bar was forming, and here also this symbol was happening. So there is a black candle and indigo one behind each other. That's why it looks funky. But the symbol tells you that they're telling you we're going to go down and you buy put option. That is as simple as that. Now another chart, right, this is cool stuff, okay? So here, same way, both side, what is the chart here? 30-minute chart. 30-minute chart has a both shown 50 minutes on a 50-minute chart, and here 60 minutes at the same time on where 30 minutes. So 30 minutes showing 60 minutes and 30 minutes is showing 15 minutes. How cool is that? This was my dream since I was on a Wall Street. How can I do that? And I did not know how to do programming. God gave me those energy. Now this is the first time in history it did happen. And this is existing since how many years? Since 2006 officially. So think about it, how far Magic Trader comes from. And it is still kind of shocking to many people. There's nothing to shock. It is all based on the risk cluster happening in 30 minutes in this slide, right? So now while you're trading, you could say, oh, I know what is happening. Bulls are buying on a 60 minute. Let's go. They're selling here. I'm shorting with them. That's what I get out of it. So you don't need to be a project out of it. You got to just get used to this symbol and take advantage of. Here is 2 yellow bars. Okay, oh, it doesn't have plus plus. Who cares? These are the neutralization. This is the first thing I send it to Jeff. I'm still waiting for it. He liked it or not. He probably forgot. But this was the first time when I was on Wall Street. Right? I want to know when people are done with selling. These are the points they're done with selling, and that also comes plus sign too. So long story short, neutralize every damn seller, and look what happened after that. Going to the moon. Here is another AI. But I didn't put AI everywhere because it goes crazy, drive you crazy. And this is the line diagram in 30 minutes, 50 minutes line up. So I want people to realize in same 30 minutes, we could see multiple time frame. I don't need to open all of the things. So that saves me time because I'm also trading a lot, right? Trading a lot means, let me tell you something. I'm a crazy trader. That's the best I could tell you. But now I don't take those kind of risks anymore. I have a lot of problems, but it's my passion. Can I do it? And people have screenshot of my platform, my broker platform. I will go at 354 and buy multiple contract, which people will not dare to buy it, and get out in 2 minutes or 1 minute. I don't have to stay there. And I have also shown, yesterday it happened to me. I was helping my wife. I went downstairs. I got executed. The minute I came in, it became a swing trader by itself, right? And I don't want to talk about how many lots were there, right? Everything is hypothetical. Otherwise, CFTC will come after me. Everything hypothetical, right? Not typical. So this morning, every single of them, I did good. And I sent my traders, some of them, screenshot of the broker platform, right? So they've also learned from that how to enter it. I don't tell them how to buy it. We can't do that. So here is a lineup. Look what happened here. It looked like going nowhere, but yellow bar showed up from nowhere. Look what happened. Going to the moon. Now I want to show you which is not part of elite, but accidentally I opened my mouth, right, in a retaliation of something, right? So I figured out without using any option data how I could see market makers or dealers buying equivalent delta. If you know a little bit about trading, then you will know the lingo. So long story short, you are forcing them to buy and to hedge when you're buying out of the money calls. So at least I know they started buying out of the money call, so I got to be careful, right? But I will buy with them, so I'm going long at that time. But they will also take profits here, profit there. So you think that is done. You could get out and you could go back in here, back in business again. Look, this is not your regular gamma squeeze. This was artificially done without any option data. Any option data, right? And Jeff will tell you, I don't have option data from Reuters. They are there, but I can retrieve them. So gamma squeeze is different than what you're hearing everywhere. But no option data use. Market makers or dealers buying, right, LMT equivalent delta to offset out of the money calls buying of others because they have to come up with the stock. So they're buying with you. So when I see that, I load it up and I do not dare to short it because I will get fat. But there are other developments done. I will have those spots where I got to take my profits, right? And there is another one like this, but we don't want to get in. But I want to tell you there is a help out there in the future. Jeff has to put it in there, but not now, right now our focus is to do a couple of other projects. So now look at here. These are artificially done. These are not your Fibonacci. We got the pattern, so we can't deny that. So these are we call magic zone lines. It forecasts way on our left what will be this level way before it happens. All right. So, and did it happen here? Yeah, it did went there. You don't need to be hero. I get the hell out of there, and I go back here on another level and go back, and I do back and forth option trading, regular stock trading. So I just want you to know, and these levels, when you put an arrow here, right? Arrow, Metastock has a good system. Arrow here, they tell you all your levels, and every time frame has a different levels. So you just put it in there, right? Now I just want to tell you a little bit here. So here is the day change here, right? From experience, this is 15-minute chart, right? And this is without this one. But a day before, you had artificial intelligence telling, buy the damn thing. Look what happened. Then it went to the moon. So these are the type A with a like a Goldman Sachs kind of trading desk. They have a retail desk too. So don't kid yourself. Merrill Lynch has, everybody has it. Bank of America has it too. So I know they're buying, but look at what this software is telling you. Going to the moon, they're forecasting intelligent way that we're going to go to the moon. Look, right, AI is telling we're going to the moon. So there are other people, good people out there, but we don't use those chat GPT nonsense. They're a good company, that's for you guys, right? But we don't use, this was already done years back before even chat GPT came out, right? So we don't need to do those things. And we got good things going on, so why we would need them for? All right, I'm going to tell a little bit about it, then we're going to speed up because I'm almost at 4 o'clock. And then I think that I'll show you one or two charts, and that will wait. So basically, my daughter, the older one, she was involved in a business. You could see how many things she knows. So I got to talk about her because me, I'm old man. I had my glory days, right? Not money wise. Money, I made a lot of money, right? And I accomplished a lot of things in a different areas, from real estate to all the way to mining and so many things, right? All this import, export, and all other happy stuff. Then mergers, acquisitions. I was just fortunate, right? I was part of Travelers acquisition team. Let me put it this way. And then nothing stopped after that. They trusted me, and I knew things which I opened my mouth can move millions, right? I kept my mouth shut. But I was fortunate as or before it happened. I knew that travel is going to go up, but insider trading. And the attorney said, I'm trusting you. You are a customer of Travelers. I need to know certain things. I did. They said, okay, that match with our assessment. Okay, we're buying it. But you don't buy it or don't tell your wife either. Okay, I didn't buy it. So my daughter was involved with me for all these glories of my life. And she learned a lot, the little girl, right? And she is also an inventor. And I'm just fortunate, you know, parents always dream about having good kids. This is one of these moments, right? I acknowledge as a father, I'm blessed by God. All right. So this is me. I had my days because I was negotiating mergers, acquisition. I had to hang around with the trading desk to know what the hell they're doing. So I had to go and get my Series 7663. Then, right, one of the people give me a hard time. I said, screw you, I'm going to sponsor myself. So I sponsor myself for Series 3, right? And 34 I was granted because I was one of you Forex trader. So CFTC blessed me for license for 34. My daughter had to go and get the exam, right? So we both have licenses. So my days are over practically. God knows how many days will be there. So I'm going to leave this slide one minute. This is the method of trading. So you could later on stop and read it. I'm not going to go over with that. These are the one who we talk about many times. So now artificial intelligence, you know, only I didn't put it there. I just took this slide so we could go faster, but this is where AI comes in. This is where AI comes in, right? So we don't brag it. This is the first time on spot I'm teaching you where they are. So this is where, look, another chart. we went to the moon. And here are the results when you what you call slow walk, then you could see what was the open price and what was the close price, get confident. Then I did a bunch of those and put it on a table, how many days each of them stayed in a trade, how much per day, $10 it moved per day, which is on option is like crazy, right? And what was the per day return? That doesn't mean you're going to get that, but in option, this will not be even a matter, because you're buying security, but put a call option there. You will have good amount of success. This is same thing, steps, what you need to do that, you get a software, so you follow these steps. Right, here is the catalyst, which is AI here also. These are all line up, you need all these things plus these. So you, when you get the software, line them up and just look at it, will line up, and this is the catalyst, and this is what is enlargement, and you're good to go. And this is where it is. Look here, the price, right, on Adobe, and this is where we cut out, right? So you got an idea. So what I did is same thing. I made a table, right? All those in there. Adobe is there. Per day, how much? $1.39 per day. So 15 days we trade on average, right? So option, I personally don't like to stay more than a second there, and I make good percentage. That's what I do with options. All right, this is all yours. What do you call, Jeff? Sorry about delay. I think we started late, so a little bit late, but it's all yours. Go ahead.
No problem. Thanks, Peter. Wanted to read a couple comments. We don't have a lot of questions. Dakari says Peter's morning market analysis is insanely helpful, as well as his teachings around drawdowns changed my understanding of trading. So maybe you could talk a little bit. I'm just going to kind of take over this lead, but you have a room that you, like a chat room, you've mentioned a couple of times. Can you talk about when you meet?
Okay, lately we're meeting on a Tuesday in the evening now, because some people have a waking up problem, especially from California, right? And we change it. We used to do 2 days. We enlarge that time period. Actually, it's 1 hour. For 2 days, we were doing 2 hours. Right now, we're doing on a Tuesday, and it is very much success, because now I could go in a deep what they want me to do it. So that alert room is a Tuesday, right after 4. We start at 4:45. It goes 7:30, sometimes 8, but 7:30 we finish it up. And let me show you. So probably you may not have to do it. Let me show you. Then you could take it over. Look.
I already took it over.
Yeah,
so speaking of all the topics we're talking about.
So the topics you could talk about that room, and we have anything on a Wall Street I learn, I teach them there, right? So and mentoring, we go in a very deep each topic, and I create these slides, and then we have it on our website, secret location. They get an access, and you're getting copy of those too, right? As I write every time. So that has been good success too.
Udini also has some good things to say. Juan says, I've seen Peter accomplish good returns in the room. I know a lot of people that have been in the room really, really like it. It's a very, very sticky. Once people start in there, they really, really keep it. So let me kind of just talk a little bit about the offer, and then we're going to transition to the next speaker. But before I do that, Peter, I do want to say thank you for coming in here and spending some time with us.
I have to thank to everybody, including you, your staff, right? Without you, it will not be possible, right? And I'm not quitting Metastock. People who are skeptic for all these years, I'm very loyal to people. I'm tough to deal with because I come from construction, right? And dealt with all these stupid mafias here and chase them out without getting one broken leg or any bones. And I had courage to chase them out, and I took it over, right? And we become #1 plumbing company in whole city of New York. All this iconic building, we are there, including Hudson Yard, which was the biggest project we were involved with, and we are doing phase 2, right? So basically, I was just fortunate. And I didn't knew this plumbing business. So I'm just telling you, put your soul into this. You don't know anything about magic. So what? You could figure it all out.
Udini also says it's a great room. So let me talk a little bit about it. We're running a little bit low on time. Peter, thank you so much. I appreciate it.
Thank you very much, everybody.
All right, very good. Let me go ahead and just, as you can kind of see, I've kind of left this up so you can kind of read, but they do talk a lot about kind of this, a lot of different topics. They talk, you get access to kind of his WhatsApp. They meet 2 or 3 times a week. And just all of the different things that they kind of go through and discuss here are included. So the educational room is part of kind of what we're going to be offering today. I'll talk a little bit about that. Also, as part of the offer, what we're going to be throwing in is access to the magictrader.com website, a glossary, as well as the private Facebook group that's available on Magic Trader. I also want to talk a little bit about the Magic Trader Elite product. It's a massive product, very, very big. It has about 58 indicators, 47 scans, 2 expert advisors, 35 templates. Here, hold on, I'm getting some alerts. I'm going to mute this so that you don't hear those. 35 templates, a massive manual, which is how I learned how to use the Magic Trader. There's about 102 symbols, highlights, expert advisors, but really kind of comes down to a lot of the core ingredients. It's where I'd recommend that you focus on when you're kind of getting started with Magic Trader and go through some of the training that's included. We're going to include the fundamentals of Magic Trader, which is 20 hours of recording that and you can kind of see exactly kind of what Peter goes through. He's very, very extensive in going through kind of the fundamentals of how to use things, how to read it, talking about the catalysts that he uses, the magic lines. You can kind of see that. This is a training that we initially did, and I think Peter told me initially it was going to be like 4 hours long. It ended up being about 20 plus hours long. At a retail price of about $9.99, and that's one of the things Peter does really well is he really over delivers. So original pricing, we're gonna talk about pricing for kind of an offer if you want to get started with Magic Trader. The Magic Trader Elite, the add-on itself would be $199 a month. Over 3 months, that'd be $597. The option equity trading alert room is $299. That would be the $897 for 3 months. We're going to throw in the fundamentals of Magic Trader Elite training. That's normally $999. So the total value of the package that we're kind of talking about right now is $2,493. And what we're going to do as part of the conference offer today is we're going to give you 3 months access, as well as that educational alert room, as well as that fundamentals of Magic Trader training. And all of that's going to be available for $997. So to take advantage of that, you can call us at 800-882-3040. You can visit us online and chat with us at metastock.com/saleschat. This particular offer is not available online because of the way that the discounts are structured. But if you give us a call, we'll be happy to help you get it set up. So 800-882-3040, metastock.com/saleschat. And just like one of the things that I will say about the Elite Room, the comments are in the chat, but Udini and Dakari have been such members of that room for such a long time. They really enjoy it. And every time we get somebody new to go into the room, it's something that they keep for a very, very long time. It's a very highly retentive product. And I think the reason for that is it's very, very useful. People find it useful. They get a lot of value out of it. So call us at 800-882-3040. Go to metastock.com/saleschat, or one of those 2 things in any case. All right, thank you, Udini and Dakari, for the great comments and the great feedback. Okay, all right. As we move on to the next part of it, I do want to invite you to kind of go to one of our sponsors, thetradersforum.com. It's a free website. You can go and chat with other traders, learn about technical analysis techniques, all that kind of good stuff. We appreciate the sponsorship. You can find out more about the Traders Forum at www.thetradersforum.com. If you want, you can get out your phone and scan the QR code. There's actually an app for it. You can download an app on your phone and all that kind of good stuff too. So great community of people. I've been in there for a while now, and the idea is to kind of share ideas, learn, grow. Expand your knowledge base there. So thetradersforum.com. All right. Of course, we're Metastock. We talked. You're welcome, Eugenia. Thank you for being here. I appreciate you. We've been talking about Metastock. Greg, I think it's prize time. Do you want to do a prize?
I thought you said it was fries time, and I'm like, I'll take French fries any day.
Only
Love French fries.
Fries. Can we do chili cheese fries?
Oh, yes, right now. Thank you.
I think after this week, we kind of deserved it. We owe ourselves a little bit of a cheat, I think.
I'm not certain I can go along with you on that. I don't think I owe myself any carb cheats right now. These days, I'm been cheating plenty.
It's a reward you get every day anyway. Is that what you're saying?
Yeah, that's what I'm saying. Yeah, my wife's a very good cook.
Well, so it's Metastock prize time,
Whew.
Right? The last prize.
That's the best prize time.
We make it a special one, and I have a brand new list. So I don't know if you've pulled a. Oh, there you are. I don't know if you pulled a Google random number or not, but if you have, you're gonna have to redo it because I've got a brand new list.
Okay.
Now, if you are watching us on YouTube, it's too late to get any prizes today. But if you click on the link that says to be eligible for prizes and you register, you will be on tomorrow's list.
That's right at the top of the chat on YouTube. It's pinned at the top.
Yeah. If you're in GoToWebinar, you don't need to worry about it. You're already registered.
Yep.
So, all right. The number is anything between 8,583.
Okay. On Google random number generator, the number I'm coming up with is 5,339. 5339.
Okay. And that is Jim M. No country on this one, but if your name is Jim M and your domain is also your last name, you probably just won it.
Well, that's. I wonder how many of those there are. Hey, by the way, really quick before I go, you've been great today. Today's been great, and I'm really looking forward to our next presenter, Tom Joseph, and Steve.
I am too.
Last name?
Yes.
I'm Steve Brumbelow.
Yeah.
I haven't heard from these guys in so long. I'm really excited to hear what they have to say.
Yeah, it's their first time that they've done an event like this. So.
Oh, really?
But before we go into that and kind of
oh, I'm sorry, I forgot about the prize. You were going to tell what the met.
We'll just make a big deal about what the prize is because we've got the winner already. And I'm gonna go ahead. So we're gonna give you 3 months of Metastock Zenith. Metastock Zenith was developed at the cost of over $1 billion.
Yeah.
Supported by over 3,000 reporters in 300 different countries, news bureaus. It's a Reuters news infrastructure. Lots of fundamental economic, anything that you're interested in type of data, a literal institutional strength platform, very similar to what you'd get. Wow, the camera just zoomed in on me.
Yeah,
similar to what you would get.
It was to build up the intensity of what you're saying right now, which is really great stuff.
Similar to what you get if you were like subscribing to a Bloomberg. It's that level of data. In addition to that, we're going to throw in 3 months of Metastock. Metastock's been rated #1 for how many years, Greg?
In excess of 30.
32. Yeah, I've got it right here.
Yeah.
I love scanning. We talked about scanning all day. You can scan for anything you want. You can eliminate anything that's garbage and just focus on the opportunities. The forecaster, the patented forecaster is cool. System testing, one of the best system testers that are out there. And then real-time commentary, alert signals. All of that is what you just won. If your name
I don't know how can you get better than that? I don't think I've got some roller skates and a blowhorn in my closet. I could celebrate with that a little bit, but I think you built that up pretty well, Jeff.
All right, very good. All right, our next presenter. Thank you. Also, if you want to get your own extended trial, buy one get two free. Pricing starts at $75 a month, and if you buy a month, we'll give you the second and third month for free.
And so I just posted that link, so just go to that link. Thanks, Jeff. Bye.
You bet. Thank you. Uday asked a question. I think you're asking how we get the number. that Greg picks out of random. And so I will say that real quickly. I'll try and keep it real simple. I think Greg Googled a random number generator. I have a spreadsheet here. It has all the registrants on there. When he gives me a number, I just typed in that number and go to that cell, and that tells me exactly who won. That's all we're doing. It's nothing too fancy. So hopefully that answers your question. It's not that big of a deal, though. Okay. Our next presenter is a good friend of mine, Tom Joseph. We have not had him ever speak on our YouTube channel, ever, or on our Metastock room. And I think that we're overdue. Tom's really, today the topic that Tom is going to speak about is 0-day 2 options expiration, which is something I'm keenly interested in, and something nobody else has talked about at the whole webinar. So without further ado, I'm going to bring Tom on here. Tom, Steve, I don't know if you're both going to talk together or whatever. I know you're both on here. Why don't we get you started?
Hi, Jeff. Thank you. This is Tom. Can you hear me?
Yeah, I can hear you.
Wonderful.
Hi, folks. You're the presenter.
Okay.
And you know how to use GoToWebinar. I'm not even worried. Perfect. First try. All right, we can see your screen.
Okay.
Uday, how we get the list that we're picking against is anybody that registered for the conference. So you don't have to be a Metastock user or anything like that. As long as you registered, which you did, you'd be on the list.
Jeff, just so there is a list of fine print on the emails we send every day, if he's more interested in that information.
Okay. I cannot hear Tom anymore. I can see his.
I'm ready. Can you see
Okay.
my screen?
We can see your screen, yeah.
Okay, wonderful.
And we can hear you now.
Okay,
I was wondering where you went.
Okay. What we're going to talk about today is the 0DTE. And just to give you a background, back in 1987, we had came out with a software called Advanced Get. And that was about the same time that I had met Jeff and Greg there, probably about 20, 25 years ago. So we've known each other for a long period of time. And we are now focusing on 0DTE or same-day expirations in the index options. As you can see from this chart, that the amount of volume that's happening or the options are trading is exceeding sometimes far more than all of the options combined together. So whatever is expiring today, you will see that is sometimes 50%, 52% of the entire volume for the day for all the other expirations combined. So what we focused on is when the 0DTE came in, and 0DTE is like, for example, for stocks, every Friday it's a 0DTE because it's 0 days to expire. Or if it's a monthly option, when the day it expires, it's 0DTE. So yes, we had 0DTE options dating back to the 80s, but it only happened on the day of expiration. What they've created now is an expiration every day that expires every day, and that's what the popularity is. So what we've done is we go through the markets for the last 2-3 days over several expirations and several strikes, and before the market opens, we come up with what is called gamma levels. Basically, the gamma levels is where accumulation of calls or puts have happened, along with there is a large gamma value for the day. And with the combination, we create an index, and that index is just plotted on the screen. So what happens is when you have a situation where the people are heavily short calls or puts or whatever the case might be, and there's an accumulation, during the day, hedging takes place. So when hedging takes place, what happens is, for example, if I come in short a call, and in this chart here, just focus on just the P&L. So in this area, whoever shorted the call is going to make money. And this white line is the current price. If the prices go to the right, at some point in time, they will lose a ton of money. But to the left of it, they have a fixed amount of money they're going to make. So what happens is, how the hedging happens is, if the prices start coming towards that strike, whatever strike they're short at, if they start coming towards that, all the professional does is, instead of going to a loss on the right side of the price, they just simply come in and they will buy 100 shares of the underlying. So as soon as they do that, if you look at the chart, what happened is, if the prices are to the left of it, they're short the calls and they're making money. If the prices are to the right of it, they just simply hedge themselves, and now they're going to make the same amount of money, the same exact amount of money on the right side of the prices. So all they have to do is either no hedging, just be short the option. But if the prices come towards the white line to where they're going to start losing, bingo, they put the hedging on, and now they're making money on the other side. So they are not concerned about hedging themselves, or they're not concerned of being short these calls or accumulating these calls, because if the prices do come to that level, they just simply automatically hedge. Now, the reason the hedging, the question that you might have is, oh, okay, on a monthly option, is there hedging taking place? Yes, but the hedging takes place over a 30-day period, over a 60-day period. When it expires the same day, that hedging has all got to be done in a short period of time. So when there's a large gamma level, so you can see that on this particular day, the largest level was up here at 54.35 level at the top. That's the largest gamma level. How do you know it's the largest gamma level? You just look at the size of it. So if you compare the length of it compared to this and to that, you can see that this is the largest gamma level. So what happens is, because of hedging action that I showed you, the markets sometimes tend to run towards wherever the largest gamma level is for that day. One of the things that you need on top of this is not only an accumulation. So you're coming in with accumulation. So this we calculate that before the market opens. So you know what that level is. Now, when the hedging takes place, it gets to that level. But for the hedging to happen, we need one more ingredient. And that ingredient is what is called the options volume sentiment. And let me explain what that means is. If you look at an option chain for the SPX today over so many strikes, as the market trades, volume takes place on the call side, volume takes place on the put side, and so forth. But what we do is we measure. So if I open up a chart, and let's say, for example, we look at the SPY. Okay. And if I look at the options volume sentiment for that, I'm just going to do it for 10 strikes. What that means is, for 10 strikes above the price, 10 strikes above and 10 strikes below, we're going to monitor every single option that's traded on that strike. Then we're going to identify and say, are they buying calls? Are they buying puts? The pink is, of course, the puts, and the green is the calls. So you can see that today, because of the sell-off, they were buying more calls. Now, this is not on one strike. This is not on a time period. This is 10 strikes above and below the market at any given time for today's expiration. Now, what's the nice thing about this is, if the market is going to make, say, for example, you have a theory that this is going to be a high. If that is a high, what should happen is we should see flat calls and puts increasing. And the way you do that is you just simply grab it, put it at the high. At that point in time, if it is going to drop from there, the calls, which is the green, have to go flat, and the puts will increase. If you're a short-term trader and you decide you want to buy this market right here, for you to be correct, those option traders have to go flat on the puts and they have to buy calls. So this is a study that measures how the options volume is happening for the day. So when you have a situation like this where you have a large gamma level and the market runs towards it, what you will also need to do is for this market to run, okay? For this market to run from here to that area, you have to have where the calls have to increase and the puts go flat. So the puts are in pink color, all right? So the puts will have to go flat and the calls will have to increase. And so on the next chart, you will see that's exactly what the market did is, as when that low came in, if you reset it at that low, from that moment on, what the market is doing is, because of the large gamma level that's here, that's going to drive the prices up while they're hedging. But in addition to that, you want call buying to come in that same direction, not on any one strike, but 10 strikes above and below. So every strike above and below, we measure the calls, we measure the puts, and at any given time, we come up with an index that tells you they're buying calls, they're buying puts. If this market has to rally, it has to have the calls to go with it. You just reset it here, puts go flat. We're not detecting any buying, any significant buying of puts. We're detecting all calls. And so between the gamma levels and the actual action during the day, it drives the prices up to these levels. Okay, I'm going to quickly run through this, and then we'll jump on today's market action, because I'm sure you want to know how you could have been trading today. On that particular day, the SPX option, if you decided that you were going to buy near the low here, which is about 10:30 or so, those call options were trading about $2, and they ran up to 13 something on that rally. Same thing happens here. We hit the high at the gamma level. Now, where is the largest gamma level on the screen? The largest gamma level is right there. And because that is a put level, the hedging action will drive the prices down. So if you follow the market for that day, it dropped, stopped at the gamma level in between there as a support. Once that couldn't hold it, it came back down to the low. And again, in this period of time, every single time the market drops, you should expect to see puts increasing, and that then confirms it. So at any given point in time, you can come up and say, all right, this rally here, if this stops and the puts increase, where am I going to go next? Right there. So that's the direction that you trade for. And on that one, if you were to buy the SPY, you're buying it at a 60-cent put that ended up at $7.50, or the SPX, you're buying the put at $1.61, traded as high as 37 something dollars. Now, can this happen all the time? Well, let's find out. Let's go to today's market and take a look at it. So if I look at, I'm going to get rid of all this here. All right, this is the SPY. So when you first open the market up at 9:30, these are the levels that you see. And if you notice the biggest level, you can actually highlight, you can hover over it, and it tells you the index of how big this is. So this is minus 26, and that's the largest gamma level we have. So at that point in time, when the market opens, you have to make a decision. Can the market rally up? Well, we don't see any significant levels up here for it to rally. We see a big put level. That indicates that if they are forced to hedge, that means the underlying will come down to those prices. And what happened is today is that's exactly what it did. Okay, so right from the word beginning, from the word go, the market dropped. Now, how do you trade it? The way you trade it is you put your options volume sentiment at that point in time. So I'm going to put for 15 strikes above and below because today was a big range day. So what it's adding is it's looking for the calls and puts traded today. Right from the opening, it was all puts. There was, even if you blow it up, you see very little call compared to the puts. That's what we detected. It was all buying puts. So when the market rallied to say to this point in time, okay, or even here, let's say for example here, all you got to do is reset it here, and at that point in time, if the rally is going to continue, the calls should increase. If the rally is not going to continue and it's going to decline, then the calls will go flat and the puts will increase. Same thing here. What happens when the market came to this level here? You reset it there, all puts from that point in time. And so when at this point in time, since it's all puts, where is the market going to? The next gamma level. So what you do is right here, you make a decision that it could go to the 5,900 level, and then you buy a put one strike higher. So you buy a 59.05 or a 59.10 put. So if you were to look at the 59 10 put today, here's a 5-minute chart of it, and I'm going to put it side by side with the chart. So when my cursor moves on one chart, it shows you what the cursor is, same time frame on the other one. So right about here at 125, when you got the sell signal that it's going to go down to 5,900, that put was trading at 79 cents. Or less than that, somewhere in that neighborhood. Oh, I'm sorry, not 79, $1.45. It ended up at $50. And all you did was you walk through here and say, at that point in time, okay? So the thing to do it is, you can put it at this high and say, that's a high. The calls are flat, but you don't see any puts increasing. So that's not the high. And then you keep moving it till you get where the one. So once the put starts increasing, that's where you take the trade. So even if you waited till 1340, which is 140, which is right about there, you're still buying that put at $1.30 for it to go to 50. And how do you pick this strike? This strike is nothing more than this target that you have here, okay, this target, and you're buying 1 or 2 strikes, put 1 or 2 strikes above that. That's all you do. All right, let's just look at does this work on stocks? Yes, let's take on active stocks it does. Let's take a look at this one here. So at the beginning of the day, you have to make up your plan at the beginning of the day. So this is what you see at the beginning of the day. So you come in and say, I see several levels here. I see some major levels here. So it could go up to one of these levels. Maybe it could go to there. That's my scenario number one. The other way is, if it starts coming down, this is my biggest gamma level, and they could drive the market down to here. Those are my two scenarios. How do I decide which way it's going to go? Remember, we need one more ingredient. We need to look at how the options are trading for that day. And if it is all calls, it's going to be scenario number one. If it is puts, it's going to be scenario number two. So it followed scenario number two. And if you put the options volume sentiment on there right from the beginning, there was no calls. It was all puts. That tells you, as soon as you see all puts like that, you forget about that. It's going to scenario number two. Where is the largest gamma level? Right there. That's where it's going to test. Right? What about if you were trading the SPY today? At the very beginning, when the market opened, you could make a case that it's going to go to this level here because that's a green level. But look at how small that is. So that's not going to attract significant number of people. Once it broke this big level here, and it's all puts, they're not buying any calls today. The buying was all puts. And so when this thing rallied and ran into this big gamma level, all you had to do was figure out, drag your cursor up to that high and look and see if the calls are picking up. If the calls are picking up, it's going to go higher. If the puts are picking up, it's going to come lower. And if it does come lower, it could go to 590. If 590 doesn't hold, it's going to 585. How do you know if 590 is going to hold? When it hits 590, stick it there. If that 590 is going to hold, we're going to see calls. If you're still seeing puts coming in, it's not going to hold there. It's going to come down to 585. Okay, let's just look at NVIDIA. Okay, I'm just going to bring NVIDIA up here in a second, NVDA, because I want to put it on the training mode so you can see how this thing works. Okay. Okay, there's the market for NVIDIA today. All right, as soon as the market opened up, we got these levels. Again, you write your scenario down, okay? From here, because there's gamma levels here, the stock could get attracted to there, or it could get attracted to here. That's scenario number one. But on the other hand, if it starts to drop, these are small levels, minor levels. Where is the biggest large gamma level? Right here, 120. That's my scenario number two. How do I know which scenario is going to happen? Is it one or is it two? I don't know. The only way you know that is to put the options volume sentiment, put it on, and bingo. Right from the word go, it was all puts. So when you see a situation where you have a large gamma level potential, either up or down, and you have your scenarios set, and all of a sudden the market opens and it's all put. That means in the marketplace today, collectively, over 10 strikes above and below at every given price, are they buying calls or are they buying puts? The index tells you they're buying puts. If they're buying puts, scenario number one is not going to happen. It's going to be the second one. And if it's a second one and the puts continue, where could the prices get attracted to? To the largest gamma level. And that's exactly where it came down to. How could you have traded that today? Well, let's say, for example, if you are trading NVIDIA options, you would come in and you would go to the closest expiration, which is the 28, and you can come in and buy the 120 put. So you go one strike above, so you can buy the 121 or the 122. So if you open up a chart for that, at the beginning, when these puts started dropping down, you're buying it at, you know, even any of the point in time, you're buying it at about 60 cents, 75 cents, and it ended up at $3.50 or $3.17. Right? I just want to show you a couple more just to give you an idea how one can trade this. All right. So here, it doesn't matter what the stock is, as long as it's an active stock that has auto options, you can apply it. So here's MSTR that opened up. Where did it open up to? It opened up at a significant gamma level. That's where it opened up, right here. So that's a level they have to test. These levels are so small compared to that. You can still make a case, you know, if the calls start coming in, it could go there, maybe there. That's your situation number one. If it's going to come down, where could it go to? So you drop it up and see where these levels come up. And what you're finding is that you could possibly come down to here or here. And that's your second situation. And which one is going to take place depends on how the options come in for the day. So I'm going to put the options volume sentiment and look at it closely. And there's the answer. Right from the word go, it was all puts. So what the options volume sentiment does for you, it measures how they are buying calls or puts during the day. When you look at a strike, when you look at a call or a put, you can't tell if they're buying or selling. What you have to look for is across the board, 10 strikes above and 10 strikes below. Wherever the price is, 10 strikes above, 10 strikes below, you add up all the calls and the puts, see how they're coming in. Are they buying it at the bid? Are they buying it at the, selling it at the ask? How many contracts are traded when the trade comes in? We take all of that into consideration and come up with an index, and the index just points out in real time if there's calls or puts. And all you have to do, if you want to reset it, so on this rally, is this a counter trend rally? The only way you can answer is you reset it there. If calls are building up, it's going to continue. If puts are building up, it's going to come down. So it just goes on and on. I mean, today was an exceptional day for this. There's NVIDIA. You know, it could go higher when the market opened. You could make a case you had all these green levels there. It was going to go there, and it's possible it could. But if it is going to go there, the calls would have picked up. As soon as it opened, it was all puts, and that brought the market down to the lower gamma levels. And so there's substantial amount of money that can be made on this if you can figure out exactly how these levels are calculated. So the simple thing is, at the opening, you put it on and you look at it, and if one level breaks, where is it going to go to? And that's really the answer to it. So if you go to our website, dynamictrend.com, if you go to the daily gamma examples, we have shown you the daily gamma examples going back to April of 2023. The 0DTE started trading about 3 months prior to that. So within 3 months, we had come up with the indicator. And if you go through the examples, you will find that the largest gamma level of the day gets hit about 70% of the time. And when a pullback comes in, you reset it here, and at that point in time, if it's going to rally, you got to see flat puts, calls increasing. If it is same, look at the example. If this high is going to be a high, you reset it there, and if puts are coming in and these levels drop, where can it go? It can go to these lower levels right here. So somewhere here, once these puts starts building up, if you decide that's going to be that it could come down to this level here, you just go out and buy a put, 1 strike or 2 strikes above this level here. You're picking these up for less than $1.50, $2, and it could end up at $15, $18. This particular day, because of the large decline, yes, you could get substantial profits out of it. So the way to educate yourself and way to decide if this is really something that you can trade with, every single day for the last 2 years, we have and some days if the market is flat, we didn't waste your time. So you can go back to April of 2023. Here's July of 23, and so forth. Take a look at it. We're working with Metastock on this particular program. We haven't hooked up with the data, but in the meantime, we do have a special pricing for the users that are here. Normally, the gamma levels are $1.80, $180 for the month. That includes all the data that you need as well. And you can also come in and do a yearly, and that's our regular fee. If you go to dynamictrend.com with this code, you would be able to buy it for $150 a month or $1,400 a year. And essentially, you have to be a short-term trader if you either 0 DTE or trading stocks for the Friday expiration. It works better in the indexes, the SPX and the SPY, but some of the higher options volume stocks like the Netflixes, the Teslas, and so forth, it really helps in identifying where the market is going and taking trades in that direction. Jeff, that's my presentation. I'm passing it to you to see if you have any questions.
I have some questions from the audience. Oh, can you hear me okay?
Yep. Yes, sir.
Oh, okay, cool. Let's see. Ron wanted to know, do you have a scenario to find the optimal expiration date?
Okay, so the whole concept of the gamma levels and the options volume sentiment is for 0 DTE. So the expiration, if you're trading the SPX index or the SPY, is that day's expiration. So if you go to the option chain, you will see that there's an expiration every single day. So that's what you would trade with every day. Now, if you're trading some of the high, like for example, if you're trading Tesla, you don't have it every day, not yet, but you have it every Friday. So you go to the closest Friday as possible, because you have to understand this levels where they have to hedge. If you buy an option that is going to expire in 30 days, they have 30 days to hedge, and you're not going to see that action come in as quickly as you would on a 0 DTE. So if you're going to employ this technique, it has to be something that expires soon. And from my understanding, that they are going to come up with 0 DTE or same day expirations for some of the active stocks pretty soon as well. All right, that's how I would pick the option expiration month.
Cool. Another question, also from Juan. Does the sentiment analysis take dark pools into account?
It does not. It just simply takes 10 strikes above and below. So whatever the price is, it takes up 10 strikes above and below. It takes every option So essentially 40 different option contracts, because you got 10 above, 10 below, that makes it 20 calls and 20 puts. So we look at 40 different options contracts, and then we come up with the sentiment index to tell you, are they predominantly buying calls and puts?
All right. Robert wants to ask, would this same concept apply during earnings announcements?
It's a good question. On the day of earnings, we see that sometimes it's not that good. But after the earnings, like for example, NVIDIA, it came out last night. So this is what you would have seen if you were looking at NVIDIA today. The prices opened up. It had a chance to run up to 145 because that's where the biggest gamma level was. There was a huge accumulation at the higher levels there. But what happened is that's a potential. It could go there. But there was also a large potential accumulation right here. And because these were puts, if these guys start hedging, the prices will come down. If the calls start hedging, it'll go up. But what is going to drive the hedging? The hedging is driven by what the options market is doing for that day. And how do you know that? You cannot look at an option chain and tell which way they're buying calls or puts. The only way to do that is come up with an index, and you can see right from the beginning, it was all puts.
All right, so another question.
Yeah, that drives it. So yes, you can use it, but if you just look at the market in real time and trade accordingly. Yes.
Cool. Jack wants to know, can he use this on Thinkorswim?
You can trade through Thinkorswim. Right now, this uses a quote media data. Here's the problem. Thinkorswim does not allow somebody to get access of that much data. If you ask for 40 options, which is 20 calls and 20 puts, they're going to shut down your interface or slow it down, saying, okay, you've reached your maximum for 5 minutes, wait for 5 minutes to get more data. So no, this will not work on Thinkorswim, but with our program, you get the data, and of course you can trade on Thinkorswim.
Yeah, you can trade on Thinkorswim. It's just the data and the graphic requirements. This is its own package. It has its own charting. It has its own engine, all that kind of stuff. Juan wants to know, is there a minimum call sentiment, put sentiment ratio to have a good chance of having a favorable trend? Thank you, Juan.
Yes, we looked into it quite a bit. We haven't come up with an answer on what that minimum needs to be, but the pattern that we look for and the pattern that comes up is like, as this rally progresses, if you think this is a counter trend rally and you want to short it, all you got to do is at any given time, set it there. Is that the high?
That's cool. That's really cool.
If it's a high, the puts have to pick up. That's not the high. How about the next bar? No, it's not the high. How about that? No. How about that? No. How about that? So now you see the puts, the calls go flat. So on that bar, that's where you see the puts go. Puts are increasing, the calls go flat. So if you're trying to short it, that's the bar that gives you the confirmation. And I usually like to wait for 1 or 2 more, 3 more bars for confirmation. So let's say you waited for 4 bars, which is at 130. So let's say, and you know that if it's going to break, the biggest gamma level is at 120. So let's come in and take NVIDIA, for example, and look at the expiration that expires on Friday, and then look at the 121 put, because you're trying to buy one strike above. So here's a 5-minute bar set of that option of the put, okay? And at this particular time, after you got 3, 4, let's even go 5 bars of confirmation, you're still buying it at 40 cents. That's what you're buying the option for.
Very good. That's really cool. One wants to know, for daily options, according to your experience, do you prefer 1, 2, or 3 day expirations?
In the sense of zero GTE, I prefer the same day expiration.
Okay.
And same thing with the stocks. If you're day trading that particular stock, so this trade is not to carry Tesla or Nvidia for tomorrow, you're just trading it for now, then you go to the closest Friday expiration as possible.
I think we've run out of questions, Tom. Let me make sure we don't have any more. No. So I think we should repeat what the offer is, just to get people going and that kind of stuff. We've got the link in the chat to this website. It's dynamictrend.com/SOTC25. Keto special pricing $30 per month discount. Is that every month, or is that just to get started?
It's grandfathered in once you get
okay. So as long as you keep that subscription active, it's going to be $150 a month, a discount of $30 every month. To get that special price, you need to go to dynamictrend.com/SOTC25. And that's all I have. And that's all the questions we've got, Tom.
All right. Thank you, folks. And I hope it's given you some ideas on expanding your trading horizons.
I have to say that I really like the fact that you can just click on that and it kind of gives you that bar only. That's really cool.
Thank you, Jeff.
All right, very cool. All right, so with that, let me go ahead and kind of take this over again.
Okay.
We'll kind of appreciate your coming in and spending. Tom, it's been too long. We haven't seen you for a while.
Well, we'll touch base, Jeff. Thank you.
For sure. All right, good. All right. Do want to, as we kind of wrap up today, lots of thanks to give. I want to say thank you to Tom, all of the other speakers that have come in and spent some time with us. I want to say thank you for being here. I hope one of the big goals I have is that you learn something, at least one thing, for 8 hours of education. Hopefully you get something out of it. I know I always do, and I hope it was beneficial for you. I want to say thank you to the sponsors, American Association of Individual Investors, sponsor of ours for a few years now. Great nonprofit. They've done a wonderful job of supporting the conference, and you can find out more about what they do at aaii.com. Also want to thank Stocks and Commodities Magazine. You can find out more information about stocks and commodities at traders.com. I've got Stocks and Commodities Magazine ever since I was an employee here. They just they've always sent me a copy, and I appreciate that. But it's a great magazine. You're here at the end of the day, a really long day full of education, and I think that means that you understand the value of kind of improving what you're doing. And I would encourage you to take a look at and get a subscription to Technical Analysis Stocks and Commodities Magazine at traders.com. That subscription will give you access to all of their article archives. It'll give you a physical magazine that arrives in the mail every month. And it's always talking about different ideas around technical analysis. It's a great resource, traders.com. Of course, the Traders Forum, join that, www.thetradersforum. You can chat with other traders, talk about the markets. You can learn about technical analysis, learn about candlestick patterns, all kinds of stuff. It's a community of traders helping traders, and we appreciate their sponsorship as well, thetradersforum.com. And then, of course, we're Metastock. We've been talking about Metastock all day. 32 years in a row, it's been rated the best software in its price category, and helps you test trading ideas, scan markets, focus on opportunities. Our forecaster can help you get probable price movements. Scott talked about that yesterday. All the pricing on that starts at $75 a month, gets you everything. We have also a full real-time version as well. If you buy a month, we're gonna give you the second and third month for free. In addition to that, we're gonna sit down with you with one of our support reps, and they're going to kind of walk you through the program, answer any questions, show you how to do scans, whatever it is that you want them to show you, they will. We'll give you unlimited access to our technical support team. We'll give you unlimited access to our training materials to help you get started. I wouldn't trade without it. I love the ability to scan the markets and find those trades. You can get that at metastock.com/conf promo. If you have more questions, well, you can type them right now. CJ says this is very good. Thank you, CJ. Go on. I'm just kidding. You can chat with us at metastock.com/sales chat. You can sign up at metastock.com/conf promo, and you can call us at 3040. We do have another great lineup of speakers tomorrow. We're starting with a good friend of mine, Anwari, and I will see you again bright and early tomorrow morning. So I want to say thank you for being here. Thank you for being part of the event, and I look forward to seeing you tomorrow.